Good morning, ladies and gentlemen. Welcome to the physically and also virtually to the Austrian National Bank. And today's conference dedicated to financial stability, building resilience, and managing financial crisis. We start unaccustomedly 5 minutes too late because, as you have seen, we had recently a little bit of rain, a little bit too much, and so not everybody may be here who thought to be here. In my opening, I will, essentially pay tribute to the institutions and to the program here. As this is an area where I continue being a student of the banking system, I abstain to make, my own contribution to that. This may happen in the future, but not yet now. The host of the conference is the Austrian National Banker, and we are honored that we have 3 institutions, a national institution with wide reach and wide reputation here working together on this great program. The first one is the Joint Vienna Institute, which is a regional training center which was established in the aftermath of the transformation in Central Eastern Europe in order to allow institutions and their civil servants to gain access to Western knowledge and training. And their original funders were 6 institutions, and the lead with the IMF. They're still there. The others contribute off and on, and it gets also strong support for the Ministry of Finance and by the Austrian National Bank, and I'm proud that I was, always well involved from the very beginning with this institution. Second, we have SUERF, the European Money and Finance Forum, which is, as we know, an independent think tank, which brings together bank supervisors, financial institutions, academic institutions, etc. And also the Austrian National Bank, it hosts the Secretariat of SUERF, and we are very happy about the interactions we had over the last years were very productive. And last but not least, we have the Yale University, created in 1701, and this one of the 8 Ivy League institutions there. And the Yale program on financial stability, the program is established to create, disseminate, and preserve knowledge on financial cases there. So what we intend to do is to jointly explore the lifespan of financial cycle, both from a theoretical and from a practical perspective. We are going to look into the development of financial markets over time, from the seemingly calm waters of normal times to the building of systemic financial risk, and to the final lead of a broader financial crisis, and ultimately to crisis management, and finally to the post-crisis reform. In this respect, the most recent financial history, starting in 2002, could teach us a lot of lessons for those who care to look at them, and we definitely intend to heed lessons to the financial history. And I think it's very important always to go back to some extent, and what we had in 2000 at this time was more the beginning of the access to the internet. What we have nowadays with AI, then very interesting parallels, at least from where I sit. Together, we are going to take stock over the key risks on financial stability and focus on successful and less successful financial crisis intervention strategies. And we'll also explore how to make the financial system resilient to imminent risks ex ante and in good times, And since the global financial crisis, macroeconomic policy has proven essentially in complementing macroprudential supervision. It addresses severe risk of financial stability. Hence, our topic will include first, how to foster financial sector resilience and address vulnerabilities, how to contain financial stress and bank runs in the world of digital banking and social media, and how to manage trade-offs and the crisis intervention, and how to best address a crisis-related stress assets there. And then I have a long list of things about what you are going to hear, which I will, not use now. I will use the occasion to say something about this hall, what you have here, because some of you have already been here before. We opened it a couple of months ago, last autumn there, as after working it over, in order to establish an institution of learning and with modern possibilities to project inside and outside. So what you have here is quite likely the most modern hall in order to have international conferences, and we have 3 screens here on which we can projector and with cameras auto-activated to make it happen. And we did it also because we found out that there are more and more tendency not to attend physically conferences. Very simple, because first of all, also part of the financial crisis and the energy crisis and the attempt and hope to change the world climate. Nowadays, going into an airplane and traveling, let's say, 10,000 kilometers to Jackson Hole. Frankly speaking, I start to have some reservations. I like to go there, but going there for 3 days and returning there makes a lot of kerosene which is blown into the air. So I think we try to prepare something in which we need to have ways in order to be engaged in a discussion, but in a way whether one is here or in Yale or somewhere else doesn't matter. Of course, it will be up for future governors and boards to do the next incarnation, which we will have our hologram standing here, and we don't have to travel anything more. But I think this is a critical part, and if and as you will discuss today important topics of financial crisis and supervision, I think it's always on our mind what the environment is doing, but I think you will also look very carefully what can be the role of financial markets to help there. And here my personal position is that it's an important, but we should use the right instruments and not misuse financial markets in order to impose very worthwhile objectives there. And with something in this direction, and then I stop here. For those interested in environmental affairs, and particularly what works, what doesn't work, it's about now 3 weeks ago, Science has published the first comprehensive study going over 1,500 interventions, individually, jointly there, and came out in some of the networks there. And the main message there, I think one should to look at, is to say, okay, what has worked, what hasn't worked, and the 2 messages which came out there: mixed interventions work always better than single intervention, but there's one exception, which is CO2 tax, taxation of CO2 is as a single instrument very successful, and of course combined even more so, which shows how to say that the financial market has important things to do but shouldn't be misused. And with this part, which is not in my write-up, I will wish you all the best here. I hope I can pop in off and on to do it. Wish you good success of the discussion there, and a great day here and in Vienna. Thank you very much.
So, good morning, ladies and gentlemen. It's a pleasure for me to be here and to welcome you at Austrian Central Bank as well. As Governor Holzmann noted in his introduction, we are in a currently uncertain phase of the financial cycle. There is some audio issues. Perhaps we can try to fix it first.
Okay.
Just for... You can hear everything? Great. Thank you very much. So just to be sure that everybody who is virtually attending will be able to get everything. So again, welcome here. As Governor Holzmann pointed out, the current situation of financial markets and the financial cycle and the direction we're going is remaining unclear. We see that non-performing loans are on the rise. On the other hand, interest rates are likely to decline gradually. At the same time, we have significant geopolitical risk, and this leads to vulnerabilities of the markets, for example, in commercial real estate markets and in all other segments of the financial markets as well. So the period we are experiencing right now is especially dynamic. And we see that perhaps not all of the agents, including regulators and supervisors, are capable of fully understanding the whole range of possible risk and to deal with that uncertainty. And also policymakers, in the narrow sense of the word, might not be fully aware of risks and effects of different policy measures to be taken. So the first session will deal with financial market stability and with resilience. I think it's important, and I expect a very interesting and vivid discussion, because that will be the main topic we'll be facing for the next years. And especially in that period of uncertainty, it's of crucial importance to also focus not only on perspectives and forecasts, but also on possible remedies for risk emerging. So let me welcome the colleagues for that first session. It's a great pleasure to have you here, and thank you for taking every effort to be here. First of all, Alessandra Perrazzelli. She is Deputy Governor of the Bank of Italy since 2019. You previously held several positions in commercial banks in Italy, including Barclays, Intesa, and others. And I think you will be, additionally to having a great overview of all the supervision issues in the Euro area and in the SSM, you will also be able to elaborate on recent developments and also on national measures of Italy, because Italy is always a big player.
Welcome. You so much.
It's great to have you here. Second, Livio Stracca. He is currently Deputy Director General for Macroprudential Policy and Financial Stability at the European Central Bank. Livio, thank you for coming here on short notice. You're holding several positions, and you have held several senior positions at the ECB, spanning a range of the key business areas of the ECB. And as the current Deputy Director General for Macroprudential Policy, I think it's your natural field of expertise to enrich the discussion with the European perspective on Macropru. And as you know, in times of certainty, things might be easy. In times of uncertainty, there is always the issue of Micropru and Macropru. And in a perfect world, perhaps Macroprudential policies could address all of the issues we have. but the collective action taken by financial market agents is more than the sum of Macropru. So I don't have to give you a lecture on the importance of Macropru as well. Thank you for being here as well. And Boris Vujčić, thank you very much for joining us here as well. As the other two, I won't have to introduce you in detail. You're well known to everybody. You have been governor of the Croatian National Bank since 2012. So in addition to all the core topics of that session, you could also give us, I'm sure, your views on the beyond EU perspective, given also your role in the Vienna initiative, which is very important to us. So thanks all for joining us. Before I begin with the question, it's called interview session. Yeah? Let me give you a few remarks on that. Interview session, in my view, just implies that there will be no PowerPoint slides and no presentations at the beginning. But then I will try to raise some questions to all the participants here. I would ask you to try to stick to not more than, let's say, 3 to 5 minutes for each question. And then we will try to get into discussion as well. So please be free and feel free to interrupt at any time. For the audience, I would invite you also perhaps not to interrupt at any time, but we will spare some time at the end of the session for a discussion, and also everybody who will join us and is joining us right now virtually will have the opportunity to raise questions online. So macroprudential policy has had a time of some kind of underdog for the last years. And then, as the situation changed, as I pointed out, it has become a key pillar of effective supervision, and virtually every country in the EU, every SSM country has implemented Macropru policies during the last years. So I'm talking about systemic risk buffers, I'm talking about OSI buffers and GC buffers, I'm talking, of course, about borrower-based measures, which have been a huge political discussion in all of the countries. In Austria, we have adopted several instruments, for example, capital buffers and also borrower-based measures. And the application of macroprudential policy has proven successful. In terms of that, Austria is still among the 12 countries with the highest rating of the banking system, according to Standard & Poor's. And so it's one of the top banking systems in the world. So I'm delighted to have experienced policymakers and sharp minds here to evaluate the pros and cons and the critical issues. So let's go directly into the discussion. And perhaps, if I may start, Alessandra, what's your general views on the financial market stability situation? Just to have a warm-up question and a warm-up for the discussion with the audience.
Well, thank you so much for having me here. Thank you. I love to be in Vienna. I love to be at a central bank. And thank you for, we've been colleagues on the supervisory board and know each other and fought some battles together. So we are looking at the world which is, at macroeconomic level, extremely uncertain. We are right now in a situation where the outlook remains very much elevated. So clearly, all the tightening of monetary policy, the limited fiscal space, contributes to maintain a challenging framework. However, we are in a position today which is extremely different from the one that we have experienced in the past. I think that following the big crisis of 2007, 2008, we are in a much better situation as a collective Euro system and in the national states. I think that the ability for our system to react to the pandemic has been extremely important, relevant, and I think also that together with the measures that have been enacted at macro pro level, we have done a job as supervisors which is extremely important in making sure that the banking systems of the Euro system had been stronger and more prone to deal with the shocks that are still on the horizon. I think that we've seen last year, we had a couple of weeks in March where we didn't sleep much, with the US and Swiss issues. And I think that that was, for me, one of the main point of interest in proving that everything that we have been putting together works. And the Euro system has been able to resist and to, to have a good standing before such a, the size of the crisis was not, of the two banks was not negligible. So I don't think we should be complacent. I don't think we should relax. I don't think that we should be in a position to say we've done so well, we can just look at the future with only a positive outlook. I think we need to stay on the job in a very, very strong way. You were saying I come from the private sector. I've been a central bank for the last 6 years. I've been dealing with banks that were doing well and banks that were doing not so well. And I know that it's extremely important just to have all the tools in our hands as supervisors and as regulators, particularly in this time of uncertainty. So this would be my opening remark. Positive, but let's not relax too much.
Thank you. I think the question you raised, and you just partly answered, is we have increased resilience a lot during the last decade. Yeah, so after the great financial crisis, capital quotas have been increased, CET1 ratios have been increased significantly. So perhaps we will come back to the question, as the title and the topic of the session states, strengthening resilience. Is there still a need? And you just said we shouldn't be complacent. So Boris, what's your views on the current situation?
I think it's quite good in terms of the financial stability. We weathered the huge shock of pandemics very well. You don't get this type of shocks typically in your career. I've never seen it, and hopefully I don't see it again. And we were nervous in March 2020, not only in March 2023, even more in March 2020. But it worked very well. It worked very well on one hand because we have a better, more resilient banking system. After the GFC, all the reforms that have been done have made it better capitalized, more liquid with all the new requirements. However, for example, in Croatia, we had the capital adequacy ratio of 25%, NSFR 170, LSR 230. None of that would have been sufficient in the face of such a shock if there was not such a huge fiscal intervention that we saw at the moment. So sometimes you have shocks that no banking system would withstand without a very comprehensive response of the monetary and fiscal policies. Now, with the help of a hindsight, you might say we did a little bit too much. We didn't have to do that much, but from the perspective, I remember when we talked in March 2020 how it looked like. It was always better to err on the more conservative side, as always in the central banking. So we weathered that storm. Then the subsequent recovery helped the banks, and now I think that it's really nice for the banks. It's net interest margins went up due to the nature of the monetary policy, which is again a consequence to a large extent of the way we intervened during the COVID crisis, where we created huge excess liquidity, on which we are now paying 3.5%. So sometimes we say pigs fly these days. But that will also change, and it's already changing. What we are seeing is that NPLs are slowly increasing, not everywhere in Europe. That's now where you see the differences between countries. In some countries they are coming down, in some countries they have started to increase. When I talk to the bankers in some countries, they are convinced that they will continue to increase in the next couple of years. That's what they hear from their clients. Others are much more relaxed about it. But I think that overall, in a short run, bar the unexpected shocks, which you never know, when will they come? The banking system is in a very solid position. But of course, I fully agree. We have to stay vigilant. We always say that as supervisors. That's nothing. That's a mantra.
It's a mantra.
No? And look at all the risks. Some of the risks are definitely also connected with the geopolitical situation, with political developments. And these kind of things are very difficult to predict. You can't put them in the model. But you know that at some point they might create significant risks. Let me stop there.
Thank you. You know, the good thing in moderating a session is you just have the role to raise the stupid questions. You don't have to answer them. So one stupid question would be, you talked about NPLs and different developments of NPLs in different countries and for different also credit institutions. So I never knew if I would be more complacent and confident if NPLs in such a situation would go up or go down, because you never know if there's really a difference and NPLs are better in one region than in the other, or if there are just different standards in evaluating NPLs. So just a short question, a short stupid question on that. So do you think there are fundamentally different developments in the regions, or might there also be, and it will be of course the question to Livio after that, are there different standards perhaps as well?
Well, in the SSM, we should have all same standards. That's the first thing. I'm not saying that we do always, but we should have. And then the other thing, and that is the continuation of your question, is whether we have same standards in coverage ratios of the NPLs when they are detected. And you see that there is I would say there's more difference in the coverage ratios than in the NPLs themselves in terms of how they are defined. And you know, there has been also, maybe Livio can say more about the attempt of the ECB to work on the coverage ratios on some types of the loans. But I think that's very important, that we make sure that, of course, we have a standardized approach in Europe, but then also a standardized approach on the coverage ratios.
Thank you for taking the nasty question, and I think it's good to proceed to Livio. To be a little bit, let's say, warming up for this morning and to be on the point. I think your job is sometimes one of the worst jobs in the SSM and in the ECB, because every time you wake up, you will have to recall a bunch of different macro-pro regulations in every SSM country. And as Boris pointed out, the standards for NPLs and the micro-pro standards are quite standardized, and there is a lot of effort at least to enforce consistency. For macro-pro, there is not such a harmonization within the EU and the SSM. So what's your assessment of the general situation? And perhaps you could elaborate a little bit on the fragmentation of the macro-pro landscape.
So thanks, Gottfried. And first of all, thanks a lot for the invite. It's always a pleasure to be in Vienna, and this is a great discussion. So on macro-pro in general, I would say, so we all know that the situation in Europe is quite kind of, I could say balkanized, but at least not fully harmonized. So we know that countries take different measures. So what we observe is that there is an increased convergence of what countries do. So they tend to build up buffers. So even though the specific measure may be different, but the tendencies are similar. So there is a lot of convergence. I mean, all SSM countries have some type of borrower-based measure. So there is no single country has no borrower-based measure. And also many countries now have either the systemic buffer or the CCYB activated. I think there are 8 countries with positive CCYB, which is also, it's already a good number. Some of these countries are also large ones. So I would say there is a certain convergence. But of course, there is also from a kind of institutional point of view, you have different authorities. So each country has a different macroprudential authority. And as you know, the ECB has top-up powers on some, not on all, but on some of the measures. There is always the question of should the ECB exercise this top-up power or not, or is it more like working through moral suasion, before this is kind of activated? So we always have the discussion internally as well. One important point that I want to emphasize is also that now the view on macroprudential policy is a bit changing. So especially I'm referring in particular to the CCYB. So at the beginning, I think it was considered more a counter-cyclical tool. So you have to assess the risk and you increase the CCYB when the risks are higher. And this is, I myself, wrote papers many years ago with this view of the CCYB. But I think now, and Boris was referring to the COVID experience, so we know that release is very difficult. The release also, not only because you need a lot in a crisis, as Boris was saying, but also, so we know now that it also overlaps with other requirements. So when you loosen capital ratios, say in a crisis, you have to consider also the leverage ratio. Now for large banks, you also consider MREL. So all these things kind of overlap. And so we know, and we have done research on this, that in many countries it would be difficult to release capital buffers very quickly. And therefore, now the kind of increasingly the common view is to say, let's build up buffers in normal times, and then only when a crisis comes, we release the buffer. So it's not about counter-cyclical, but it's more about normal versus crisis time. So it's more kind of bimodal that you have this kind of. So given that now we are certainly not in a crisis, but on the contrary, in very normal, even buoyant conditions, the recommendation is always to countries to build up their macro buffers. Because the idea that you have to have as much as possible, so when a crisis comes, you have to release a lot, and there are a lot of constraints in that. That would be kind of a high level.
Can I add a little something?
Of course.
Now, I just wanted to say something about NPLs, and I think that in addition to what has been said, I think that we went through this last 4 or 5 years through a learning curve of understanding how to deal with NPLs. Banks did that. So I think that when we started to look at NPLs sometime, at the beginning also of the SSM, we were not aware of the tools that we had, and banks were not aware of how to identify and how to classify and how to deal with NPLs. And I think that has been very, very relevant. Today, even if we have to face an increase in the NPLs percentage within the Euro system, I think banks are a lot better equipped to deal with that. And I think this is very, very relevant, very important.
Mm-hmm. Very interesting issue both of you raised is how would market agents react in a crisis situation? So you raised the question if policymakers would really release buffers, if that's easy or not, and if the counter-cyclical idea would work. You talked about the harmonization of NPLs and the knowledge about NPLs. And I would be interested in your views, Livio, perhaps just one more intensive question on that. If the hypothesis is that agents would not, policymakers would not release counter-cyclical buffers at the right time, and releasing buffers is not easy, what about MDA triggers and automatic stabilizers as an alternative?
It's not that policymakers do not want to release buffers, it's more that it is difficult to do. And there are a lot of several reasons. So one is market pressure, obviously, but it's also, as I said, there is also a mechanical aspect that some of these ratios kind of overlap with other regulatory constraints, like just the leverage ratio. So either we make the leverage ratio also countercyclical, which we could discuss, or it's difficult. So we have to keep in mind that the capital release which was made during COVID crisis was really a one-off. So we will not be able to repeat it, that kind of release. And by the way, much of the release was microprudential, not macroprudential. I think like 75% of the release was microprudential. But again, the macroprudential release that we did we would not be able to do it again. So it was a one-off. So one has to look at things from this perspective. It's not really a question of automatic versus non-automatic. It's more a question of, do you have enough, in normal times that you can release in bad times? And I don't think we have tested this very much. I mean, fortunately, there's not been, as also Alessandra and Boris were saying, the financial stability situation has been quite good. So we were not tested yet, fortunately, but we have to see. So if you have another COVID episode, it's going to be very challenging, actually. So because again, cannot be repeated what we did.
Yeah, that's interesting. I would be interested in your take, all of you, on that issue. So to put it also in very, let's say, confrontational words concerning the policy fields, I think one of the hypotheses is that policymakers would not easily release, especially at the right time, macro buffers. At the same time, for the private agent, there might be some issues in diving into MDA triggers. There might also be some issues related to that. So if both instruments suffer from, let's say, timing issues and reluctance in using them, so how could we deal with improving resilience?
Well, in April, what we did has been to activate the systemic buffer in Italy, and we are, the achievement of the 1% target to be made gradually by banks by the end of 2025. And I mean, it's kind of early times to evaluate whether that's going to work, whether that's going to be effective as a measure. I think it's very premature with us, but I think it's a step in the right direction. And when you adopt this kind of measures in the financial sector, you have to assess very carefully the short-term costs and the longer term benefits, and I think that's something that requires a right balance that we'll be able to look at, in the near future. I think that these buffers will help. The Italian banking system is enjoying a good, a very stable time. There is a period of very generous banks' profitability. So all of this, I think, can go together towards an assessment that will, contributes to the financial stability in our country. But time will tell. And as my colleagues were just saying, whether there's going to be a new COVID or whatever, a new shock of that, a Europe and worldwide shock, will that be enough, to face all this?
We've now been talking a lot about classical fields of risk to financial market stability. We talked about NPLs, credit risk. We talked about, implicitly at least, about market risk and everything like that. Boris, I would be interested in your views. Usually crises come from areas where we do not expect the main core of the risk. So we're talking about non-banks, near banks. We're talking about other fields like ESG, sustainability. How important are those fields of risk in your views?
Well, we think they are becoming more and more important. Some of them, I would say, maybe are also kind of traditional set of risks which are just less predictable and difficult to deal with because they are less predictable. But some are like a climate change, something that is in the making, which is also extremely difficult to predict. We've seen the cyclone Boris. Quite difficult to predict, and we will have probably increasing number of this type of events in the future. We know that they will have costs. Banks are exposed to more risks. That's quite clear, I think, and you see it, for example, through the insurance companies already. Prices of insurance have went up. Prices of reinsurance have went up. You even have the prices of insurance going up because of the EVs, because the introduction of the EVs increases that. So you have all kinds of new risks that happen either because of the technology, either because of the climate change, but are more difficult to model, to put in our usual models that we have to assess the risks. Then you have geopolitical risks, which I mentioned already, which can work in many ways. They can create the situation in which it's not like a COVID, but very relatively quickly the economic situation deteriorates to the extent that you have quite rapid increase in the NPLs. I can think of different scenarios where that can happen. Or they can work in a way that through the electoral process in democratic societies, you get governments which increase the sovereign risk. And sovereign markets have been very complacent about the sovereign risk recently, as we know, but that might not stay forever. Now you might have, for example, geopolitical developments that could quickly change that. And then you have the technology that is changing. So we've seen how quickly you can now withdraw the deposits at the blasting speed in the case of the American banks. And we have to try to deal with all that. It's not that we can perfectly deal with all these risks, but at least we have to take them into account in our regulation and try to think in advance what possible answers or reactions could be in the case of materialization of some of these risks.
That's a lot of risks to deal with. And so, Livio, I would be interested, what's the core way forward to deal with that? Because, you know, in a perfect world, the economists in ourselves would say there is some, let's say, optimal level of capital within the banking system. It's certainly not zero, and it's certainly not 100%, because then you won't have any financial intermediation anymore, and it would not be efficient. So where should we go? And to be honest, the discussion on financial market stability improvement and macropru is always related with other topics, such as the micropru, for example. Yeah, so there is a long ongoing discussion on if we increase macropru measures, should there be a compensation by reducing the headroom for micropru, which we have within the SSM. So do you see a need for increasing the capital stance overall? So what's the way to go?
Okay, that's the hottest question. So I could speak half an hour about this, but I will be brief. So first of all, the one thing I wanted to mention is that, you know, you asked about risks. I think we know now that we are very bad in kind of predicting which risk will hit. So we know, and there is an American scientist called Philip Tetlock who has done this work systematically. And so what he finds is that, you know, if you ask experts, you know, what's going to be the biggest risk in the next 12 months, you know, they always miss it. And for example, I can say that we didn't see, for example, the turmoil in the US and Switzerland, we didn't see it coming. So, I mean, I can mention no ECB document where, you know, before, you know, the turmoil, we were saying, you know, this is going to happen in the US, you know, for these banks. So it's very hard to predict which risk. So what is much better is to have a resilient system that then shocks will come and you can react rapidly and you have a resilient system. So predicting the risk so we try to do it, but it's a bit of a kind of almost impossible task. So on the capital ratio, so what we know is that, you know, there are differences in, you know, not only between Europe and, say, the US or UK and so on, but also within Europe about, you know, for example, you know, how banks are valued by the stock market. You know, people look at these price-to-book ratios, for example. And also within Europe, we have a lot of difference. For example, in Italy, the price-to-book ratio is above 1.
Yeah.
You know, in Germany is less than 0.5. So, so you have these differences, but, you know, the capital regulation is the same. So that already tells you that that's not the only element that matters, of course. You know, so and also we know there is a lot of empirical work that, at least within the ranges we consider, of course, you know, you are right that capital ratio could not be 100, no, but at least with, you know, in the neighborhood of the range we are considering, increasing capital buffers does not kind of hamper lending or growth and so on. So there's a lot of empirical work on this, and actually we are trying to update that work as well. So in that sense, you know, this trade-off between capital ratios and growth and lending is a bit misleading. Again, so within this range, of course, I'm not saying that now we should move to 50% capital ratios, of course, no, but it's within the range we are considering, the evidence is not there. Last point, indeed, there could be overlaps between the macropru and the macropru instruments. I mean, there is a process called reconciliation, because the capital ratios can be increased in the so-called Pillar 2 guidance that comes from the stress test. But of course, you can argue this kind of Pillar 2 guidance also partly overlaps with the macroprudential capital buffers, for example, the CCYB. So, and banks are worried about that, but we always tell them that, and it is true, that there is a reconciliation process. So we try to not to double count the capital ratio. So there is a process that does this.
Boris, it seemed like for the overlap you would
Well,
something to add.
No, but I would also agree. I think the important thing that Livio stressed is, we cannot predict the risk well, but we have to have a resilient system. But a resilient system means that we do have enough of a releasable capital, that we have a good liquidity situation, but also then we have a good trustworthy deposit insurance.
Yeah.
I mean, I worked in my own country. We closed down. We basically reduced the number of banks by 2/3. When I came to the central bank, we had 60 credit institutions. Now we have 19, and we basically consolidated the banking system without having a banking crisis. Why? Because we had a good system of deposit insurance, resolution. So some resolutions were just shutdowns of the banks, liquidation. Some of them were mergers, etc. The last one we did with the Sberbank, very successfully. First within the SRB, so the first full case within the Single Resolution Board. And you have to have efficient role of the central bank as a lender of last resort in this kind of situations. So these are the things that we have to work on, all these 5, I would say, aspects to have a system that can withstand such shocks and resolve them relatively quickly. We saw, for example, in case of Swiss bank or the American banks, that not everything was working
Exactly.
perfectly. So these are the things to learn from and to improve what we have.
So I think you're stressing credibility issues as well, and the more credibility you have in the resilience of the system, the less is the risk that somebody would like to test it, of course. Coming back to resilience, and you mentioned the Swiss banks, I will resist the temptation to talk about German and Italian banks and current issues, of course. I will resist.
We won't comment.
So I'm sure, so I will resist. But I would like to talk about Swiss banks. Yeah. So for Swiss banks, what we saw was the setup of a really important GSIB institution. And my question is, again, complicated and a bad question. If banks continue to get bigger and bigger and bigger, yeah, so it's the old too big to fail issue, of course, yeah. So if they grow to GSIBs and get even more important, so what's the role of Macropru in such a world? Because let's say if we go to the extreme situations and the extreme concepts, if we just have 2 or 3 banks in Europe, yeah, I know that's completely stupid. Yeah? If we just have 2 or 3 banks in Europe, then we wouldn't need any Macropru, for example, because there wouldn't be any macro dimension which would be different, much different from the Micropru dimension. And in every crisis situation, you would also have to go to the specific institute and do something which is very, very huge. So, Alessandra, perhaps what's your take on that? So, is that increasing financial stability risk? What happened in Switzerland?
Well, I think so. And I don't want to comment on specifically on Credit Suisse. You know, there were issues there that the market knew and for a long period of time. But definitely what I was just saying about increasing the buffer in Italy is one of the measures, you know, that you can take in this kind of situations. But I want to go back to the idea that, you know, we were just talking about, we didn't see the risks about Credit Suisse and the American banks. I don't agree with that, actually. I think the risks were out there. And I think that particularly for the regional banks in the US, you know, when you see that kind of very light supervision, when you see the idea that banks can sort of like make a, you know, check, you know, boxes when it comes to their stress test. I think that it's a huge red flag, for supervisors around the world. I think that has been one of the main issues, the non-application of Basel III. That was one of the issues that should have put us on the alert, and I think that we did not, we didn't want to see that. So to be honest with you, I worked for a long time in the States. I know their banking system. That was a while ago. But I mean, the kind of prudential supervision that we are able to apply in the Eurosystem, it's second to anyone. And I think that is that's the direction, that is the right direction. More SSM integration, more harmonization, better knowledge, more interchange also between macro and micro. I think the ingredients are all there. And I think that we are in a very good position to work together in order to stabilize and to make our system really strong. We will talk about the newcomers, because all of this, it's a very nice scenario that doesn't take into consideration technology. We'll talk maybe about that later, because that's the newcomers are going to be big comers.
Mm-hmm. So at least in my experience, in my view, crises, both on the micro and the macro level, have always emerged, as you pointed out, by kind of switching of the expectations of the market participants. So I think your hypothesis was that it was not completely unexpected. So everybody knew about the weaknesses of the business model of some mid-sized US banks, the non-application of Basel principles, and so on. And if I look back at you mentioned Sberbank, for example, you mentioned the great financial crisis, you mentioned Credit Suisse, you mentioned the American banks. So in all of those cases, basically, I would agree there has been a problem, which everybody has been aware of for a long time, but then suddenly market sentiment switched from the going concern perspective to the gone concern perspective. And when that happened to the American banks, everybody tested the balance sheets of every SSM bank and every bank in the world, looking at some balance sheet issues, which would not pose a problem in the going concern perspective. So first of all, please feel free to oppose to my hypothesis that a switching of expectations might be an issue, and the switching from going to gone concern. And perhaps, Livio, as it's your business, main part of your business, how can we deal with that macro-pro policies should be capable and suitable in reducing or eliminating the risk of such switching of expectations? So how to be credible, as Boris pointed out?
So what I would say is that switching expectations is not always random. So I agree with Alessandra that there may be vulnerabilities. So if you so the earlier edition of bank runs, if you read Diamond Deep, the traditional model of bank runs, there is something that comes in from the sky, like a sunspot, and hits, suddenly people shift, and there is a sudden change of mind of depositors, and this kind of creates a bank run. So we know, I think the empirical literature is quite clear that there is always a reason. So in the Credit Suisse, for example, we knew that, of course, it had the governance problems. So it's always a bit of interplay. I would also say that there is always a triggering event which we cannot predict. So you have vulnerability. So it's interplay between vulnerability and then a triggering event, as you say, that shifts in an unpredictable way. So in that sense, and I don't think a macroprudential is really the tool to address that. It's more like, it's liquidity, is liquidity regulation, is access to central bank facilities. So this is key in these cases. I don't think a macro-pro is the key tool there. So
I think it's a combination.
I
think pretty much that's why we're saying, we have a number of tools that can be played together for in this kind of situations. And of course, if we go back to Silicon Valley Bank, I mean, that was a specific kind of market. These were people that were addressing and giving credit to startups, to, companies that were also enjoying, the rates, they were very low at the time. When the rates started to, to grow, I mean, that was a big issue. And then we can talk about bank runs and, how easy it is these days to get money out of banks. I mean, that's another issue which I think has to be addressed. And we talk about this in the SSM. It's quite a difficult issue from a technological also point of view.
So you wanted to add something?
No, I was just looking at it. There's a new NBR working paper, which I recommend for reading. It's called Failing Banks, huh? Just this month released. And it looks at the history of bank failures in the US from 1865 through 2023. Huh? And basically what they find out is what was my experience as a supervisor through my 20 years career is that bank runs can be rejected as a plausible cause of failure for most failures in the history of the US. And they say, look, banks that failed because they were bad banks, and you could have seen that before through the publicly available data in most of the cases, not every, but if you have bad banks, you can detect them much before the deposit run starts. Yeah. So it's a nice read. It's Correa, Luck, and Werner, September. So I recommend it for reading.
So I think that's fully in line with also the discussions and what the SSM communicated in recent months, that capital is not everything. Exactly. There is also a point in looking closely at governance, at business models especially.
Yeah, you had in the US, you had more of a problem of a business model. If somebody would come to me as a supervisor and I would ask them, what are you doing in the SVB? And they told me what they are doing. I would tell them, look, you're not a bank, you're a bond fund. Maybe you should re-register,
Yeah.
You don't belong here. And then, if I'm not wrong, Credit Suisse failed with a cost-income ratio of 112. 112 cost-income ratio. And then somebody says, I don't want to invest anymore in that bank, and they blame him for, well, why would you invest in a bank that has a cost-income ratio of 112? It's a money burner machine. So it's this kind of things should be seen in time. No?
Also, I wanted also to add that, of course, these measures, you don't see it necessarily in regulatory ratios. So, for example, Silicon Valley, I mean, you mentioned Basel III, but Silicon Valley Bank, actually, I think satisfied all, I'm not sure about the liquidity coverage ratio, but it satisfied almost all of the Basel requirements.
Nearly, yes.
So you don't see necessarily through and the same in Europe was true for Banco Popular. So Banco Popular was satisfying all the ratio and it still went down. So you need more detailed information than just the ratios.
Perhaps another issue to come back to the macro level as well, because I think we could talk a long time on the micro issues and if perhaps just sticking to the figures might be a sufficient condition for stability of a single institution, and I believe all of us agree that it's not a sufficient, but perhaps a necessary condition for being stable. But for the overall level, we mentioned, we talked a little bit about sovereign risk. And I think we should talk a little bit more on that, because public debt, sovereign risk, that's related in several ways to financial market stability. Though we have some separation principles in monetary policy and supervision and regulation on the one hand, fiscal policy and monetary policy on the other hand, but it's interrelated, because if there are geopolitical crises, if there are real economic crises, there is a tendency for policymakers to increase spending, that public finances deteriorate. That has a direct effect on financial markets, on lending and on the margins, the conditions of financial markets. At the same time, there might be spillovers to monetary policy as well. Yeah? On the other hand, monetary policy will have spillovers to interest rate environments and so on. I won't have to detail that. So how should we deal with that specific risk? Because history shows that real economy crises have been related in different sequences and orders with financial market crises as well. Livio, perhaps.
So your question is one of the interplay between the two?
Yeah, the interplay, and how should Macropru react on that? Or should Macropru react at all?
No, I would say so. It's not an instrument for cyclical stabilization. I think monetary and fiscal policy, are the right tools. Of course, I mean, also there is an interplay. So by the way, something that when we in DCB when we do the macroeconomic.
Sorry for interrupting. Yeah. I mean, an interplay might be that in times of crisis there might be. Take environmental crisis like right now in Austria and other countries in Europe. Yeah, there might be a call for relaxing regulation, for providing credit to the real economy, for example, for rebuilding the economy, yeah, and that might add up to increased risk in a riskier situation in the world. So, should Macropru react on those real world issues?
I would say if that threatens the stability of the banking system, yes, but only in that case, only if there is a kind of financial sector issue, not as a countercyclical tool in general. I mean, I was about to say that. So while we know how to measure monetary and fiscal policy more or less, I don't think we have good data on what is the stance on Macropru. It's very hard to. I always my colleagues, give me a summary measure on Macropru, and they are not able because. Partly because you have different measures that interplay. So you have these borrower-made measures, you have the capital measures, how do you summarize, different tools. But it's also, especially for the borrower-based measures, it also matters a lot, where the real distribution is. So if you have a loan-to-value ratio, it'd be a completely loose. So if all loan-to-values are lower than the limit, then the Macropru is not restrictive at all. On the other hand, it could be completely restrictive. So it could be that it completely set a cap to loan-to-values, for example. So you either have something that's completely binding or completely not binding. So it's very hard to measure. So if you ask a country, I don't know, if I ask Boris or Alessandra, what is the Macropru stance in your country? So I don't think you would be able to say with a number, no?
That's true.
So it's not easy to kind of use in this kind of quantitative way.
Yeah. Well, yeah, I agree on that. But on the sovereign bank nexus, it's there. It has not been in focus recently, but as I said, no, you never know when it's going to become something that people will pay more attention to and have a problem. But if you think about how to solve the issue, we did a lot of effort to try to solve it. Mm-hmm. Without success, as we all know. Of course, the exposure of the banks to the sovereigns decreased, but it decreased because the ECB increased its own. So it bought the exposure from the banks. As we offload during the QT, banks will again get more exposed to the sovereigns because they will be the ones to a large extent buying, and you already see that happening. Huh? But imagine you have true pan-European banks. Then, if you have a true pan-European banks, you would not have the sovereign bank nexus exposure because they would be exposed to many different types of risks, sovereign risks, not to one. As long as you have national banks, they are exposed to the national sovereign risk, and it's going to be very difficult to solve it without having a true European banking market, where banks operate everywhere and are exposed to different types of risks. I was just having breakfast with Steen, and he was telling me that they did a table in which they show that European banks, for taking outside of their national risk, do more out of the Eurozone than within the Eurozone. Mm. So they get exposed more out of the Eurozone than within the Eurozone. So that's a bit. So we have some problem there, talking about the banking union, which needs, and we have to think how to solve it to really create a common banking market.
So I think what you illustrated in that discussion on several topics was that expectations might be very important, and that stabilizing expectations and confidence is important. So I would try to do that. So just to make sure you're prepared, I would now want to go to the discussion with the audience, of course, because they're eager to discuss those issues with you as well. And 5 minutes before, or 7 minutes before we go to the break, I would ask you the final question then, not before the discussion, but at the end of the session. And the question will be, after what we have discussed now, what's your take on the main risks to macro financial stability? And what's your core remedies and your ideas on the core measures to take? Yeah, so, but I'll ask you that in approximately 20 minutes. And now I would love to give the floor to all of you after having discussed a lot of different topics from sovereign bank nexus and public debt risk to macro-prudential measures, borrower-based measures, and capital measures, and so on. So who wants to start first here in the audience, or do we have some raised hands in the virtual space? Okay, so let's start 1, 2, and 3.
Franz Nauschnick, formerly Austrian Central Bank. 2 questions. First question is regulations, Macroprudential. They are not very popular with the banking system. For example, here in Austria, we have a so-called KIM-Verordnung, which regulates that those who want credits must have some own capital and also affordability. And there is now political pressure to do away with this KIM-Verordnung, which was very well helped to help the resilience and addressing vulnerabilities in our banking system. Without the KIM-Verordnung, the risks we had in the commercial real estate market would have spilled over into other markets. Second question is sovereign. In Austria, we used to be part of a hard currency bloc, so we had very low interest rates. Now, because of, how should I say, very expansionary fiscal policy, our risk spread towards Germany has increased to 50 to 60 basis points. So our 10-year spread is now closer to Portugal than to the Netherlands. And in the election campaign, how should I say, all parties promise some goodies. Only one party promises tax increases, but these tax increases will not materialize because all the other parties are against these tax increases. So the fiscal situation will worsen a lot. So we could have 2 problems. Our really good regulation could go, and also our sovereign risk could increase.
Thank you. I would like to collect the questions. Perhaps we'll continue. Yeah.
Okay, thank you very much. Great discussion from all of you. I'm Andreas Haritou, professor at the University of Cyprus and member of the board of directors of the Central Bank of Cyprus. The question that I have is the following. It relates to the NPLs. You mentioned NPLs play a very important role in the banking system. And there are 2 issues that they relate to NPLs, prevention and management of NPLs. Do you believe that central banks and European Central Bank pay equal attention to both prevention and management, or they pay less attention to prevention? Because if we pay more attention to prevention, then we're going to have fewer problems. And what it comes to my mind is governance of financial institutions. We can have buffers, we can increase the buffers and stuff. When there is plenty liquidity in the financial system, we can increase the buffers as much as we can. But one of the problems that we're facing, and you mentioned that, is that all those risks, or some of those risks, like, the COVID, is like black swan. They are coming, once, every blue moon. And, to mitigate those kind of risks in the financial system, we have to set buffers which are going to be optimum in order to give the opportunity to release those funds for expanding, the economy. And the issue that I would like to raise is that, do we pay enough attention overall in the governance issues to mitigate risk, and especially NPLs? Thank you.
Thank you. And we have a third question.
Thank you. Good morning. Thank you for the discussion. Livio from MasterCard. Discussion so far has been very much about how the existing regulation works, how all the existing Basel apparatus works and is expected to work. Looking back to 2023, SVB bank run was 70 times faster than Washington Mutual in 2008. So the question is, are today's apparatus still sufficient for the future of bank runs, for the future of AI, for the future of new technologies? And how should we think about it preemptively in advance of that? Thank you.
So let's take a fourth question and then collect it.
Hello, everyone. Evgeny Skok, University of Liverpool, previously National Bank of Ukraine. So today we talk a lot about uncertainty and about modeling. And my question is, do central banks have appropriate modeling toolkit to model financial crisis nonlinearity attributed to the domino effect, what happened with the Silicon Valley? Because I'm working on this, and my new Keynesian model showed that many research missed nonlinearity in crisis. So I'm curious, on a practical side, if central bank models capture this nonlinearity. And another thing is that we touch a question about interrelation between monetary policy and macroprudential policy. And I'm curious if, when there is adjustment in the monetary policy rate, does central bankers take care about balance sheet's effect on banks? Of course, it doesn't make sense to consider this for all the banks separately, but in aggregate terms. How banks exposed to interest rate risk, especially during the monetary tightening cycle? Thank you.
Okay, thank you for that. We have one set of questions from the virtual space.
Actually, we have three questions. One is by Kristina Christova from Cargill. She would like to know what the strategy is in the face of overheating housing markets and mortgages, except central bank policy tightening and consumer credit markets. Another question is from Silviano Africana from the Bank of Namibia. He would like to know which policy, micro or macropru, is more suitable in addressing elevated non-performing loan ratios. And one more question from an OeNB colleague, Gottfried Gruber, regarding banks that have failed in the past. If everyone could see it coming, what were the obstacles to taking action on
Well.
Okay. So we could return that question, of course, to our colleagues and experts. Okay, I would suggest that all of the panelists will try to take the questions you feel comfortable to comment on, and then I will try to have the remaining part and to distribute, not to forget anything. I think we had one question or one set of questions on NPLs. It was the NPL question on prevention and management. And I think that will also be related to the question if macro or micro measures might be appropriate. So perhaps we can take that together. And for the modeling question, I would like to try and answer myself, being a model guy in my academic career. First of all, stress testing includes nonlinearity. Stress testing, at least in our models, includes also the effects of real economy, balance sheets on banking balance sheets, and so on. So that's included in the models. But in my experience, crisis comes from issues that cannot be modeled within the models. So I'm not very confident that models could predict financial crisis. Yeah, they could predict financial tension. But I would go, perhaps Alessandra, if you start.
I'll start with a friend from Cyprus. Now, listen, this issue of governance, it's really fundamental. And every time we're going into, banks that were in crisis, that was the first thing that came, clearly to our, understanding, was the poor governance, the lack of a real challenge within the board, the absence of specific skills, particularly in a changing environment like the one that we're seeing for banks. And that is related also to the way in which, these banks were able to put together preventing measures for the rise of NPLs. And even when the situation didn't give them too much space to do that, at least to have transparency in their dealing with NPLs. In Italy, in the last 5 years, we closed about 30 banks, all right? And I can tell you that every time we went in and every time we sent our commissioners to these banks, the first very thing was governance. So I'm totally there with you. I will take, if you don't mind, the question about, was that MasterCard? Yes. Mm-hmm. Look, in the last 4 years, we granted in Italy, and that is pretty much the trend all over Europe, out of 87 licenses, only 2 were banks, all right? Okay, so the licenses that we're granting, there are mainly payment institutions and other different kind of non-banking financial institutions. So the issue of how we cater for those risks, how we supervise these entities, it's clearly on the table of every single national bank, but mainly on the table of the SSM, because the move to platform of the offering of services make sure that the boundaries are not there anymore. The geographical boundaries do not work. We have a new, set of horizontal regulation coming in right now in Europe. It's very, very interesting. We are dealing with crypto. We're dealing with stable coins. We're working towards a digital euro. And we have, of course, a rise of technology towards payments. So that is where the big thing, the elephant in the room is how do you deal with those risks? We've been trying at SSM level. Clearly, there is a bit of a blanket that you pull it in every direction when it comes to prudential supervision. That does not work there. So we're all getting new skills. We're hired, data scientists to try and be a good regulators, and a good supervisor there. That is the future. The other issue is how much bigger the competitive scenario is going to be, because we're having not only your company, but we're having the big tech coming in, the third-party providers, which are extremely relevant right now as banks are trying to make their digital journey. It's very hard for them. They have a legacy that comes from, behind many, many years of trying to update their IT systems that do not work anymore. Today, we have the advent of AI, generative AI. We have the advent of, the choices about clouds, They are also extremely interesting from a geopolitical, point of view. So we don't get bored in our jobs. I mean, this is, the next wave of issues that we need to face. Now, I will stop here. If there's anything else, I will chip in.
Thank you. Great. So, Boris, would you like to continue?
Well, I didn't have a paper, so to remember all the questions. First one was for you, I think. Then I skipped that one. But let me also try to get into some which are. One is I fully agree with Alessandra on governance. It's same experience I have. You send people to the bank. If there are governance problems, it's always governance problems that create problems in the bank. Almost always. Sometimes there is something coming from the sky, and they had a very good governance, solid bank, but very rarely. It's typically, bank has not been managed well. That's why it gets into a trouble. It's good, I think, that we had period before where banks had a lot of NPLs, and they've learned how to manage them. I can tell that from the Croatian experience. I'm sure that the banks are now much better in managing the NPLs than they were 15 years ago, because they went through the wave. We have the NPL servicers, which, I mean, there are different opinions about them, but they also worked smoothly, and we have one system that is now better than it used to be before. On the monetary policy and impact of monetary policy on the bank's balance sheets, well, we have a separation principle. We're not allowed to think about that when we make interest rate decisions. But it's not that we don't understand what's going on. We do understand, but there is a clear separation principle where we have to stick to the monetary policy mandate. But there's also another part of the central bank always that has to take into account the possible monetary policy decisions and their impact on the balance sheets of the banks, and try to understand what might happen, and then act preemptively to the extent that this is possible.
Mm-hmm. So, Livio, perhaps as I'm out of the competition concerning the application, feel free to answer whatever you like. But if you could drop a few words on the timing and it's including the popularity issue of certain measures, because if you want to prevent something, it means you have to impose some restrictions at a time where everything is fine. So I think it's most natural that the general public and policymakers feel that there is an unnecessary restriction. That's the curse of supervision on the macro and micro level. If everything is fine, everything you do might seem a little bit abundant or too ambitious and too restrictive. And if something goes wrong, then you did it too late and not enough. So how could we deal with that? And please feel free, of course, to answer everything else you would like.
Thanks. So first of all, I agree that the life of somebody who looks at financial stability is a hard life because you're going to be wrong in any case. So there is no scenario in which you are thanked afterwards.
And if you were successful, there's proof that you were doing the wrong because nothing happened.
Yeah, exactly. So I think by definition you fail, and you have to learn to live with it, and it's fine. So we are all healthy, and I just wanted to pick a couple of the questions. So on NPLs, the question was about prevention and looking forward. So we do have measures of kind of stage 2 and so on. So we have measures, forward-looking measures of NPLs. I think, by the way, Alessandra was a bit shy to mention this, but Italy, for example, had a spectacular decrease in NPLs. It was really incredible. It's also in a country where the civil justice is not as fast as in the world.
I didn't want to sound too nationalistic, but I am extremely proud of that.
Yeah. So it's not easy because, of course, it interplays with the civil justice, which is incredibly slow. And so I think the hope was also that through the reduction in NPLs, so the civil justice was also quickened. So there was also this kind of institutional aspect. But but NPLs is very important, and it remains a topic. The second point on the modeling toolkit, and I mean, you mentioned it already, and non-linearities and so on. So I think we do have the kind of the tools. So now, I mean, you can use Dynar, and you have all these kind of occasionally binding constraints. And so I don't think it's technically that difficult, but it's more that nonlinear models are very fragile. So you may be very right, but also spectacularly wrong. And so I'm still a bit of a fan of linear models because at least they give you more or less the direction right. While think of the line and think of something nonlinear which goes asymptotically. So of course, if you are wrong, you are very spectacularly wrong. So I'm not sure that nonlinear modeling is always the solution. Then perhaps the last. I will not say anything on quicker bank runs and so on because I think we have a session coming afterwards on that. So I'm assuming we discuss that there. Last point was there was a question about overheating housing markets. That was also a bit your question. So what should be, however, clear both for housing markets but also for climate, for example, is that we don't have a mandate to shape, say, the sector allocation or relative prices. So for example, in the area of climate, DCB has no mandate to, say, green the financial system or tilt. So the mandate is only prudential. So we need to kind of face the risks. And so it's only about the assessment of the risks stemming from either housing or for example, the in the climate area. And so, I mean, sometimes there is a divine coincidence, so the two go together, but not necessarily. So I don't think that, so we have the authority to say, decide what the right level of house prices is, is more an assessment of, if they are overheated, then there are risks for banks and households. So it's a bit slightly different, and sometimes there is a bit of confusion on those mandates.
And there are so many other things that shape the housing markets, rather than monetary policy, and often more important than the monetary policy itself.
Yeah, thank you very much. I think we talked about all the topics raised in the questions, perhaps a little bit less on the liquidity and bank run issues, but as Livio mentioned, there will be a session dealing especially with liquidity and bank runs, and I'm glad you will participate in that as well. So there will be room for discussion. So as I announced, very, very short, because we're just hitting the time limit for our session. The session was called Strengthening Resilience and Addressing Vulnerabilities. So please, as I announced, a few words by each of our panelists on what are the key vulnerabilities and what is the key to strengthening resilience in the future. I would start with you. Yes,
right.
Please.
Well, the one thing I didn't mention, but I think is very important, is that we need to monitor very closely the evolution of the bank's sovereignty nexus. I think that that's going to be very important going forward, and all the underlying channels. I think that it's not an easy task, but sovereign exposures can really generate a range of risks for banks, and the casualties should not be taken with appropriate consideration, because I think that the one good thing, though, is that the improvement in the bank's overall resilience probably makes the chance that a new financial crisis is not going to be too much weighting on the public finance. I think that's going to be probably one of the good things about the good job that we've been able to do in the last years.
Thank you. Boris, if you may continue.
No, now I want to start with again and go through everything. Basically, I would say we have to make sure that we have the supervision, which is good enough to address the governance issues first, to understand what kind of the business models are banking having, to understand whether they are sustainable or not, what kind of risks are banks taking or not, to understand those risks. Then we need to have a proper macro-proof. We said a lot about it. Make sure that to the extent possible you have the releasable capital at the time when you might need it, and contain risk building where you can, when you see that it's becoming risky for the bank's exposure, to have a good lender of last resort, to have a trustworthy deposit insurance system, and to have a good and functional resolution system. That's what we can do. And we have to, you have to have all of that in the end. Yeah.
So that's the outline for several follow-up sessions on all of the separate topics. Thank you very much. Livio.
No, thank you. So as I said before, kind of predicting risk is one of the hardest things to do, and we are not very good at it. So I'm sure if I say something and then in 1 year you check what I said, I'm going to be spectacularly wrong. So my personal opinion, but it's not ECB opinion, my personal opinion is that all the geopolitical risk is a bit overhyped. There may be aspects. I mean, I'm a bit worried about the fiscal for sure, but all these things are more geopolitical is a bit overhyped. And by the way, there is this geopolitical index by Caldara Jacobiello, and if you read the index, it's not particularly high right now. So I don't think that it's obvious that we are living in more geopolitical kind of risky times than normal. I mean, commercial real estate remains an issue. It's not only the issue that there are further declines in price, but it's also the issue that many institutions have not recognized the losses already, so they are not mark to market. That is something that is quite worrying. And more generally, I also worry about a bit the regulatory cycle. So now there is a lot of push towards like going down with regulation. Part of the reason is that we took too long to finalize the Basel III. The Basel III was a result of the global financial crisis. Now they're over 15 years, and people have forgotten. I mean, people trading on the market are young, so many of them have not seen the global financial crisis.
Exactly.
And now, of course, everybody's questioning this, but it's because we took too long. I'm a bit worried that there will be this cycle, then there is a push towards more lenient, but then there is another crisis, and then we go into this trap again. So that's also what I'm worried about.
Thank you very much. I think that's an interesting thought at the end of that session, that people acting on financial markets have gained experience in a very, very unusual period of time since the great financial crisis, concerning interest rate levels, concerning regulation levels, and the crisis we had to observe. So thanks a lot to all of you for taking the effort to be here. I think it was a very interesting discussion. I learned a lot. I hope you enjoyed the discussion as well. We will now continue with a coffee break, and I would ask you to reconvene here at 11 a.m. for the next session. Thank you and enjoy.
Thanks a lot.
Thank you.
Okay, so let's continue with this second session, which is dealing with containing financial crises and digital bank runs. My name is Markus Schwaiger. I'm from the Austrian Central Bank, where I'm working in the financial stability department. Actually, financial crises seem to have a calendar effect. There is a nice working paper out which demonstrates that the second half of the year is actually prone to experience financial crisis, and September seems to be a particularly exposed month. If we remember, Lehman Brothers happened in September, the bank run on Northern Rock happened in September, the sovereign debt crisis in the euro area in 2011 intensified in September. And in 1992, I think the UK exited the ERM also in September. So, but that shouldn't disturb us any further. We would like to focus on an instance that actually happened a bit more than 1 year ago in March 2023. We've already touched upon it in this first session. We have experienced during this time a couple of medium-sized US banks that ran into problems. And I think this episode has both very traditional lessons to teach us, in the sense that we have experienced an interest rate shock that then led to the problems we have seen. But it also has, I think, a number of new lessons to teach us, and they have to do with the fact that digital banking and the use of social media actually spilled quite some fuel into the fire. And we have already mentioned it in the first session. If we look at how the speed of deposit outflows has actually happened, I think Silicon Valley Bank lost almost more than 80% of their deposits in just 2 days. Signature Bank also lost more than 30% of their deposits in 2 days. First Republic Bank took a little bit more than 5 days to lose almost 60% of their deposits. So basically what happened in these banks took days for what other instances like Northern Rock, iSafe, took weeks. And we can even go beyond that. If we look at the use of trading algorithms and artificial intelligence in financial markets, we are down to the effects of crises happening within minutes or hours, if we look at the flash crashes or instances like that, rather than days before. Now that begs, of course, the question whether the very nature of deposits as a stable form of refinancing for banks has to be rethought, how we should actually deal with that in terms of both regulatory responses, in terms of also practical responses that central banks can offer, that market participants can offer. And I'm here to discuss this with a very distinguished panel, which I would like to introduce now, starting with two panelists that join us online. I hope they are both, yeah, they are. They are both online by now. I would like to start with you, Andrew. Andrew Metrick has gone up very early. Today. I think it's just after 5 o'clock in the States. So thank you for taking this effort. Andrew is the Janet Yellen Professor of Finance at Yale University, and he's also the director of the Yale program on financial stability, with whom we are co-organizing this event. So welcome, Andrew, and thank you for joining. Then we have Fernando Restoy, who joins me here physically. Fernando is chairing the Financial Stability Institute and has held, I think, as all of you know, a number of important positions. He's been deputy governor in the Bank of Spain. He also has been in executive positions with the Spanish Securities and Markets Commission. And last but not least, he's for quite some time also been a member of the supervisory board of the single supervisory mechanism. I think I can spare the introduction of Livio. His CV has not changed, so we would directly move on to Oliver. Oliver Wünsch is leading the financial services practice at Oliver Wyman in Switzerland. He has a very interesting CV in the sense that he's not only been active in the private sector, but has been very involved, especially during the great financial crisis, also in the Swiss administration. I would like to start with you, Oliver, and ask you what your take on digital bank runs is, and how the nature actually of deposits as a source of liquidity for banks has changed. Oliver, the floor is yours. I would think we have arranged for a roughly 10-minute intervention for each of you, and would then also allow enough space for questions both here in the room and online via WebEx.
So, thank you and good morning, everybody. Many thanks to the organizers and also to Max Vandel for inviting me to this important event. Unfortunately, I have not been able to make it physically to Vienna. Actually, right now I'm in Copenhagen, where we do a large banking crisis simulation with 8 Nordic Baltic countries and about 500 participants. So I carved an hour out of this to join this panel, and this only virtually. It's particularly sad that I've seen a lot of friends of mine are sitting either in the room at OeNB or online. It would have been great to meet you, but I think we can do this next time. So you gave me quite some concrete questions on the issue of digital bank runs, and in particular, you asked me about what do technological improvements, in particular in the retail banking space, have an effect, and also what is the relevance of large depositors and, in the end, social media. But let me start with the second point and start with the fact that it has actually not changed since the great financial crisis. It is that many banks have, if you look at the amount of deposits, they have large concentrations of deposits from institutional and corporate depositors. And it has always been the case that these depositors run first. They have very high cash balances often with the banks, well above the insured amount. There's also a lot of fluctuation because they do cash management with these bank accounts. They have, given the treasury strategies, that they have a very low margin for error. They run international cash pools, really need to be able to move liquidity around the world, because otherwise they might not be able to meet their obligations themselves. So as a consequence, what they have done is they have implemented very strict and continuous counterparty monitoring, in particular the larger corporates. They have today policies that mechanically require reduction of exposures once certain thresholds or triggers have been met. So for instance, they are monitoring CDS spreads of banks, they are monitoring ratings, they have their own analytics framework that is coming. And as soon as they see certain problems quantitatively popping up at the banks and certain triggers being met, they're actually forced by the policy to start moving. This is actually quite important because usually when you are experiencing some stress in the corporate sphere, the bankers start to work these clients, call them up, say, look, actually we are fine. We are also willing to pay a bit of a higher interest. Please keep the funds with us. But policies actually prevent them from agreeing to these kind of things. They have to move. Also, these kind of clients, they have several banking relationships domestically and abroad. They have a very good information network, and even they are sometimes tipped off. So often, not that seldomly, there are leaks, even including on the authority side, that makes these deposit moves. And the consequence is such clients run very early. So this we have observed during the great financial crisis, the euro crisis. We have observed it with Credit Suisse twice. So last year, but also when they were close to being indicted by the US authorities. And not a lot has changed here, except perhaps the perception that corporate deposits are not necessarily safe in a crisis scenario. So I think in 2008, we were in the situation that even corporates didn't necessarily believe in banking failures, but today, with all these experiences, but also with a BRD or FSB rules that explicitly provide for having uninsured and non-preferred deposits in the firing line, I think the awareness has increased, and this might have increased the run risk even more. Now, the interesting thing about these kind of runs is that they don't necessarily happen in the public, so you don't see this. It accumulates for several months. It's not something you see on the street. You see it obviously in the liquidity reporting. You see it in the balance sheets, but it's something that is not publicly that visible. Retail deposits behave a bit differently in the sense that usually you had this sign of people queuing up on the street, but this is not necessarily the case anymore. I think it still happens, but once people are queuing up in the street, it is already too late. You have a lot of technological improvements that, however, allow for retail depositors to withdraw funds more quickly. So first of all, I mean, even during the GFC, a lot of people didn't have e-banking, so they need to go to the bank branch. And that is not the case anymore. You can do this on e-banking or by the phone. And also the transfers took several days to complete. I think we are now in Switzerland we are down to a kind of a 1 hour settlement for normal transactions, not even talking about instant payments. 10, 15 years, it was much different. And this actually creates expectations on part of the client. So before you were able to submit your transfer, but it was clear it takes 2 or 3 days. And now banks were able to use this as a way to kind of delay transfers a bit, to massage the liquidity flows, to make sure that balances are kept at a certain level. This has essentially disappeared. If you enter the transaction, there is an expectation that the settlement is taking place within a very short time frame, and if it doesn't, it becomes very visible, and it's also an information that then goes into the market. Now, also what has changed is that in many countries, even smaller firms and consumers have more than one banking relationship. And this is even the case in countries where you have the typical universal banking system. For instance, in Switzerland, a lot of people during the great financial crisis opened up accounts with several banks. They still have them. So meaning if they want to move money within the country, it can still be done because they don't need to get onboarded at another bank. And you have in many countries neobanks popping up that allow for a digital onboarding experience. However, I mean, with many banks, the digital onboarding experience is only digital at the front. There's still manual processes in the back, so it might still take a lot of, time to get then finally the account approved. This is especially the case for the larger or the more traditional banks that have not completely digitized yet. There's one thing, however, that changed to the detriment of depositors, especially retail depositors. today it is very difficult to open up a bank account in another country. So it was, even in Europe, it was much easier for some years ago, where you could, whatever, as a Swiss, go over to France or to Austria to open up a bank account. Banks would normally take you. This is not possible in that scale anymore because there are compliance concerns, KYC concerns, compliance costs that prevent this from happening. And therefore, it is more difficult to move money out of the country. So this is important when we talk about a systemic crisis where several banks in the country might be facing problems at the same time. You might be able to move the money about the banking system in the country, but you can't get it out except if you go to the ATM and really get cash, which is obviously difficult as soon as we talk about certain sums. So one of the consequences might be that perhaps people get even more cautious. And when we talk about protective measures in the banking system, it might be necessary to have protective measures not only for a certain bank, but for an entire system. And if we look at the crisis that we had in Cyprus and Crises, it's exactly what happened. Let me close my intervention with talking about social media, which is one thing that you asked me to talk about. So social media, when we hear politicians or the European Commission talk about social media, I think they are mostly concerned over misinformation, as they call it, so kind of information that might create panic or negative sentiment, although being false. I would say social media, from what we need to be concerned about, is mostly that today information spreads much more quickly. So if you look at the typical retail investor, people are to a certain extent, or have been to a certain extent, oblivious what's happening in the banking system. So first of all, many people don't understand banking in the first place. Information was traveling very slowly and only within certain groups of the society or the business sphere. And so a lot of people got confronted with, say, trouble in the banking sector on a very short notice because they haven't really taken care. And then because of the friction that we talked about earlier, it was essentially too late to move the money out. This kind of friction has disappeared. Tools like Twitter allow for information to circulate first between perhaps informed professionals or media people to the broader public. You can't really hold information back anymore. So I think one of the things that we have with social media is people are better informed, and that information about trouble with a bank or with the banking sector is traveling much more quickly and much more broadly. And of course, then people start acting. And the other opportunity or challenge that we have is that if there are problems with withdrawing funds, that this information also travels very quickly. So you see the margin for error has substantially slimmed down, and that is something that we need to take care of. Now, you were asking about the consequence. And I think we want to summarize a bit is that certain frictions in the sense of information, travel of information, being able to execute transactions quickly, these kind of frictions slowed down or perhaps even prevented certain depositors from moving. And technology has removed these frictions and has also raised expectations. And I would say this is actually a good thing. Financial markets are about efficiency. Our entire economy is about efficiency. And we should not rely on outdated frictions to keep our system stable. Now, what can we do as regulators or supervisors? I think it is important that we diversify and extend the maturity of the funding base. So a lot of banks, especially during the low interest rate period, were essentially funded by sight deposits. I think we need to get to a point where the funding profile is much more stretched, so people are contractually not able to take the money out. Of course, you cannot prevent it happening at all, but you can stretch it. And I think these kind of, say, private contractual frictions, this is something that is accepted because it's also remunerated. If you have whatever, a half a year deposit, 6 months deposit, it is remunerated higher than a sight deposit, so you get something for that risk, and people can make conscious decisions. What you, however, should not do, in my view, is to introduce artificial frictions, because I would say that the population, the counterparties of the banks, are not willing to cope with these kind of artificial frictions. They will see this as trying to rig the system against them. And this is something that undermines the trust in the banking system, not only in the crisis scenario, but also going forward. And if we look at all the challenges that banks are facing today in their business model, if you look at the valuations that banks have, for instance, in Europe, the increase of importance of private credit, the competition that is coming from CBDCs and so on, we should not do anything that makes this financial system or the banking system look kind of rigged against the counterparties, because it is only creating another competitive disadvantage. And let me perhaps close with one point, bring this issue home again. I think if you have a sight deposit, or if you have a deposit that is due, it is your contractual right to get the money out. So any protective measures that prevent these withdrawals need to be very targeted, can only be done in a, say, really crisis scenario where you are also having a plan how to get out of this. And again, we should make sure that we kind of diversify and extend the funding profile of the banks going forward, which comes at a cost to the banks, but otherwise we should not rely on artificial frictions to stabilize the situation. Let me stop here.
Thank you, Oliver. Now this looks like very much a new normal, in the sense that the world has moved on. Digital banking has transformed people's expectations and also the speed of execution in terms of moving money around. Livio, where do you see the role of central banks in all of this? Can they solve kind of the corollaries that result from this new normal by, through using ELA, through perhaps applying macroprudential policies? And how does, Oliver has mentioned it, how do CBDCs fit into this picture?
No, thank you. And first of all, I hope you're not bored by my voice now that I was also a member of the other panel. So there is a number of issues here. So the first thing is that, so far, at least in the euro area, we don't have a lot of evidence that really, deposit outflows are quicker. Of course, this may come in the future, so it's plausible, and we have to be prepared. But I was just saying that the evidence is not, there is no evidence, and so we have, because we have looked at it, and so we have been using supervisory data on deposits for all euro area significant banks, and so first of all, once you look into this data, there are a lot of statistical breaks, reclassifications, and so on. So things that look like large outflows when you just look at the raw data, if you actually look carefully, most of these are more like statistical breaks. So you have to clean the statistical breaks, and then so once you do that, there doesn't seem to be much evidence that we have speedier outflows or runs in Europe. We even looked at what happens in the period just before, say, a bank resolution or a bank failure. And even in those times, it doesn't seem to be the case that it is not always the case that there are large outflows. So sometimes there are, sometimes there aren't. There were some outflows probably before Banco Popular, but in that case, and also in other cases, including Credit Suisse, by the way, so there were outflows, but these were not the central concern. So the central concern was market financing, so repos and so on. So just not to overdo with the deposit, volatility. It's not yet, such a macro relevant phenomenon. Having said that, of course, yes, we have this concern. And there is a separate discussion on central bank inclusive, which is what you asked about. And so there are discussions about, the role of, liquidity ratios as in the Basel framework, but also, rapid intervention by central banks, things like preposition of collateral and so on. So also that one, I mean, in Europe, it doesn't seem to be a big concern. So so what happened in the US, essentially could not happen to the same extent in Europe because we do have kind of preposition collateral. We have in general higher recourse to central bank facilities. I think the US is also working in the direction. They are doing fire drills and so they are increasing the operational preparedness a lot as well. One thing we have to be aware, of course, is that in extreme cases this will not work. If the scale of the run is the same as Silicon Valley Bank, there is probably no central bank facility that can plug, tens of billions in a matter of hours. So, so there are limitations to what you can do in very extreme cases. So it would be better to prevent those extreme cases from happening. And final point I want to make. So I agree that it's not a great idea to put frictions artificially. And by the way, I think you mentioned also the compliance. Sometimes are also strange. So just to give a practical example, in my home country, I cannot open a joint bank account with a resident. So within the banking union, so if I open a joint bank account with an Italian citizen, I'm automatically considered to be a money launderer. So these kind of things are kind of, so they undermine the trust in the banking system. It should better be avoided. At the same time, I personally believe that, establish some nudges, so some obstacles that are easily overcome, might be part of the solution. They're not the most of the solution, I agree, but they could be part of the solution. For example, my own bank, for example, has a payment limit to what you can pay online. And if you want to pay more than that, you have to send some kind of signed document. I don't find it that unreasonable to do that as a way to stop, the panic and so on. So it's, but again, so if it was impossible, to withdraw more than a limit, then I would agree that it would undermine completely the trust in the banking system and the nature of deposits. But some middle way nudges, I still believe could be part of the solution. So we need to look at the kind of overall spectrum of measures. I don't think there is a silver bullet measure that solves the problem entirely. But again, so just let me conclude again with the positive message. So far, we don't see a lot of signs in Europe of that happening. So we have to be prepared, but not panic right now.
Okay, and on CBDCs?
CBDC, sorry. Yeah, so CBDC is, so as you know, the ECB is in the so-called preparation phase to introduce a digital euro. One of the concerns is, of course, about leading to disintermediation of the banking system in both normal and crisis times. So we are now in the process of setting holding limits. By the way, it's not even clear legally who sets the holding limits on digital euro, so there is a separate discussion on that. But so part of the discussion on holding limits is also what happens in crisis time. So the function of the holding limit is both not to lead to too much disintermediation in longer time, but is also to prevent large inflows into digital euro in crisis times. So it has both this dimension. So the same tool serves both purposes. But we need to keep in mind that this, of course, can also happen with physical cash. So whatever happens with digital euro is exactly the same when people withdraw cash. So if you and in principle there are no limits to withdrawing cash. So so it's not fundamentally different from that. So it's not a new problem. So it's part of the nature of deposits that are convertible into central bank money. So the digital euro doesn't fundamentally change that.
That sounds very reasonable, especially what you've said about these holding limits playing an important role in how the digital euro will actually affect the commercial banking system. Now, Andrew, turning to you, out of the last panel, I took away that as continental Europeans and taking part in the SSM, we seem to be very proud that the March 23 events did not spill over to Europe. And this has different justifications also in the regulatory field. What is your take on the difference between US banks and European banks? How did this actually play out? Why didn't we see this spillover? And are some of the reasons that we are perhaps proud of because we didn't see this spillover, are some of the reasons, the very reasons why we still do see, at least in some countries, rather depressed market values of banks when we compare them to their US peers? I think we can't hear you.
How about now?
Great.
Great, thank you. So thanks very much for that for including us in this conference. The Yale Program on Financial Stability is delighted to be participating in this. Several of my colleagues are in the room, made the trip all the way to Vienna. I am, as was mentioned in the beginning, early in the morning here, still in the United States, but eager to participate. So my angle on this that I've been asked to address is this difference between Europe and the United States along this overall theme of digital bank runs. And indeed, there were some very big differences in March 2023. To put a little in context first, I think perhaps because we got a little lucky in the United States after March 2023, and because the response was so forceful and effective, people's memory of what happened there and thoughts of what happened is that it maybe wasn't that big of a deal. It really was a big deal, and we were kind of lucky. It's probably the case that during the run-up in interest rates, we lost approximately half of our banking capital around that time. So if you can look at the various different estimates, there's a lot of interest rate risk on the balance sheets of US banks. First approximation, perhaps we had 10% bank capital going into in early 2022, and that was down to about 5% by early 2023. So that's a very serious drop. And given that interest rates had gone up as much as they had, by historical standards, you usually expect to see some hit to credit losses as well. In fact, the best estimates that I've seen suggest a 100 basis point increase in the policy rate leads over the next 8 quarters to about 100 basis points loss in bank capital. And so if you go up by 500 basis points, maybe you expect over the next 8 quarters to go down by 500 basis points. And if you only started with 5%, because you cut your 10% in half, you would have a banking system in deep, deep trouble. And I think that was the concern when we stood in spring 2023, was that inflation would stay stubborn so that the Fed needed to keep interest rates high, and we did not get back any of those mark-to-market losses. But at the same time, we had started to see some credit losses. So we were lucky. That recession, which I think at the time forecasters thought was 2/3 chance of happening, did not materialize. And it seems that inflation, while stubborn, is finally going to allow the Fed to drop interest rates. So we shouldn't be too happy here that we dodged this bullet. I think a chunk of that was luck. So with that introduction, then, what are the differences, Europe and the United States, and what should we be thinking about? And there's two. I want to separate onto each side of the balance sheet: the liquidity side and on the liabilities, and the asset side. On the liquidity side, it is absolutely true, and my colleague Greg Feldberg, who I think is sitting out in the room somewhere, did some excellent work on this right after what happened in Silicon Valley Bank. On the liquidity side, because in the United States we do not apply the Basel standards except to the largest banks, we ended up with much more. If Silicon Valley Bank had just had those standards applied to them, it would have helped a little bit. As Livio mentions, nothing is going to help all of your deposits flowing out that next day, but we would have had a little more attention paid to it early on. Furthermore, as Livio mentions, we have, unfortunately, a much clunkier emergency lending system over here than in Europe. There's historical reasons for this. There's we have a relatively old central bank compared to the ECB, and our old central bank has a old for us in the United States, but even old relative to the ECB, a long history of creating stigma and of not really being sure of itself in whether it wants banks to borrow from the discount window. And that's part of the reason we haven't set it up to be aggressive and to pre-position collateral in the way that that Europe has. That I hope will change a little bit, but certainly that was a difference going into what happened. I think the bigger difference is on the asset side of the balance sheet, and this is something else that has received a fair amount of attention. But on this point, I think that perhaps we may be drawing the wrong lessons, or a one-sided lesson from the differences between Europe and the United States. We, for a variety of reasons, allow much more interest rate risk on the balance sheet of banks. We don't test for it. It's not part of our stress testing framework. Our supervisors don't go looking for it and yell at banks and tell them not to have so much interest rate risk. In Europe, you do. And it is effective. There is significantly less interest rate risk, not just in the banking book, but in the securities portfolios of European banks, such that when interest rates went up significantly in 2022, the balance sheet losses were much less for European banks than they were for U.S. banks, and so more U.S. banks were in trouble. Now, the lesson that I think has been most publicly drawn from this is, well, we shouldn't do that in the United States. We shouldn't allow so much interest rate risk on the books of balance on bank balance sheets. I'm not sure that's the right lesson. I think that it's a choice. It's a policy choice that's been made in the United States that when interest rates go up, we more implicitly than explicitly believe that our banks have a natural hedge from their deposit franchise. That actually the best place for interest rate risk to sit is a place that has a natural hedge that they don't have to pay for. The deposit franchise tends to become more valuable when interest rates go up because deposits are sticky. And the interest rates on deposits don't go up quite as fast. Now, let's just start for the moment and imagine that that's true. Okay, so I'll come back at the end to whether it's no longer true. But let's imagine that's true and that banks have a natural hedge because of their deposit franchise. Then it would make some sense to leave this risk on bank balance sheets. Of course, when you get a movement that is big enough, as we did get big moves in interest rates in Europe and the United States, then the damage will occur on bank balance sheets. But the damage still occurs even if it's not on bank balance sheets. In Europe, the way we prevent having this risk on the balance sheet is to have more adjustable rate everything. To place more, when interest rates go up, more of this falls on the corporate sector and on the household sector. This is likely a reason why European monetary policy is a bit more effective than U.S. monetary policy, and why Europe has had slower growth than the United States since the interest rates started going up. So it's a bit of a pick your poison. Do you want to take the hit to banks, and if it's extreme enough, you run a risk of financial crisis? Or do you want to have more of that risk sitting on the balance sheets of the household and the corporate sector and have it have more effect on your economy? It's not an obvious choice. And what maybe makes things different, coming back to the digital side of things, is perhaps the deposit franchise is not as good a hedge as it used to be. This is not because money might move faster in a panic itself. That's one thing. But for structural reasons, and for many of the reasons that have already been discussed by Oliver and Livio, it could be that it's easier for people to move their money. People are more sophisticated. It's much more, the largest deposits are on the wholesale side, and they've gotten much faster and better at this. And if it is the case that a deposit franchise is no longer as valuable or as much of a hedge, then it could be that this choice made by the United States, which perhaps made some sense under that scenario, makes less sense today. Now, how this impacts bank valuations, bank valuations certainly, bank valuations are certainly driven in a significant way by the value of deposit franchises. And it could be that in the United States, those franchises have been more valuable, in part because banks have a much bigger incentive to stay sticky on the liability side of their balance sheet because it is their hedge. It is not just a source of value, but it's actually a hedge for them as compared to European banks. But I think the bigger effect, the bigger difference is really where the risk is sitting. And the fact that it is sitting on the corporate and household sectors in Europe means you have a different problem when interest rates go up than we have in the United States. I will stop there.
Thank you, Andrew. I would very much agree that this is a tricky question on who should actually bear interest rate risk. But my first impulse would actually be that the banking sector is better suited in terms of the skill set that is in the sector than the corporate or the household sectors are. But you have also touched upon regulation, and you've mentioned interest rate risk, and remembering, for example, that interest rate risk is one of the only major risk parts that are not cared for in the Pillar 1 of the Basel supervisory architecture. Fernando, what is your take on how this regulatory architecture should actually respond to the events that we have seen? Is it necessary to think about fine-tuning our system? Do we have to overhaul it completely in some aspects, or are we in the wrong direction anyway and should just think about what Andrew has mentioned as well, better supervising certain things that banks do?
Yeah, thank you very much, Markus. It's a very interesting conference. I'm very happy to participate in this panel. So I guess you are asking me whether, how could I project the very interesting ideas that the three other members of the panel have put forward, how we could project all this into policy action, right? You mentioned regulation, you mentioned supervision. Of course, we have to try to address them together, and also include issues like deposit insurance, as well as central banking actions in that regard. I think this is more or less, the different angles I would like to cover, because there are different aspects of financial sector policies. They may have a bearing, to have an impact on the issue that we are now discussing, right? So starting with regulation, right? So regulation, of course, liquidity requirements in particular, is an essential piece of the new regulatory framework. They have an important role to play in many different respects. It's important that somewhat the liquidity transformation business of the commercial banks is sufficiently controlled in order to prevent liquidity risks. It's important also that by asking banks to have sufficient liquid assets, basically we reduce somehow the probability of some procyclical behavior when they face in stress, as it may actually have systemic implications. And certainly it's important, these liquidity requirements, in order for authorities to have sufficient time to deal with the crisis or the stress of specific banks. But of course, the regulation as such has some limits. First, of course, by definition, regulation is a set of requirements that you basically impose across the board to all different banks. It's difficult actually to take into account specificities, the situation of concrete banks. Second, is clear that it's very difficult to take into account in regulation or all the different sources of liquidity stress, so that you always might necessarily leave something outside of the regulatory requirements. So in that regard, of course, you have to bear in mind there is a limit. The most important limit, of course, of liquidity requirements is the very fact that you can actually factor in sort of the liquidity needs in a specific adverse scenario, but most likely you don't want actually to have to ask the banks to have sufficient liquidity to cope with the type of bank runs that, for instance, we have observed in the case of the U.S. regional banks during the banking turmoil. I mean, SVB case has been mentioned, of course. It's important, actually, just to extract the right lessons from what happened there. Has been mentioned, SVB lost, like I think it was $42 billion in a single day, the collapse day. The day after it was expected actually to have an additional 100 billion actual withdrawal of deposits. I mean, 42 billion, I mean, the money they lost in a single day is roughly 24% or something of the mostly non-covered, non-deposit insurance protected deposits. It's 40%, 42% of the total deposit base of the institution. If you think about the scenario which is behind the calibration of the liquidity coverage ratio, you know, this 24% is more or less actually what is considered to be withdrawn in a whole month. So the liquidity coverage ratio, frankly, would have been great. It would have been applied in the US. Its SVB would have been subject to the Basel standards, but by definition, it would have not solved the problem. This we have to bear this in mind. That basically provides a good example of why regulation has some limits. You cannot actually sort of impose liquidity requirements having in mind the elimination of any possibility to have such a bank run. If you do that, of course, at the end you will kill basically liquidity transformation business of the banks. And it's true that you could actually end bank runs, you can actually stop bank runs, but also you will end the financial system altogether, the banking system altogether. So I don't think it's a good idea to try to avoid bank runs by just getting rid of banks. Probably you need to go for a different type of approach, right? Another element here is, of course, deposit insurance. I mean, of course, deposit insurance plays an important role when we talk about the prevention of destabilizing bank runs. Actually, it was born for that very reason in the mid-19th century in the United States. But again, you have to be careful when you discuss about the reasonable or the total amount of protection that the deposit insurance funds could actually provide. I mean, it's absolutely legitimate to think about possible adjustments, but it's clear that if you only go for a moderate type of adjustments, that is not going to solve much. We know that the non-covered deposits are typically concentrated in a few clients. So therefore, even if you increase in a significant way actually deposit coverage, typically most deposits will not be affected by that. But still, that will imply, of course, additional costs for the banking industry and for taxpayers eventually. If you go in the direction of, well, having a more ambitious reform of the deposit insurance scheme, even to go for full coverage or whatever, then of course that will raise standard objections in terms of moral hazard, in terms of this important and welcome distribution of resources between strong banks and weak banks, and also you will actually introduce important distortions in the allocation of resources within the whole, actually financial industry. So again, I don't think the deposit insurance actually by itself could actually be the most effective tool to address the issues that we have identified with the banking turmoil. So as you see, I'm a little bit skeptical about how much you can get out of regulation and enlargement of deposit insurance coverage. Again, I think that some fine-tuning, some regulatory requirements could indeed be helpful. There is some good work going on now at the level of the Basel Committee, looking at issues like the type of factors, the type of issues or elements which are factored in the calibration of the liquidity coverage ratio. There are issues about the treatment of interest rate in the banking book, also discussions about the treatment for the purpose of the liquidity coverage ratio of securities which are actually counted at amortized cost rather than at fair value. So there are some elements that we could actually discuss. This has been discussed. But again, I don't think there is a strong case for a huge regulatory overhaul as you suggested. And something similar could be said of the deposit insurance schemes. I'm more positive or more optimistic about the role of supervision. And you mentioned that, Markus. I think if you think about what has happened, it's clear that the liquidity stress was clearly linked to structural vulnerabilities of the banks themselves. Too much interest rate risk, for instance, as Andrew was stressing, but also poor governance, poor risk management, etc. So this is something that could only be addressed with good supervision, with intrusive supervision. And supervisors have the tools actually to address that. For instance, now I think there is a movement to try to improve stress testing techniques by supervisors, both at the individual institution level as well as the systemic level. I think it's important to understand these interconnections between the liquidity situation of different participants in the banking industry, with the idea of having a more comprehensive view about liquidity risk in the system. On the basis of those tools, I mean, supervisors should have the possibility actually to indeed address the vulnerabilities which are relevant. In principle, I think experience in many jurisdictions, not in all, is that moral suasion, even only moral suasion, just to identify the vulnerabilities, talk to the banks and require the banks actually to cope with those vulnerabilities, can do a good job. If not, you can escalate, and you should escalate. You can use a number of qualitative or quantitative actually actions. For instance, Pillar 2 liquidity add-ons, something which is not much used within the banking union now. It was used in Switzerland, particularly with Credit Suisse, but it was not enough. It's important to look at, I mean, you know, maybe to have a more intensive use of the liquidity add-ons, in which you could actually sort of identify specific liquidity needs in specific jurisdictions above the standard Pillar 1 type of requirements. And for sure, qualitative measures. If we are thinking about governance issues, risk management, possible unstable funding sources, whatever, business model issues, I mean, there are a number of qualitative measures that can be taken in that regard, and that can be really effective. So I think overall, it's true though, of course, that you really want to go in that direction, sort of to enhance supervision. You have to be mindful of the need to have three important elements. One is powers. Something has been identified over the crisis is that some authorities, in particular the Swiss regulator, did not have actually a full array of powers that you can observe in other jurisdictions, like in the European Union, for instance. It's about resources. It's extremely important. If you really want supervision, more supervision, you need actually more and better human resources. And very importantly, supervisory culture. I mean, you need supervisors to be brave enough to act early, even if this could trigger some litigation eventually. But supervisors should be ready to take up some risk, because otherwise they are never going to act in a timely way. That's important. If you go in that direction, I think that can make a difference. Finally, word on central banks, or already has been mentioned, different proposals out there. It's clear central banks have an important role to play, not least because they have actually a very important function, which is the lender as a last resort function. They are effectively the managers of the aggregate liquidity situation of the banking system. So they actually have to sort of look at their own tools that is used for the performance of this particular function. A big issue, of course, about collateral. It's clear that the main obstacle for liquidity support in many cases is the lack of eligible collateral that could actually be used in order to guarantee emergency loans from the central bank. But in principle, if you look at a standard balance sheet of a commercial bank, I mean, looking at the average in the banking union, I think you don't have more than 35–40% of what you could call runnable liabilities on uncovered deposits and short-term market funding. The balance sheet, you have plenty of space in principle to actually use the assets of the institution to collateralize emergency liquidity loans that could be used to address the withdrawal or even a significant part of those runnable liabilities. So there is much to be done in that regard, in how to better operationalize actually the lender as a last resort function, to better operationalize emergency liquidity assistance. Certainly it's important to put in place effective facilities, but also to make sure that the banks are ready to make use of them. And this is absolutely crucial, and you should play with a right combination of incentives, maybe eventually requirements for banks to be fully prepared, and then you should actually test that this is the case and with simulation exercises. Of course, in those jurisdictions in which there are issues to mobilize collateral in a smooth way, you should probably go beyond just this. And you should consider prepositioning, right? To ask banks to preposition sufficient amount of collateral. This is something that has now been discussed in different fora. Again, you can play with incentives and requirements. You can actually sort of link, for instance, scores to the availability of prepositioned collateral. You could actually even play with that when deciding on the contribution of the banks to the deposit insurance fund or to the single resolution fund or whatever. Or you can go beyond that and go for requirements, so basically to ask the banks to preposition collateral as a proportion, as a function of their runnable liabilities. And G30 report, CS Times here, makes a very interesting proposal, actually just to link require preposition collateral to the amount of runnable liabilities, including non-covered deposits and other short-term market funding. I think it's a good idea. Frankly, we hesitate very much to go beyond that in the direction of the so-called prone broker for all systems, the proposal by Mervyn King and Paul Tucker, that they will go as far as replacing almost all regulation, almost all supervision, and even deposit insurance by a requirement to the banks actually to limit the runnable liabilities, including all deposits, to the available amount of assets that could actually be used to collateralize emergency liquidity assistance after very conservative haircuts. That, once again, will actually kill the liquid transformation business of banks and will certainly damage and threaten the sustainability of commercial banks' business model. So, in sum, I think, indeed, there is a scope actually to adjust regulatory requirements. You could actually think about improving the function played by the deposit insurance fund, but I will actually devote specific resources to strengthen supervision and also to reflect about what is the best way to better operationalize actually lending in emergency situations by the central bank.
Thank you, Fernando. If I may add one question, because I think you made an interesting statement that it can't be the job of regulation to regulate banks out of business. Banking is ultimately about taking risks. Now that begs, of course, the question on the role of non-banks. Do you look at non-banks, for example, the fund industry as a source of diversification for systemic liquidity purposes, or are they just evading the strict rules the banking system has and exacerbate crises, as we, for example, have seen, by the way, when the COVID epidemic struck, when there was this kind of run on money market funds that actually caused some issues in the system?
Well, I understand it's related to what we are discussing, but it's a completely different matter, I think, right? I mean, NBFIs certainly play a role in many respects. So that, and this should not come as a surprise that as a result of the regulatory reform after the crisis, there is a larger role actually for non-bank financial institutions. Basically because part of the objectives of the reform was precisely actually just to provide these incentives for excessive risk-taking by the banks themselves. So it's good actually you have actually non-banks taking that risk, and now banks have more problems actually to take. So this is, I don't have actually a negative view about this, but of course it poses some challenges. You mentioned one of them, it's important, the sort of behavior by money market funds, that could exacerbate actually market movements. We all agree with that. There is some work by the Financial Stability Board in this particular domain. Also, securities regulators are looking at this very, very, very carefully. There are some controls there. Of course, money market fund is an animal which is different in different jurisdictions. It's not the same to have constant value money market funds than to have variable value money market funds. They are sort of the challenges posed are quite different, and therefore the policy actions cannot be the same, right? So this is something on which the international community has to work, and is already working on that. What happened, of course, last March is pretty much focuses on the banking system. as you said at the beginning, I think, right? I mean, it's clear that we have to revise, possibly in a significant way, our traditional assumption about the stickiness of deposits. And we have to revise that. On the basis of this, trying to adapt our policy framework to better cope with the new situation.
Thank you very much. Thanks all of you for this first contribution from your side. And I would like to take the opportunity and open up the floor to you here in the room. Perhaps we do one tour and collect questions here, and then we would actually turn to the virtual room and collect questions there. I think there's one question over here and one over here.
Thank you. My name is Wolfgang Pointner, Austrian Central Bank. Thanks a lot for your very insightful interventions. I think that Andrew Metrick and Fernando Restoy mentioned both the importance of the provision of liquidity by the central bank to banks in financial crisis. But we all know that it also necessary to avoid that good money thrown after bad money in this situation. So therefore, we would want the central bank to have a very clear picture on the viability and the soundness of the affected banks. And therefore, so my question is, do you think that central banks should have a very clear mandate for supervision of banks themselves? Or is this a task that could be outsourced to other institutions? And what's your view on that?
Thank you. There was another question here.
Thank you. Thank you for the discussion. Oh, sorry. Thank you for the discussion. Again, Elival from MasterCard. Coming back to the point about stickiness of depositors and also the deposit guarantee scheme, Fernando made a point about how to think about DGSs in the future. But comparing the European situation to the US situation, the Europeans tend to be spread around. DGSs are national, as we know. We don't have an EDIS in Europe, different from the FDIC in the US, which is very much well known to the citizens and to the depositors. Now the question is, in Europe, also financial literacy about DGSs is ever so changing across countries, to put it nicely. So there are some countries where the knowledge about the protection of the DGS is quite limited to barely existent. So is it also worthwhile considering discussing directly and improving directly the knowledge of the depositors on the protections they are bound to by the DGS? Or by doing so, we open the Pandora box and the stickiness that we want to include will evaporate? Thank you.
Any other questions? Yeah, there's one here and another one here.
Just two quick clarification questions. So first one about the stickiness of deposits in the USA. So I see that large banks they have a lot of market power and they can keep sticky deposits in the USA, but I tend to think that the regional smaller banks, they're more in competition between each other and fight for deposits, and they don't have so much market power to keep deposits so sticky as large banks. So just let me know if this is correct statement or wrong. And second question about the regulation of non-banking financial institutions. So each financial crisis comes from some new resource which is unpredictable, and there is a lot of risk in non-banking financial system, financial institutions. And a good example is a company which run trading platform, for example. And if this company faces problems with liquidity, it could put a lot of pressure on the rest of the market. And my clarification question is regulation of this non-banking financial institution should be stricter for all institutions, or it might be enough just to keep an eye on these important institutions? Thank you.
Thank you. There's one over here, and then Andreas Dombrit as well.
Hi, I'm Greg Feldberg from the Yale Financial Stability Program. I guess I'm having trouble wording this as a question, so let me just present my point. I guess what I told the students yesterday in our class that based on my research, if the liquidity coverage ratio had applied to Silicon Valley Bank 2 years before the bank failed, or if the interest rate risk in the banking book standard under Basel, which wasn't applied in the US, had applied 2 years before, the bank would have been forced by those rules, those regulations, to manage its assets and liabilities very differently. And I guess my point was nothing was going to save the bank in March of 2023. I mean, their goose was cooked already. But the LCR would have signaled a year earlier they needed $20 or $30 billion more of high-quality liquid assets, and that would have started a conversation that would have resulted in significantly more liquidity in March. So the failure wouldn't have happened in March. But it also would have led to conversations with the supervisors over maybe positioning collateral at the Fed instead of using the FHLBs, for example. And I guess the same part is the interest rate risk. 2.5 years before the bank failed, it would have failed the Basel standard, which wasn't applied in the US, and it would have been an outlier in the whole country, actually. So that would have required, at the very least, $2 billion of equity to be raised. But I think more importantly, that also would have started a conversation with the supervisors. So I guess my point is, doesn't regulation play a role in enabling supervisors to do their job?
Thank you. There's a question here.
Andreas Dombrüt, I'm a former banker and a former central banker. I have a small question, maybe for Oliver and Fernando, but whoever would like to answer it. There are quite some deposit brokers out there where banks who don't have funding can acquire deposits on a market, on a trading platform, and then get those deposits and enhance their ratings, etc., etc. And this is getting bigger and bigger, and a former colleague of mine is even the chairman of one of these largest platforms now, a former central banker. Now, is this stabilizing or destabilizing, and what would be the arguments in which direction, please? Thank you.
Thank you. And then there's one more question here.
My question is, isn't the main difference between the US and Europe Fannie Mae and Freddie Mac? Because housing finance is done mainly by Fannie Mae and Freddie Mac in the US, where it's done by banks in Europe.
Thank you. Now I would actually leave it up to you who wants to go first. Starting perhaps with you, Oliver.
Okay, let me try to take the answer or the question that Andreas addressed to me on the deposit brokers. So, I mean, in theory, you could say this is improving market efficiency, but one of the questions is that as you are running this deposit broker platform, and as you try to arrange deals between depositors and banks, all the factors that we have discussed before that would drive a decision for a depositor to choose a bank or not choose a bank will immediately apply the same way. So I would say that this kind of brokerage is not going to help banks that are running low on deposits because of concerns of counterparties would get more. There's one point where it perhaps could help. There might be depositors that are willing to take the risk in return for a substantial remuneration. And perhaps the platforms have the possibility to match these kinds of clients, but this comes as a significant cost to the bank. And just to put a number on the table here, when Credit Suisse was facing the wholesale run in the second half of 2022, they were paying institutional depositors up to 900 basis points for a sight deposit. So, I mean, even if you find somebody that gives you that money, the 900 basis points are going to ruin your margin in your P&L. So you have got quite a different problem. So we need to make sure that as banks are as banks are trying to find deposits in a stress situation, that they don't do so while at the same time jeopardizing their medium-term future. Because, I mean, if you have funding costs like that, it also reduces the ability for you to get more capital in to do a successful restructuring and so on. So we need to pick our poison. And that also confirms the point that Fernando was making earlier. I mean, we can't take liquidity risk out of the banking sector. And at the same time, one of the points that ELA or emergency liquidity has, that it is usually, although it comes with a penalty, it's much cheaper than what the banks would need to pay in the market. So that is something that needs to be considered. And here, really, the question is how much of these kind of risks is the central bank going to take? And it comes then also to the question on what is the eligibility in terms of collateral and so on. And we see these big decisions happening or discussions happening now. And in Switzerland, we even took the decision to accept essentially every collateral. So this so-called ELA plus that we did, which is essentially ELA minus, is taking everything that is on the balance sheet, including the chair of the CEO as collateral. And this can't necessarily be the solution, but we need to find the right equilibrium to this.
Okay, thank you. Livio, any question you would choose? I mean, I would be tempted to ask you the question on the role of central banks in supervision, but I would also accept if you decline to comment on that.
No, I mean, but there is nothing to hide. So first of all, in DCB we have a concept which is called counterparty framework. So essentially, the people who work in market operations, they need to assess if they can give credit to a kind of solvent institution, and this kind of procedure is called counterparty framework. They partly rely on the supervisors, but as you know, the supervisors are so we are in the same institution, but also separate by Chinese walls. I mean, I'm not sure how high these Chinese walls are, but we are a separate building, so there is some kind of separation, but of course it's not complete. Sometimes, I mean, just off the record, it also looks a bit artificial because, of course, that you interact with the with SSM colleagues, and so this separation is, so there is an element of artificial separation, but there is a real problem, which I agree that of course you need to be independent. So when in this counterparty framework, you need to make sure that the SSM does not internalize the concerns of the market operations, vice versa. So for example, you want the market operations people to take an independent decision and not be pressured. Suppose you have a situation where, by not giving credit to an institution, you precipitate the crisis of the institution. So you don't want the market operations department to internalize this financial stability concern. So you would like them to be independent and to take the decision based on their risk assessment. So it's not easy to break down this interaction. So it's a challenge. But I mean, so far in practice, I don't think there's been a big problem. But in theory, yes, it's an issue. I just wanted to briefly also mention this issue of. So what happens before? No? So of course, when you have a crisis, you have a timeline before. No, it's the same thing as when you observe human behavior. You always have to have what happened 1 hour before, until you were born. No, it's the same thing for banking crisis. So there is something that happens on the same day, but then you can go back in time, and of course, this is an important point that when you think about regulatory ratios and so on, it depends on how much back in time you go. I think there was a question here on that, so I agree with that. So because some people look at, what were the regulatory ratio 3 months before, but that's not always the right question. The right question is that what this was imposed 1 year before, 2 years before, and so on. So there is a timeline before the event. Then one has to reconstruct the whole history. And not like observe because of course you can say take Credit Suisse. The Credit Suisse respected all the Basel ratios. 1 or 2 months before the collapse. But of course you have a history of governance problems, and it goes back in time. So there is a timeline to be looked at.
Thank you. Andrew, there's been this issue, I think, which we have observed in the US of large versus small banks and the stickiness of deposits. Maybe you could comment on this question that we have had.
Thank you. That was actually the question I was planning to comment on. So well done. So the specific question was about regional banks and whether or not I would paraphrase it as saying, can their business models survive? If we know that right now I bank at Bank of America and they pay me 1 basis point, not just on my checking account, but on my savings account. And they laugh at me when I tell them, why don't you pay me a higher interest rate? So they clearly have some ability and have made me very sticky because I have everything set up with them, and I guess I know they won't fail. The regional banks historically have had a form of that stickiness, and that may be gone. Or people may be realizing that it is not quite what it was even 20 years ago. This relates to one of the questions that was raised about brokered deposits. We have in the United States brokered deposits. We also have a form of reciprocal deposits that go through various types of services, the most famous being IntraFi. IntraFi will take a very large deposit, most of which is uninsured, and break it up so that it goes to a large number of banks where it can be insured everywhere. When that happens, the bank that has given up the very large deposit is able to take back reciprocal deposits from other banks through the system. However, when that happens, it's usually the case that they're paying a much higher interest rate. And so if we think that part of what made deposit banking work historically was the fact that there was, if you're going to do maturity transformation and have long dated assets on your asset side and short-dated liabilities on your liability side, it really helps if those short-dated liabilities are in fact kind of sticky, so that the effective duration of them is longer. If that is going away, such that either you have to pay higher interest rate or people move, and that has something to do with these technological changes, we may really be seeing a non-regulatory reason that the structure of the system will change. Now, in the United States, our regional banks really have to compete with the big, huge banks. In Europe, you can have local champions and national champions that stay this size and retain some of their local monopoly power and stickiness. So it's a real question as to whether or not the United States system with so many banks can actually survive. We are unusual in that way. And some of that is historical from the fact that we used to make it very difficult for banks to branch. And it's probably the case that we're moving, well, it's certainly the case that over time we've been moving towards larger banks and towards the business models of the smaller banks being harmed. It's probably the case that this is going to continue despite the best efforts of the banking lobby.
Thank you. Now, this looks like large banks basically having a lot more deposit franchise also in the future than the smaller ones. Fernando, anything you would like to add?
Well, there are very interesting questions, frankly, right? And I cannot resist to say something about the role of central banks in supervision, because I happened to put together a book with Governor Holzmann not long ago precisely about these issues. So being here in Vienna, I have to say something about that, but something very brief. Of course, when the discussion about the function that should be assigned to a central bank, we always have to weigh two different considerations. The first one is in terms of conflicts, the conflicts of objectives, of interest, on the one side. On the other is the existence of synergies across different functions. Let me just say that experience shows that normally synergies are much, much more important than conflicts. So I probably is more a relatively pragmatic view about this, but certainly there is a very strong case actually for having central banks in charge of supervision that facilitates very much the solvency, liquidity assessment that you always require in the middle of a crisis, right? So I think this is very strong reasons for that, and I think the recent episodes actually show this. On the question about actually the role of regulation, whether I'm exaggerating what I'm saying that there is a limited role for regulation. I think there are two ways to answer your question. The first one is when you mention actually what would have happened if SVB would have been subject to the liquidity coverage ratio. Yes, indeed, you will have some more liquid assets, possibly that will have actually delayed the collapse of the institutions, but by how long? Maybe a day? So also because to take into account, in the case of SVB, of course they will not have satisfied the liquidity coverage ratio, but it's not that they have to do many loans or something. They have securities that did not qualify as high-quality liquid assets. So relatively not terrible modification, actually, of the nature of the instrument, the securities that they had in the balance sheet, they would have satisfied, actually, liquidity coverage ratio. But underlying liquidity situation might not have changed that dramatically, let me put it this way. That said, I fully agree with what you said about the role of regulation, and that with formal regulatory requirements being breached, it's clear that the role of supervisors is much easier in all respects. I cannot agree more with that particular statement. You put the example of the liquidity coverage ratio. I think it's more important, even more important, when you talk about this rule under the prudential regulation in the US, that was the one applied to SVB, that unrealized capital losses, while recognized in accounting equity, it was actually sort of forgotten in the case of regulatory requirements. So there was this prudential filter under which these unrealized capital losses would not affect actual regulatory capital. That would have triggered otherwise it would have been subject to Basel, and this prudential filter would not exist. That's clear. That should have triggered a more, definitive and effective dialogue with the supervisor. So your point on this sort of complementarity between regulation and supervision, I cannot agree more. It's extremely important, I think. My last point is in the question by Andreas. I think you put your finger in a very important issue here. Not all deposits are the same. Of course, there is some sort of granularity, some sort of tailored, treatment for the liquidity coverage ratio. We know that different deposits are subject to different tax assumptions in terms of withdrawal rates and all these things. But this particular dimension is not yet considered in the standard. It's something to look at, because you're right. The degree of stickiness of such deposits, obtaining the platform or something, may be really below the one you will actually sort of consider for more traditional deposits. I agree with that statement.
Thank you. I would perhaps also answer one question from my side, which was on this financial literacy, FDIC versus the European deposit insurance frameworks. I think one of the big differences is that the FDIC has a proven track record in the sense that it has intervened in literally hundreds of banks over the last years, and is therefore, I think, a system that is well known to function. And I think that is one of the key elements of trust. And coming from a country that has experienced over the last, I think, 5 or 6 years, 4 cases where deposit insurance had to step in, it was extremely important in all of these instances that these deposit insurance cases worked out quickly, that the deposit insurance funds were paid out in due time without delay. So I think a very important element is really, as we don't have these instances in Europe so many times, to prepare well, to do the operational stress testing and all the operational preparations over and over again in order to be prepared, because if you don't do this 1 or 2 instances in a timely way, what people actually expect, that's harming your reputations way more than anything else you could do. We have started 5 minutes late, so I take the liberty to actually take 2 or 3 questions also from the virtual room, and we would then finish off the session.
There are actually 2 questions in the chat. The first one is from Stefan Kavan of the OeNB. He would like to know the following. Would tighter collateral requirements necessarily create another issue, namely a stronger bank sovereign nexus via larger government bond holdings by banks? And what could be another quote-unquote collateral of last resort? And the second question is by André Dochia. There is a lot of focus on calculations, quantification, limits and scenarios when it comes to liquidity risk. Should we focus more on the capacity of banks to respond and manage an actual crisis, that is plans, communication, testing, where there is too little guidance and supervisory focus as of now? Let's not forget that the Silicon Valley Bank crisis was amplified by poor investor communication by the executives themselves.
Thank you. So on the bank sovereign nexus, anyone who would like to intervene?
Okay, so
Livio?
I can say one thing, so that perhaps there is a little bit of confusion on this. Normally the government bonds are already part of the HQLAs, which is the high, liquid assets, which go already in the liquidity coverage ratio. So in a sense, when we speak about pre-positioning and so on, so we have to be clear, we are speaking about positioning of illiquid collateral. And therefore, this is not government bonds. So at least when we discuss about liquidity coverage ratios versus pre-positioning, and we see them as alternatives, we are not speaking about government bonds. So in that sense, I don't see government bonds as being necessarily the core of the assets that would be in the pre-positioning, because the government bonds are already part of the HQLA. So they are not the main purpose of the pre-positioning in that sense. Although the concern in general is correct, but I don't think that it applies in particular to the pre-positioning discussion. So in that sense.
Okay, thank you. And then there's been this question of, I would say, operational or process-wise stress testing. So actually trying to run through all the processes, the communications that are needed whenever stress hits a bank. Anyone? Oliver?
I could perhaps offer 2 perspectives on this. So I think it's an utmost important issue. And this is, of course, because of technicalities that you already mentioned, but it's also putting authorities, and in particular banks, under a lot of, say, heavy workload. And what we often see is that authorities, but also banks, have their challenges from going to business as usual mode, where they do supervision on long timelines, where they have policy discussions that go for months, where they have very slow decision making with regular meeting schedule, etc., into a mode where they really need to take decisions under huge time pressure and high uncertainty. And that requires essentially an organization that is working on very long timelines to turn the way that they operate upside down. And that is something that needs to be trained. However, I would advise against kind of trying to prescript everything, because every crisis is different. So really it's about getting information channels in institutions that are able to work quickly, getting information channels between banks and the supervisor and the central bank, having data available, which is a huge effort, for instance, to, if you want to talk about providing collateral with ELA against illiquid collateral mortgages and so on, that the data pool is available. And so that's quite some effort. And I would say there are a few countries that have made quite some strides in that, but in many countries and also many banks it's lacking. Let me also mention the point that we're talking about the question between coordination of work between supervisor and the central bank. What we not usually say doing this globally is that every model can work in one way or the other, but you need to have a model that allows for, say, the different positioning of the authorities. Right? The supervisor might say, look, we just have the central bank provide liquidity and then we take time to work on the rest. Whereas the central bank will say, well, I'm having this escalating commitments game theory game going on. So the more I provide, the more I kind of slow down things on other sides, but also might be at the receiving end of trouble if then things don't pan out well. This is something, no matter whether you have it in the same institution or in different institutions, you are not able to necessarily get away. But what is important is that you at some point have a body, could be several institutions and their leaders, or also one person that is able to take a decision considering all the advantages and disadvantages. And this is something that often is lacking for good reasons, also because of independence and different objectives. But what this leads to is that decision-making is dragged out until the last moment. And one thing that we learned in banking crisis is that the earlier you start intervening, the more substance is there still on the balance sheet, the more leeway you have restructuring and so on. So we need to make sure that whatever model we are aiming for is not kind of delaying or giving an incentive for postponing decision-making. I think that is the main criteria. And if we have achieved that, I think there are several models that can work one way or the other.
Thank you. Let me conclude the session here. Thank you all for your very valuable insights. I think what at least I have taken away is that we are up to a new normal when it comes to the behavior of deposits, perhaps not as far-reaching as we might have thought, but still a different behavior that we need to adapt to, that all actors need to adapt to, be it central banks with their role as lenders of last resort, be it the banks themselves by managing interest rate risk, by also accepting more term deposits in that respect. There might be a role for fine-tuning regulation as well, though it seems that we as supervisors also have to accept our job and do what needs to be done, which will of course add to what Livio has said, making the ones that are responsible for financial stability even more happier than they already are.
Or less unhappy.
Or less unhappy. So I wish you a nice lunch. We will restart at 1:30 with, I think, a very interesting keynote address from Tobias Adrian, which I'm very much looking forward to. For those who are in the room, lunch is going to be served outside. And I would invite you to be back at 1:30. Thanks a lot and enjoy your lunch.
Thank you.
Okay, so good afternoon and welcome back to the room. My name is Hervé Joly. I'm the director of the Joint Vienna Institute, the JVI. As you know, the JVI is one of the co-organizers of this conference, and so I take this opportunity actually to thank the colleagues from OeNB, SUERF, and Yale University for the excellent collaboration on the preparation and the delivery of this event. As Governor Holzmann mentioned this morning, the JVI is a joint venture between Austria and the IMF, and we provide training on macroeconomic management issues and financial sector issues to government officials or public sector officials from countries in Central, Eastern, and Southeastern Europe, the Caucasus, and Central Asia. One of the courses that we have this week is actually on financial crisis management. It's a joint undertaking of the IMF, Yale University, and the JVI. And this conference is actually part of the program of this course, and the course participants are in this room, so I'm quite happy about that. But let's go back to the conference, and it's my great pleasure to introduce Tobias Adrian, who will give the keynote address on navigating through financial turbulences with preparedness, competence, and confidence. Tobias is the IMF's financial counselor and director of the Monetary and Capital Markets Department, also known as MCM. So in this capacity, Tobias leads the IMF's work on financial sector surveillance, monetary and macroprudential policies, digital money, financial regulation, bank resolution, debt management, capital markets, and climate finance. Prior to joining the IMF, Tobias was a senior vice president at the Federal Reserve Bank of New York. He has published extensively in economics and finance journals, and he has taught at Princeton University and York University. So I see not at Yale University. Huh? You need to invite him. So Tobias, I understand you're going to speak for about 30 minutes, and we'll try to keep a bit of time at the end of Tobias's talk for questions and answers with the room. So Tobias, the floor is yours. Thank you.
Thanks so much, Hervé, for the kind introduction, and thanks also for the Austrian National Bank and Yale University to co-organize this event with us. I'm very sorry I'm not there in person. This is a fantastic program, and it's always good to be in Vienna. So really sorry about that. And thanks so much for Governor Holzmann to come to this event earlier as well. I have had indeed the pleasure to visit Yale many times, so I do feel at home there, even though I was never formally affiliated with Yale. So let me talk about the theme of this conference, which is on navigating through financial turbulence with preparedness, competence, and confidence. Okay, so let me reiterate: preparedness, competence, and confidence. So all three things are important ingredients to manage financial crisis. We have heard from a number of panelists earlier today, some of the practical issues in terms of crisis preparedness. What I want to provide is sort of like our current assessment of the policy implications of the events from last year and how we see the policy agenda, but then also the operational agenda, i.e. the hands-on crisis management going forward. Of course, here at the IMF, we have a group of about 30 resolution experts that are helping countries around the world to deal with financial distress, primarily in the banking sector, but also in other parts of the financial system. The key issue that occurred last year, and that was already discussed in the previous panel, is the question how we can deal effectively with bank runs and bank failures. Excuse me, there will always be a certain amount of bank runs and bank failures. So policymakers have spent a lot of time creating mechanisms to contain the spillover of those failures to the broader economy. So those are the resolution regimes and liquidation regimes, and I will go deeper into that. And I will explain a little bit what we do at the IMF in working with our membership. So those are the 191 countries that are members of the IMF to make further progress in this critical area. Of course, last year, two countries were in focus, the United States and Switzerland. I would argue that the events from last year really have been the most significant test since the global financial crisis of 2008 in terms of understanding how far we have come in ending too big to fail. So how well have the reforms that were introduced on resolution been working? The key objective here was to end too big to fail, i.e. To remove the necessity of governments to provide unusual financial aid. So, of course, it's not often that policymakers get a field test that is sort of showing us how to deal with failing systemic banks including, of course, one globally systemic bank, but also a number of smaller banks that turned out being systemic. So the punchline of my remarks today is that the failures of Credit Suisse in Switzerland and SVB, Signature, and First Republic in the US show that while significant progress has been made, further progress is still required to deliver on the too big to bail reform agenda and to reduce the risk to taxpayers to bail out the shareholders and creditors when bank fails. So in our view, we have made progress. We've made very important and very first order progress, but we haven't fully converged yet. So on the one hand, the actions of the authorities, both in the US and in Switzerland, were very successful in avoiding a deeper financial turmoil. You could have imagined that in the absence of the strong and timely policy actions that were taken, one could have seen a broader fallout, both within Switzerland, within the US, but also across countries. We certainly saw a number of indicators of contagion to other banks. Significant losses were shared with the shareholders and some of the creditors of the failed banks. I think this is really extremely important to underline, right? So there was a significant amount of loss absorbing capacity, both in the US and in Switzerland, and that contained the cost to the taxpayer. However, and this is where there's work to be done, taxpayers were on the hook to some degree, in the US with an actual bill at the end, and in Switzerland with a large contingent exposure. And the support went well beyond ensuring the insured depositors only. Guarantees were given much more broadly. And when you think about the too big to fail agenda, this is really about removing this additional liability to taxpayers entirely, right? So there's some sort of like pre-agreed exposure of the taxpayer, which is through deposit insurance and indirectly through liquidity backstops by the central banks. But ideally, in a well-designed system, you don't want to see extra insurance on top of that. And in both cases, there were those extras. So let me explain, and let me then explain what can be done to come to better outcomes in the future. So in Switzerland, there was, of course, a massive creditor run, and the Credit Suisse acquisition was backed by a government guarantee and a liquidity facility by the Swiss National Bank. And the liquidity facility was of the magnitude of about a quarter of Swiss GDP, okay? So, the contingency wasn't drawn, but there was an emergency contingency liquidity facility that was put into place of the order of a quarter of Swiss GDP, right? So this is pretty significant. And there was also a credit guarantee. The public support was ultimately recovered. So this contingent support was never in the money, so to say. But of course, now we end up with an even larger institution, which could potentially generate even more contingent exposures to the Swiss taxpayer. And so really making sure that the system going forward is done in a way where any exposure to the taxpayer is contained seems extremely important. So just to put a number on that, UBS now has the largest ratio of assets to home country GDP of any individual GSIB in the world, right? So, it is really an extremely important policy priority to make sure that the resolution regime and the resolution powers are watertight. So the use of the standing resolution powers to transfer the ownership of Credit Suisse after bailing in shareholders and creditors, rather than relying on emergency legislation to effect the merger, would have fully wiped out the equity of Credit Suisse shareholders and limited the need for public support. So put differently, so the authorities, decided to trigger a merger between UBS and Credit Suisse that preserved some value to the shareholders of Credit Suisse, about $3 billion. And the AT1s were written down entirely, right? So there was loss of absorbing capacity, and the deal was completed very quickly. But there would have been an alternative way to go, which is to use the FSB's resolution framework that would have required to write down Credit Suisse's equity entirely. And then the merger could have been done in the resolution regime. So this is where some of the policy debate is. Arguably, it would have incurred less need for these additional guarantees. So what are the lessons? So I want to give you 6 lessons. And these are both from a domestic and an international perspective. So the first lesson, we think, is that the importance of intrusive supervision and early intervention was underlined in both the US and Credit Suisse, right? So Credit Suisse, had management challenges that was well publicized, in the news. It was well known in the financial industry to policymakers. Deposits had been drawn down over 2 years already from about 700 billion to about 500 billion as losses were accumulating, and the management and governance challenges were not so addressed very aggressively. And so supervisors were aware of that. In the US also, when you look at the Barr report, it's very clear that supervisors identified many of the issues that ultimately triggered the run. But in both the US and Switzerland, there was what we call supervisory hesitation. So there was a realization that there were problems, but there wasn't an aggressive action to get a commitment from the senior management to make the changes that are necessary to address the shortcomings, right? And I think this is one of the key lessons from the 2008 crisis, is that supervisors really want to engage with management to get commitments by management to make the changes that are necessary, right? So supervisors in both jurisdictions should have acted faster and in a more assertive and conclusive fashion. That is lesson number 1. Lesson number 2, of course, is that even small banks can prove systemic. We have known this all along. We have seen many times that systemic crisis can stem from a herd of small institutions. But of course, the post-2008 reform agenda very much focused on the importance of the GSIBs. And I think clearly there has to be a refocusing to do just as well with those small institutions that can be systemic because of the similarities in business models on both the asset and the liability side. So banking supervisors and resolution authorities should ensure that sufficient recovery and resolution planning takes place across the banking sector as a whole. Of course, this should include on a proportional basis banks that may not be systemic in all circumstances, but that could become systemic. You know, there are many facets to that. Happy to go deeper into those issues in the discussion. Thirdly, central banks should be prepared to provide extensive liquidity support during a crisis. Central bank operational preparedness in terms of discount window lending and understanding the magnitude of lending that may be necessary and being ready to do so at short notice at any point in time, right, is something that I think we sort of assume, of course, that is the case. But I think in both episodes, we saw some room for improvement. So who can access central bank lending? And you know, that's particularly important as some of the risks, some liquidity risks, have partially moved away from central bank counterparties. So you know, there's a related debate about like how much risk is in the banking book versus other parts of the book of major institutions, and to what extent can the central banks provide liquidity through regular facilities. You know, there is, of course, the danger that regulatory arbitrage is incentivized by having some sort of implicit commitment to provide liquidity to institutions broader than the banks. And these are extremely difficult trade-offs, right? I mean, you know, you often hear in policy discussions when market participants say that they assume that the central bank put is going to be there. And of course, central bankers don't want the central bank put beyond what is agreed with the commercial banks. But of course, in many countries, the commercial bank subsidiaries, say, of universal banks, or the commercial banks within the broader financial system, you know, are not the only part that is subject to liquidity transformation. So, you know, balancing sort of like insurance of the financial system as a whole while containing moral hazard is a very open policy debate right now. The other aspect that really came into focus on liquidity was the pre-positioning of collateral and the operational preparedness to actually lend against that collateral, right? And you know, that was even the case back in the Banco Popular case that came up earlier, right? I mean, Banco Popular, the actual resolution was triggered because they ran out of security collateral that was tied up at the ECB, and they couldn't lend against the loan book. So, you know, how operationally prepared are the banks and the central banks to borrow against securities, but also against the loan book? In the SVB case, of course, there were operational challenges even for securities, right? But we would think that you want to be ready at any point in time to borrow against both securities and the loan book. And we see a wide variance of practices among central banks, particularly on the loan book side. So pre-positioning is, of course, directly linked with the risk. When you think about sort of like the total balance sheet of the bank, you know, you have insured deposits, you have equity and convertible debt, and then you have in between that the uninsured deposits, and there is a wide variance how much uninsured there is that is neither covered by you know, equity or debt or by insured deposits. You know, does the bank have, you know, taking valuations and haircuts into account, so like enough liquidity to cover that part? I think that's a key question that both discount window staff and supervisors should look at closely. My point number 4 is that resolution plans and regimes need sufficient flexibility. So here I want to underline the Financial Stability Board's report that is entitled Lessons Learned from last year. it's a really good report, and we fully concur with all the conclusions there. And one of the key takeaways is to better operationalize a range of resolution options for different circumstances, right? So we see in some countries that there's sort of like a focus on plan A, but of course, in reality, you also need a plan B and a plan C and a plan D. And you may not like plan B and plan C and plan D as much, but you should think through all of them, right? We live in a complex world, and every crisis is different. So having a lot of flexibility and different ways to plan is really very first order. And again, the punchline is to protect the taxpayer from those liabilities. Authorities should make sure that they carefully balance rules versus discretion and have detailed planning as well as optionality in the design of the resolution regime. So, for example, for Credit Suisse, the event prompted us to think about what would be needed for the successful sale in resolution of some of those largest banking groups in some circumstances. When you think back of the Lehman weekend, the institutions that were sold there were not banking institutions, that were dealers. So Merrill Lynch, for example, was sold on that weekend to Bank of America, and the sale of Lehman to Barclays sort of, didn't go through, and hence we had the failure, and the rest is history. But really thinking through, so like the steps that need to be taken and what needs to be done in advance in order to get all of this done is key. For the US cases, for 2 out of 3, there was also an intermediate step of transfer to a bridge bank. And so, that of course is possible in some countries, but not in other countries. That really depends on the resolution framework. And having this bridge bank, of course, allows the resolution authority time to assess the situation and then to get bids in order to sell off either the whole entity or the entity in parts. So timely and high-profile reminders here that the transfer of power should really be core to the resolution toolkit and should be planned in advance. Number 5 of 6, cooperation and effective implementation of resolution powers across borders is imperative. We do hear that across many jurisdictions, there's a lot of resolution planning. There are the crisis management groups that meet very regularly, and we support that very, very strongly. And that includes both regulators and resolution authorities. The Swiss authorities worked intensely with international counterparts to prepare for the resolution of Credit Suisse. That needed supportive counterparts in the supervisory and resolution authorities in other countries. For Credit Suisse, primarily in the US, UK, and the European Union. For SVB, of course, there was an important UK subsidiary, which was also resolved and ultimately being sold to HSBC, I think for £1, if I remember right. And of course, the FSB report highlights that the UK relied on the deep relationships built over the years with the US counterparts to get this done very quickly and very smoothly. So I think here's really a good example for how early engagement and dialogue can lead to a very smooth outcome. Thinking back of Lehman, right? So if you don't plan enough in advance, you can end up in a situation where the authorities in the other countries may not be fully prepared to take the steps that are necessary. So that experience highlights how global financial stability depends on authorities being able to work together across borders and build in peacetime the routine contacts and good understanding, and conduct tabletop exercises and think through all these various options A, B, C, and D as opposed to just A, so that there is a good outcome to a range of possible situations. There was a wrinkle in this otherwise positive experiences, and that is also highlighted in the FSB's report on bank failures, which relates to the importance of US security markets, where most major foreign banks are issuing securities. So Credit Suisse and most other major banks, particularly European G-SIBs, issue debt securities in US dollar under New York law. And those securities, some of which can incur losses in resolution. As a result, there is an open question about how disclosure and how the security law applies in the event of a resolution that involves the bail-in of those securities. And in the US, under security law, basically converting those securities over a weekend is, very challenging, if not impossible, because, the securities are typically converted not down to zero, but are converted from debt to equity, right? It's bail-inable debt. But under the securities law, as far as I understand, that amounts to a reoffering of the security, and basically a prospectus with a full balance sheet and updated accounting numbers has to be offered, which of course is not possible to do over a weekend. So this is a key point of discussion right now. Point number 6 is that effective deposit insurance regimes are crucial when banks fail, creditors lose confidence, even before the balance sheet reflects the potential losses. You can see that when you compare the market value to the book value of the firms, right? Oftentimes the book value, meets regulatory requirements, but clearly the market value tells you that confidence is totally lost, right? So at that point, right, depositors are going to be on the alert. And as mentioned earlier already, new technologies such as 24/7 payments, mobile banking, and social media have accelerated the potential for deposit runs. And we really need to rethink deposit insurance within that context. So let me conclude. So at the IMF, we work actively with the membership to strengthen supervision, resolution, liquidity assistance, deposit insurance, and this international cooperation. So these are the 6 highlights that I mentioned. And we do this through 2 main tools. So tool number 1 is our financial sector assessment program. As a matter of fact, this year we are assessing Switzerland in terms of broader macro-financial stress, oversight, and resolution and liquidity assistance, as well as the euro area. The last time we were in Switzerland and the euro area was in 2019. The last time we were in the US was in 2020. So the US is going to come up in about a year. If you go back to those FSAPs from 2019 in Switzerland and 2020 in the US, and you look at the kind of recommendations on resolution, on emergency liquidity powers, on deposit insurance, they read pretty well in retrospect. So, it is always difficult, of course, for authorities to have the traction to push through these recommendations. But the FSAPs really aim to be a tool for regulatory authorities and for central banks to have some political backing to get the necessary reforms through. So the next FSAPs for Switzerland and the euro area are going to be published next year. and the FSB's findings will likely reiterate many of our previous findings as well, both in what was done last year and what the FSB is going to do forward. We also provide technical assistance to many countries. So we assess about 50 countries around the world are on the mandatory F subcycle. So these are all the major advanced economies with major financial systems, but also financial centers and major emerging markets. They are on the mandatory F subcycle. And then we cover additionally other countries that are voluntarily assessed. So we've covered about 150 countries since the start in 2000. So over 25 years, about 150 countries. And so it's very, very broad, so like assessment and support for the countries. So the bottom line is that progress has been made, but there are still areas where further improvements can be made and should be made. So let me stop here and turn back for the discussion.
Thank you very much, Tobias, for walking us through these 6 lessons that you've drawn from the 2023 events in the banking sector, and also what the IMF has to provide to its members in terms of support. So we're opening the floor for questions. I would just ask you, please introduce yourself when you ask the question and try to keep your question or your intervention relatively short. I think we have about 10-15 minutes with Tobias for that purpose. So who wants to ask a question in the room? Okay, it seems so far you've been so clear that nobody's raising any questions. Shall we turn to the... Oh, there is one. Sorry, Ernest.
Hi, Tobias. Thanks very much for your excellent presentation and your excellent overview. Now, I'm aware that twice a year you do the Global Financial Stability Review. So could you reveal to us, in fact, a few weeks ahead, what is in the kitchen right now? What are the key themes that you are concerned with for the next 1 or 2 years in terms of financial stability?
Thank you. Any other questions that we could take? Nope, I don't. Oh, there is another here. Thank you.
Mr. Tobias, thank you very much for your presentation. I am from Banking Supervision of Central Bank of Uzbekistan. My question is that we saw banking crisis last year, so should there be a single regulator for banking sector and the securities, the capital market, mega regulator, or should they be separate from each other? Thank you.
Thank you. So there is a third, and we'll end there for this first round. A third question is coming.
Thank you very much, Franz Nauschnig. My question is related to global imbalances. You didn't mention it, but recently global imbalances have increased quite a lot. So China relying on their exports to achieve their growth targets, and the imbalances with the US, but also with Europe, is increasing dramatically. So are you worried about global imbalances?
Thank you. So Tobias, the floor is yours.
Okay, thanks so much. So let me start in the order of the questions. First, with Ernest's questions about the GFSR messages. So as Ernest points out, we have the Global Financial Stability Report, which is our multilateral surveillance tool, published twice a year in April and in October. And that provides a global financial stability assessment. It also has some specific topics. So this time, there are 2 deeper chapters. One is on a policy approach on artificial intelligence in the financial sector. So how should we think about the policy challenges here? And the second one is a little bit more analytical, thinking about how to quantify macro financial downside risk. Let me start with that. So what is our current assessment of macro financial downside risk? And so basically what we are seeing is that the global baseline is one of a global soft landing. You know, there are some countries that are in a slight recession in Europe, but overall the global economy continues to grow, but is slowing in an orderly manner. And inflation is heading towards a target everywhere. So there's a global baseline, but then of course we spend a lot of time thinking about the risks around the baseline. And so when we look at our quantitative assessment of downside risks, that has improved somewhat in recent years. So about 2 years ago, after the Russian invasion of Ukraine, we did see an unusually high amount of downside risk. It was close to crisis levels, not quite there. Whereas now the metric of downside risk is back to sort of like median levels. So that is in the short term, over the next year or so. When we look over the next 2 to 3 years, we actually worry more, because what we see at the moment is that financial conditions are very accommodative, but of course that fuels the buildup of leverage and maturity transformation in the system as a whole. You know, some of that in the banks, but much of it outside the banks as well. So, you know, one particular area that has come into focus is the role of bank credit and liquidity lines to private credit markets. The private credit markets are growing. There's a lot of money flowing in. And so, you know, we had a chapter in April on sort of like thinking about private credit market risks. We think it's contained for the moment, but we need to watch closely how that evolves. I think, you know, a key message in October is that there is a tension between the ease of financial conditions and so like the market implied volatility, particularly for riskier markets such as equity markets or corporate bond markets. So you see implied vol of equities at very low levels by historical standards. You see credit spreads that are very tight. Yet when we look at global policy uncertainty, global economic uncertainty, that is actually at quite elevated levels. So there's a kind of tension in between policy uncertainty, geopolitical fragmentation, you know, political risk more broadly, and the market price of risk. And we think that is giving rise to potential for sharp readjustments of financial conditions in some circumstances. And we saw a little bit of that in August, around August 5th. You know, this is when the Bank of Japan tightened monetary policy and made statements that were perceived as somewhat hawkish. And then the payrolls on August 2nd, that was on August 1st, August 2nd, the payrolls came in below expectations. So there was sort of like a differential shift in the outlook for US versus Japanese rates. So there was a carry trade unwind. But then more importantly, there was also a massive risk-off event in equity markets, both in Japan and Nikkei. The Nikkei dropped 12%, was stopped out 3 times on Monday, August 5th. Okay, it hit the stop 3 times, and implied vol, you know, shot through the roof. The volatility skew, you know, went up extremely. So basically, out of the money put options got very expensive. And particularly in Japan, but also in the US. So intraday, the VIX shot to over 60 and settled at 38. So these are very high levels. Now, this episode dissipated very quickly, but you could imagine that there are other triggers that could generate more persistent impact. And, you know, really what we hear from market participants and policymakers around the world is that, you know, the degree of non-linearity that was in the system took people by surprise. So, you know, there's the baseline, everything looks fine, but then once you go outside of the baseline, there may be more non-linearity in terms of the pricing of risk than we appreciate. Let me stop here. I can go on and on, but I think that's a pretty good pitch. The question about supervision from Uzbekistan, should banking and security market regulators be unified? So we do see both models. In some countries, we do see both security and banking regulators under one hood. In other countries, we do not. There's not a clear systematic evidence that one is better than the other. Really what matters more are the powers of those institutions, the governance, the resourcing, the degree of independence. So there are many other aspects. It's a highly complex sort of apparatus, which we assess in the FSUPs, right? Our pillar 2 in FSUPs are the assessment of oversight, and we're benchmarking regulators against Basel core principles and IASCO, CPMI IASCO principles. And so it's really, you know, when you think about the Basel core principles, there are 29 aspects. Many of them are about the governance, about 5 or 6, I think, are about the governance and powers. And so it really is not so much about whether they are under the same hood, but more about, you know, what kind of powers and governance they have. Finally, in terms of global imbalances, of course, we do have a publication once a year that is looking at those global imbalances that comes out over the summer. You know, we are tracking that closely, and you know, it's a core mandate of the IMF. And you know, I would point you to the report. I don't want to go too much into details because it's a little bit far away from the resolution issues, but it's certainly a very important backdrop to these discussions.
Thank you, Tobias. I think we have time for one more question. There at the back of the room, please.
Stefan Kerber, Austrian Central Bank. Thank you very much for your 6 lessons. I think they are important for us going forward. You have raised the difficulties in the trade-off between discretion in resolution on the one hand, and on the other hand, clear ex-ante rules that guide resolution. I don't want that you get away with just mentioning this trade-off. I would like to be maybe have more precise guidance here. The United States has issued in spring 2024 lessons learned from the 2023 crisis, SVB, new guidelines in resolution. They say now the message is everything is now clear, everything is in place, there won't be any need for ad hoc changes. But it seems that even if there's a small space for discretion in resolution, this small space, when time comes, will be widened, will be broadened to city gates of its size, and will start at stage 0. So is this the case? Is this your view of the problem? And how can we address maybe this dynamic inconsistency in preferences?
You're muted, Tobias.
Sorry, I was muted. Yeah, thanks so much for this question. This is really the key around all the resolution discussions, right? So when you think back of the policy debates after the crisis, you know, the work at the FSB in particular, internationally, but also domestically in pretty much all countries around the world, you know, you want to sort of get to a point where institutions are resolvable without putting the taxpayer at risk beyond the agreed mechanisms, right? That is really the goal. So coming back to Credit Suisse and SVB, so I do think that the fact that there was much more capital and liquidity in the system made a first-order difference, right? I mean, the fact that the AT1s were there to be converted made a first-order difference, right? So in that sense, Credit Suisse is orders of magnitude better from a social point of view, from a broad macroeconomic point of view, than the resolutions in 2008. So I do think we have made a humongous amount of progress, but we can make further progress. And So, you know, one important point to note is that even though broadly advanced economies have used the FSB resolution framework to guide their national implementation, there are still significant differences in implementation across countries, right? So you mentioned the US in particular, and of course, in the US, there are two different types of resolution regimes, right? So for the G-SIBs, the largest institutions, you have a Dodd-Frank Title I and Title II. So Title I is basically normal bankruptcy. When that cannot be pursued, you can trigger Title II. And Title II in the US is a resolution regime for the most systemic institutions. And unlike what is the case in most other countries, it has, I think, 2 or 3 distinct levers that others don't have. So the first one I already mentioned is that they have the possibility to form a bridge bank. So basically, on that first weekend, you don't have to come on Monday with a new deal. You can go into a bridge bank and can use a couple of weeks or months to sort out how to restructure the institution. So basically, the management changes. There's a new holding company, but then you don't have to go to the market on that Sunday. You can work through the issues and then eventually go back to the market. So that is one significant difference relative to other countries. The second significant difference is that you know, there is the emergency liquidity, which is, you know, similar to other countries, but you do have within Title II the possibility of the credit support via bridge lending. And so what we see more and more is that liquidity in resolution, but also some amount of treasury support in resolution, i.e. one is liquidity, the other one is solvency report. You know, both of that is already built into the system, and that is not necessarily the case in other countries. In fact, in some countries, it's not possible at all. And then the third thing, which we saw importantly in the US, and this was applied not to these G-SIBs, but to the small institutions, is the systemic risk exemption, right? And I believe that the US is the only country that has this ability. I mean, of course, you know, on ad hoc fashion, you know, countries can always promise to make all depositors whole, but I think the US is the only country where that is predetermined in the law is something that can be done. And I would argue that that was crucial last year to contain the run risk. So, you know, to learn more, please do take a look at these FSAPs, you know, for example, for Switzerland, for Austria, for the Euro area. You know, we have extremely detailed assessments of liquidity in emergency situations, of resolution regimes. And, you know, we list all of the challenges and the recommendations. It's very, very deep, very rich, very technical, but really a good read if you want to get deeper into the issues. And when you compare, say, the US, the Euro area, and Switzerland, you see, you know, first order differences in terms of our recommendations because the implementation of the FSB regimes are so different across countries. Let me stop here.
Thank you very much, Tobias. So I'm afraid our time is up, but let's give Tobias a big round of applause. So thank you for being with us early in the morning for you, Tobias. And I think we're moving seamlessly to the next session, session 3. Thank you.
Yes, indeed. Let's move on to this session, which follows, I think, very nicely from what Tobias did in his keynote speech, really getting into the weeds a little bit on the resolution part. So this builds on the earlier sessions where we talked about deposit insurance, we talked about liquidity, we talked about what needed to be done ex ante to prevent crisis. But often we find ourselves nevertheless in a situation in which an institution has to be resolved, and there are many ways in which it can be done. But one important means that will be used is public capital and guarantees. So in this session, we're going to talk about the how and the not, and to some extent, of how to resolve those kind of questions when you're faced with. And for that, we have a very good panel. So I wanted to thank already, accent everybody. But before I start, I want to also thank, on behalf of Yale, where I am as an executive fellow, the other co-sponsors of this conference. I want to join Andrew Metrick in thanking the JVI, OeNB, as well as SUERF for allowing us an opportunity to be here with you on this important topic. So the specific topic is indeed this a balance sheet perspective on crisis intervention, injections as well as guarantees. The perspective is the balance sheet, so that's what you should keep in mind when we're going to be discussing this. We won't be talking about liquidity as much as we've done in the earlier sessions. We're not going to talk about NPLs at all, because there will be a next session in which it comes down to the resolution of the asset side of those banks that run into trouble for that reason. You can run into trouble for various reasons, of course. And like I said, we have a great panel here. The format is more or less going to be the same as we had in the earlier panel. The speakers will have 10 minutes. I'm going to give a little bit more time to the first speaker, because I will follow the sequence slightly different than it's in the program. We're going to do more or less a reverse alphabetical ordering of the people. So what we're going to be doing is first have June Ree, who's the director of the Master's Program in Management Studies at the Yale program. There's going to be a common element of some of the presenters. They all have a Harvard affiliation or a degree, but June has a JD from Harvard, but she also worked in the private sector. That will be followed by Jeremy Stein, who is on the screen for you now as well. Thank you for joining us early in the morning there as well. And he, of course, is at Harvard, but previously had been at the board, the Federal Reserve Board, as well as the National Economic Council, working on crisis management very close. The stress test was one of his, I think, contributions to the global financial stability paradigm. He will be followed then by Natasha Serene. Natasha, also JD, as well as a PhD from Harvard. She's currently at Yale, but she also has been at Wharton. And importantly, she was at the Treasury at some point, helping Janet Yellen and others on important issues. And last but not least, Andreas Rumbet. Andreas is a little bit of a free man today, but he still has an affiliation with Oliver Wyman. But previously, he was with, of course, with the Bundesbank and in the private sector in important positions. And he was a fellow member of the Basel Committee when I was at the BIS. So welcome to him as well.
And I'm with Columbia.
And you're with Columbia, sorry, your last affiliation.
Just to get it in.
Yeah. So with that as an introduction, I'm going to ask June to step up and give her a short introduction. It's a little bit more of where are we coming from when we say balance sheet interventions, to get the mechanics out of the way, and then we're going to pass to Jeremy, Natasha, and Andreas. So with that, June, you can do it from here. The slides, hopefully they will pull them up.
Is it easier if I do it from here, or?
It's up to you. Why don't you speak from there, and then you have the You have the clicker as well in front of you.
Okay, so this is the clicker. All right, so I'm gonna, as the first panelist, I'm gonna lay the land on and trying to explain, as Stein told everyone, to lay the land of where we're trying to come from. So give you a little bit of background. Yale Program on Financial Stability, we've been around, I think, a little over 10 years now, and our mission is basically to collect every single knowledge that's out there possible regarding financial crisis interventions. So we have recorded so far about 300 or more cases across the world during financial crisis, and what central banks and governments have been doing with the interventions responding to those crises. So the data that I'll be showing you a little bit today kind of shows the framework that we've been using to approach this recording of and research of different kinds of interventions. So this is the framework that we use, and it kind of fits in nicely with what we're trying to talk about during this panel today on the balance sheet approach. So different categories of interventions that a lot of the central banks and the governments generally use during the crisis, different combinations of it, but laying it out here on a balance sheet, and you can think of it as a balance sheet of the entire banking system or an individual bank or the financial system, depending on what you're trying to do at that time. But it shows you kind of what different interventions and what they're targeting on the balance sheet. And you can see we have, kind of more finer categories beneath each of the larger, broader categories on the balance sheet. And the distinctions are meaningful for us because what we specifically look for in these interventions is that, what is the policymaker's reasoning behind making certain decisions, design decisions. So not all capital injections are the same, depending on what you're trying to do and what institutions you are kind of focusing on and targeting, the designs differ. So that's why we have different categories under capital injections, ad hoc, which gears only kind of one institution or a handful of selected institutions versus broad-based capital injection, which gears more towards a broader kind of banking system, entire banking system. And similarly with the guarantees, although it's not an ad hoc versus broad-based categorization, we differentiate between what guarantees it's providing, what it's targeting on. So we have those categorizations. So each of these categories, I think at this point, we have a kind of a guidance document for each of these categories. And these are available kind of if you go through the Yale Program on Financial Stability website. There is a journal that we're associated with, and those are all published on there. We also have an online database that policymakers can go in for free and search for these things. If you're in a situation, you're responding to a crisis, you need a little information on what certain countries did and how they did it. We make it available to everyone. And then there's these two other categories, which don't fit in kind of perfectly into the balance sheet, but are relevant because there are interventions, a lot of interventions done in those categories, and they have implications in the bank balance sheet, but do not fit kind of squarely into it. So that's the framework that I'm giving. And then just because this panel's focusing on the guarantees and the capital injections, the background of where kind of my next couple of slides will be coming from are from these case studies that we have. So far we have about 36 broad-based capital injection and 23 ad hoc capital injection cases that we've done, and the period range is very wide. We're trying to reach as much as we can. And then with the bank guarantee programs, we have 23, 10 blanket guarantee programs, and 24 account guarantee programs, also spanning in a wide range of periods. So these are just the list of the kind of the documents that I told you about, where it gives you a broader guidance on how to do certain things. So on that, I'll dig a little bit deeper into the relationship between guarantees and capital injections, and hopefully that lays the land, and our other panelists can kind of go deeper into them. So specifically with the guarantees and capital injections, what we have found looking at a lot of these case studies, over 100 of them, is that combining them is probably a good idea. But then there is a caveat to that, is that I think Levin and Valencia's paper also acknowledges this, is that guarantees are usually only available to countries that are high income. We've seen in the case of Ireland where, just because you announce a blanket guarantee doesn't mean that you're going to save your financial system. You have to have a credibility backing the guarantee. So there are some, it happens to be announced together, or it happens to be where recapitalization and guarantees are together. It happens to be from a country that are more higher income, have more higher success rates. So, but even kind of considering that, if you look at the individual studies that we looked at, there are benefits to having those two together, and there are instances where the policymakers have specifically kind of really laid it out why we're doing this together, and I will go through those instances in a little bit. But intuitively thinking, yes, there are different facets of failures in the banking system, so you don't want to use just one tool, right? You want to use different tools, kind of targeting different parts of the balance sheet that I showed you. And then we have to think about the costs in doing all these interventions. You know, obviously, capital injection is pretty expensive, and versus a guarantee might be less so, you know, barring the fact that there might be real failures and you have to pay out. So all these kind of different factors that you have to think about when you're thinking about cost, and if you combine these different things, you might be able to reach an optimal point. So those are the kind of the broader reasons why we're thinking about capital injections and guarantees together. So this is more looking from the perspective of guarantees, right? So why do you just not want to do guarantees and kind of touch on recapitalization later? And I've listed it as kind of different separate categories, but the broader message is that guarantees kind of can be really good at stopping bleeding, right? Your financial system is in an acute phase of a crisis, and you really need to quickly stop the runs. It might be helpful. But then usually when you're in a financial crisis, you know, you don't just stop the run, you have to go and rebuild the financial system. And guarantees have limited effects on those things. So that's why if you want a longer recovery and an efficient recovery, then there is a valid point to combining the two. So these are different instances. The bank debt guarantee were the two examples that I list for the US and UK. They're more or less kind of forced by the authorities at the time. So those combinations, you know, you can kind of, I think we can say that they are less of an evidence of a complementary relationship, because there was a coordinated effort from the authorities that, you know, if you participate in the capital injection, you have to participate in the guarantees, and that was a condition. But also, if you look at the reasoning behind why they were doing this was, you know, there are different reasons, but they were also mindful of this, you know, making sure it's cost effective for the government. They were protecting themselves to a certain degree by providing both guarantees and capital injection at the same time. Account guarantee example, generally similar kind of vein of argument that they have, but also I point this one out, which is an interesting thing where I think the UBS, Switzerland during the GFC, and Dexia during the GFC, you know, those authorities were really focused on saving the larger banks. And then they used the account guarantees to ensure that the smaller banks are also covered in a way. So that the depositors were feeling confident that they were okay to remain in the smaller banks. And then the blanket guarantee, in a similar vein, you know, in order to sufficiently address the failing banking system, bank rehabilitation efforts, you really need to combine and ensure there's restructuring and recapitalization. So that's from the perspective more of the guarantees. And this is more from the perspective of recapitalization, why guarantees have been helpful. So the capital injections are, you know, it's a very efficient way of restructuring and rebuilding the bank, but also it's very politically and fiscally expensive, right? And it's a very upfront cost for the authorities. So, you know, in some, and especially in the US, it has been very, very unpopular. There has been a huge backlash afterwards. So what they try to do is try and combine it and minimize the cost for the authorities that might cost them just trying to do purely capital injection. So actually, the two examples I list here, the Germany and the Citibank, and to an extent for Bank of America, is more of kind of capital injection combined with liability guarantees and asset guarantees. And we differentiate liability guarantees and asset guarantees, where liability guarantees focus more on the liquidity side and stopping the runs, versus the asset guarantee side has been used specifically more for really being mindful of this cost. So, you're trying to inject capital, but in order to ensure that you're injecting the optimal amount of capital, you also do an asset guarantee where certain troubled assets, their value is guaranteed and it protects the asset side, so the calculation is more efficient for the authorities. So both instances where the authorities first didn't start out with, they only had the liability guarantees attached with the capital injection. And then later they came in with the asset guarantees. And it was very explicit in explaining why they were doing this. And especially in the US case, the market reaction was very strong. Just with the liability guarantees and the capital injection, the markets were still not convinced that they were confident enough in the Citibank and Bank of America. So then later, the authorities came in and said, okay, we're doing the asset guarantee. And then finally, the market kind of came around to it. But I think also there's also a stress test factor that also came in that really helped with the confidence. And I think Natasha's going to talk about that a little bit more. So that is the lay of the land, kind of where YPFS's research is kind of coming from in this, what recapitalization and guarantee relationship is and what the balance sheet approach is. And with that, I think I'll hand it over to others.
Thanks very much, June. I think that's a great start to get into the weeds. I think Jeremy will pick up on some of the complementary steps, so I'm going to pass it on to him from his experience and thinking. Jeremy, the floor is yours, the virtual floor.
Okay, well, thanks very much. Can you all hear me okay?
Yes.
Okay, so I know that this panel is meant to be about capital injections during financial crisis episodes, but I thought I'd take the liberty of kind of panning back a little bit and thinking about the role of capital conservation and capital rebuilding after adverse shocks to the banking system, even when we do not yet have a full-blown crisis of the sort seen during the global financial crisis in 08, 09. So let me start with just a very, very basic mechanical point, which is, suppose you have very robust capital requirements in the sense that capital is high enough that you don't really have to worry about banks failing or about imminent bank runs. Even so, even with sort of high-level capital requirements, if you don't have a good, robust mechanism for recapitalizing the banking system after a negative shock, you can nevertheless have real problems with credit crunches and macro consequences. So let me give you a concrete example. Suppose you have a bank with assets of 100. Suppose God comes down and tells you that you're never going to have losses of more than 7. So the worst case scenario is losses will be 7. Okay? So now you're very conservative as a regulator and you set a capital requirement of 10. Okay? So you're guaranteed that you're always going to have enough capital to absorb the losses. Depositors will never be put at risk. They should never, if they're rational, run. Okay? But now let's imagine that you get hit with a significant loss, a loss of 5. Okay? So it's within what you expected. Right? You're not going to have a bank run. You're not necessarily going to have a crisis. But if you still have a capital requirement of 10%, and you've lost half of your equity capital, your asset, and if the bank is unwilling to raise new equity or conserve capital by cutting dividends, cutting repurchases, they're going to have to shrink their assets by half. And that's a pretty powerful credit crunch mechanism. And if you have macroprudential concerns, that's something you need to be concerned about. So, the policy takeaway from this is that, high capital levels of the sort that we've seen kind of after the financial crisis, obviously a good thing and helpful, but by themselves are not enough to give you macro resilience to shocks. What you also need in addition is some kind of a mechanism to basically push banks to conserve capital, i.e. to cut dividends, to cut share repurchases, or to raise new equity when they've been hit by a negative shock, even if the solvency threat is not immediate or imminent. And of course, the problem is the banks themselves bank management acting in the interests of themselves and of shareholders are not going to be inclined to do this, to cut dividends or to raise new equity. Equity holders like dividends. If the bank is in some trouble, it'll benefit the equity holders at the expense of the creditors. Same thing about raising new equity. It's dilutive often to the equity holders. It's a good thing for creditors. It's a good thing from a macroprudential perspective, again, in terms of, strengthening the credit provision mechanism. So, here there's a kind of clear role for policy to do something or to try to accomplish something that the bank shareholders or bank management on their own are not going to want to do. And I think this was really one of the major, in retrospect, one of the major policy failures during the global financial crisis, which was you could see by mid-2007, the shape of the thing was starting to come into focus. It was clear. It was abundantly clear that banks were going to have very significant losses on subprime and related things. And yet from 2007 through Lehman Brothers, regulators in the US allowed banks to pay out to shareholders via dividends and repurchases over $100 billion. So that's a big number relative to bank capital. It's a big number relative to what was done eventually in the stress tests. And, sure, eventually, and this is sort of more the focus that June had, is, eventually we got to a full-blown panic crisis. When we got to that full-blown panic crisis, we had injections of government capital. We had the transactions account guarantee, all the kind of things that she talked about. And those were absolutely necessary, good, necessary, and helpful when they were done. But I guess the point I wanted to make is that there was a big missed opportunity earlier on before things got quite so bad. And as June said, using government balance sheet is expensive. It's expensive politically. It's expensive in terms of the risks it poses to taxpayers. It's not a situation you want to be in. And I think we had an opportunity to conserve on the government's balance sheet had we been more proactive about getting private capital pushed in or conserved in the 18 months leading up to this point. Some broader evidence in the spirit of kind of this cross-country type of analysis. Very nice paper by Barron, Werner, and Schong a few years ago, where they looked at data from 46 countries going back to the 1870s. And if you look at this data, anytime you have large declines in bank equity capital, 30% or more, even outside of anything that we would kind of classify as a full-blown crisis. So even if you don't have runs, you don't have widespread government intervention into the banking system, you just have a major adverse shock to bank equity capital, those tend to be followed by significant contractions in credit and by recessions. Okay, so again, the point that, this is something that calls for policy intervention even prior to or even outside of the kind of full-blown crises that we've been talking about. Okay, so if you accept the premise, my premise that, aggressive prompt recapitalization of banks is a legitimate policy goal, question is, where do we stand kind of in terms of our preparedness institutionally to achieve this goal? And again, sort of, are we willing to do this outside of or before we get to really the worst state of a crisis? And I would say, unfortunately, at least in the US, it's been sort of disappointing on this score. Again, the stress tests in 2009, which eventually led to a forced recapitalization of the banks in the spring, was a big success. You might even argue, I would argue it was a turning point in the crisis, even if we let things get worse than they needed to. And so then when stress testing became a regular feature of the bank supervisory and regulatory process, you might have thought, oh, that's going to be a good thing. That'll allow us to build sort of during peacetime a process that creates a measure of sort of institutional muscle memory or institutional resolve, so that next time we have a shock, we'll be quicker to react, we'll be quicker to sort of, get the private sector to do the kind of capital retention and capital rebuilding that we'd like to. And I think sadly, this is just not in the US, I should say, this is not what's happened. Is the stress test, which I felt like, you know, if you'd asked me in 2010, 2011, I thought this is a really promising piece of the arsenal. I think they've sort of sadly devolved into more of a kind of compliance and box checking exercise. And I'll tell you one sort of particularly unhappy story in this regard, which is at the onset of the pandemic in early 2020, a number of other countries' regulators, rightly, I think, suspended bank dividends. We just didn't know what was going to happen. The downside looked pretty scary. It seemed like the prudent thing to conserve capital. The U.S. did not do that. Did not suspend bank dividends. And you know, I'm sort of poking around and asking people. One former Fed, a very senior former Fed official who had been involved with the stress testing process, said, "Well, you know, one reason it would have been uncomfortable to do this is that we ran the stress tests last year. And when we ran the stress tests last year, the banks had a certain assumption that they made about dividends in the 9 quarters following. And given that we blessed the stress tests last year and we blessed the dividend assumptions, it would seem odd and not credible on the part of the Federal Reserve to then suspend dividends." I thought this was an odd but deeply revealing comment about, again, how it had become some kind of a weird, compliance process. I mean, it's like saying if last year the dots in the SEP said we weren't going to cut interest rates, well, then we can't cut them this year, even if the economy turns south. It seemed like a very odd place to get to. But, you know, and why is that? You know, some of it may be a natural bureaucratic tendency towards, you know, process ossification. It may also in the US particularly reflect fears of legal challenges from the banks to the stress testing process if it's used too aggressively or with too much discretion. And I think some of those legal considerations may have become even more pronounced kind of post the Supreme Court's ruling on the Chevron doctrine. I will actually stop there. I think Natasha will be able to pick it up with a much more informed perspective on some of these issues. So let me stop there and turn it over to Natasha.
No, great, Jeremy, and I think you also give us a lot of questions that we can follow up with as to what needs to be done instead than in the US. I think you gave some hints at us. But yes, please, Natasha, on the stress test specifically, what more and what better can be done to make them more useful?
Thanks so much to the organizers for having me. Can you all hear me?
Yes.
Great. So I kind of want to start, Jeremy very nicely laid out the land for me, and I kind of want to start where he ended, which is, let's say that aggressive prompt recapitalization is kind of the overarching objective. For the reasons June laid out, it's kind of hard to do, and I suspect has gotten harder to do politically for the government to bear this sort of cost of that recapitalization. So we'd like it to come from within the system privately. And why didn't that happen in the lead up to the great financial crisis? And also, why isn't that happening now? And why won't it happen in the future in the US? What you had a fair bit of in the aftermath of the financial crisis as people considered this question was a lot of discussion of legal authority. And Jeremy kind of started to give us some of it, but it's like there was this understanding, and in retrospect, it looked pretty clear that kind of like a year and a half before you had any sort of serious new equity being raised or equity being injected into large financial institutions, there was a problem. So you had this like year and a half, and in that year and a half, you didn't actually have regulators do much of anything, at least vis-a-vis, and this is a kind of important point, at least vis-a-vis the largest financial institutions in our system, even though we kind of understood that they might not be exceptionally well equipped to continue to intermediate, and in fact, some of them might well be on the brink of failure if the downturn took the shape that it looked like it was going to take the shape at that time. And this is sort of a question that I've considered. This is a question that Larry Ball has considered, like, why didn't we do more? There is a view that we didn't do more because in the US we didn't have the legal authority to do more. And they're really just to sort of be explicit, the argument is that we couldn't tell banks that they couldn't pay out their dividends as planned. We couldn't tell banks that they had to raise new equity because that would be pushing on the limits of what regulators were allowed to do to these financial institutions. And there's just literally no evidence that there is any real legal constraint in this space, and certainly not that there is today, but frankly not that there was in 2007. There's a statute it's called the International Lending and Supervision Act, which basically says that regulators can set capital requirements for institutions as they see fit, in light of a variety of factors that could very well be heterogeneous. So it could be that you decide as a regulator that the right capital requirement for Bank of America is different than the right capital requirement for JP Morgan, and you have full legal authority to make that sort of decision. And you have full legal authority to say, actually, it doesn't work. We need to have a capital directive for this particular institution. It doesn't work that they make this, they continue on their program of paying out dividends to shareholders or all the share repurchases that they're contemplating. That's kind of not in the interest of the broader financial system stability. And as a result, they're not allowed to do that. How do I know that, and how can I say so concretely that legal authority exists for these sorts of capital directives to financial institutions? I know that it exists because regulators actually deployed that exact legal authority, just not for in the lead up to the great financial crisis, just not for the largest institutions. So in fact, there were capital directives that came from the regulatory community, and we have a sort of complex, as all of you know, we have sort of a complex maze of regulators in our system, but they were capital directives that came to smaller financial institutions saying, actually, you need to safeguard capital, or you need to not pay out dividends as you're planning, or in fact, you need to raise new equity because of risks that we're kind of concerned might be on the horizon. So that authority exists. That authority was deployed. It just wasn't deployed for the largest institutions in the system. And that bears the question, I think, of why and what should we try to do about that? And Stein was kind of starting to lead us there as well. I think the why is actually pretty hard in that it's totally understandable. If you are a regulator in late 2007 and you're contemplating what should one do, and you're thinking about this power to have these capital directives, or you're thinking about the fact that you can turn off dividends, that sort of affirmative action by a regulator is in and of itself a signal of what regulators think about the safety and soundness of the financial system. So it's totally understandable, in fact, that you might not want to sort of deploy the authority that you have because of a concern about what that might signal about the risks that you think are on the horizon. And that sort of affirmative action becomes really hard. And while in hindsight, it's seems pretty obvious that something should have been done and we should have been more aggressive and recapitalizing when we had the opportunity to do so, at the time, you could have imagined, and in fact, I said the same thing around COVID. I said, we really need to recapitalize. We should be really worried. These financial institutions, they might very well be on the brink. And in retrospect, the sort of financial institutions that have struggled since over the course of the last year or so as a result of sort of mismanaged interest rate risk weren't the largest financial institutions in the system, and my prognosis was incorrect at the time. And so we have a bit of hindsight bias as we think about these things, and also a totally reasonable concern that regulatory affirmative action might very well be destabilizing to the system at the onset of the crisis, of a crisis, and kind of have death spiral type of dynamics that it might actually trigger exactly the kind of downturn that you're worried about trying to prevent against. I think what that means ideally, and is what you would like to do, is have a system that manages to automate some of these recapitalizations at the outset of what looks like it could be a crisis. And I actually think, and Stein kind of said it, and Jeremy also said a version of it, I actually think the stress test provides you with at least an infrastructure to think about how you might do that in the US. Although, as Jeremy pointed out, like the stress tests today are pretty far from achieving any sort of ideal like that. And this is work that ongoing work that I have with Till Shorman, is to say, like, how do we think about the stress test and what types of reforms might you like to see to stress testing to get us closer to a tool that might allow for some automated recapitalization of the system at the onset of what looks like it could be a financial crisis. We have a couple of recommendations in our paper. They kind of range broadly from, like, we think we should have more aggressive stress tests that are responsive to real-time risks through the use of more stress test scenarios. So you could imagine what's happened to the stress test. Part of why they've become, as Jeremy describes, this sort of rote compliance exercise is because they're actually like the same test year after year. The sort of dimensions are not really changing. It's like a 40% decline in equity markets. It's like a 30% decline in the housing market. It's like very clearly articulated. And banks are not like my students. If I gave the same test year after year, they would kind of understand that I was giving the same test year after year and would start to learn to the test in ways that allow them to hide certain types of risks that have accumulated, or actually take certain types of risks that the tests just aren't testing against. And interest rate risk is a very good example of exactly that. I think another sort of challenge for the tests, and another challenge for why they're pretty far from achieving any sort of dynamic recapitalization ideal, is because they rely very heavily on measures of regulatory capital. And measures of regulatory capital are inherently pretty static and don't update for changes in what the market perceives or the true value of a bank's assets and liabilities. And again, the market can be whatever the saying, like the market is wrong, as the one truth in life is that the market is always wrong, and that's totally accurate, I get it. But the reality is that there's information that's coming from a substantial decline in the market's assessment of a particular institution's viability, and that assessment should be well considered in any sense of how we decide how strong or weak a particular financial institution is from a regulatory perspective. I also think it's like really important for the stress tests, if they want to get close to achieving some of these objectives, for us to have more explicit stress testing of bank funding. And particularly for the types of risks that we saw at the SVB moment, for the fact that sort of a very substantial share of deposits were very highly runnable very quickly. That should be something that the stress tests, and our stress test assessment of financial institutions, reflect and contemplate very seriously. And I also think that there is a real need, and particularly if you ask me where I was worried as you look at the US and as you look at our sort of maze of different types of financial institutions and regulatory structures, if you ask me what I was most worried about, it actually wouldn't be the largest financial institutions in our system today. It would be sort of these mid-sized regional banks like SVB, where it's not actually fully clear what kind of business model is supporting that type of institution going forward outside of broad-based guarantees of essentially the entire system of liabilities by the government. And additionally, I'm worried about some of the risks that are on the horizon that actually those institutions have taken on primarily with respect to things like commercial real estate. And so in that world, what I would like to see is the stress test as a tool that's applied more broadly than just to the 30 or so largest banks in our system, where you have more financial institutions that are subject to the stress test more regularly. And all that is, so these are all kind of ideal goals that I would like to see from the stress test perspective. In order to accomplish those goals, we would need a combination of statutory changes in the US. So you'd need new laws. And you would also need new regulations that the Federal Reserve decided to issue to kind of interpret capital requirements, which have traditionally been measures of regulatory capital. If you wanted market assessments to be incorporated into your measurement, you would need sort of a whole process of notice and comment rulemaking to kind of get you to be able to consider those types of values in our measures of capital. And you would need all of these changes in a moment when I think the Fed is totally rightfully and reasonably very concerned about legal risk. And the concern is that they're going to get sued, and they're going to get sued already for the existing stress test infrastructure. And you've seen some of the bank trading groups in the United States kind of start to issue threats along these dimensions because of a view that they're not because the stress tests today are setting binding capital requirements for institutions. There is a view that the stress tests themselves and the stress test scenarios should be subject themselves to a regularized notice and comment rulemaking process. I think that argument is pretty legally tenuous because there are a whole host of reasons why. The most obvious one, and Dan Tarullo has written extensively about this, the most obvious one is that the stress tests themselves aren't actually an example of what in administrative law we call a final agency action, because there's a lot of space to actually debate and contest the stress test results. And in fact, instances where the Federal Reserve has decided that even though a particular institution failed a stress test on quantitative measures, they still technically were allowed to pass the stress test because of how regulators ultimately decided to internalize or process the information that came from the tests. So there's totally good arguments to be made against this sort of legal risk, but given the contours of this Supreme Court and how they feel about administrative law and Chevron and all of the sort of the legal environment in which we're operating, I think there is a totally reasonable concern that pushing more on existing authority than the current stress tests do already is a recipe for getting some of that authority thrown out in court. So what do you do about that? I think Dan Tarullo, again, has a very sort of clever solution that might be a version of the right one, which is that if you decouple the results of stress tests from explicitly being tied to financial institutions' capital requirements, then maybe by virtue of that decoupling, you take away some of this legal risk because you undercut the sort of presumption that this is somehow some sort of final binding action. I think that's a smart and perhaps the right approach and allows for more creativity with respect to different stress test scenarios and with respect to some dynamism in the stress testing regime that's been lost today. The thing that I worry about, though, is that moves you again. Then the stress tests become more of a normal input into a supervisory process. And it moves you again away from a world in which we've automated, or at least started to move in the direction of automating recapitalization that comes internally from the institutions themselves. And that world is subject to many of the same risks that we had in the lead up to the financial crisis and mismanaged over the course of that period. So I think that we're kind of I wish I had a very easy solution for this challenge. I don't really, but I think it's a really important one for us to contemplate as we think about not just the future of stress testing, but the future of dynamic recapitalization more generally.
Thanks very much, Natasha. So with that, and I think there's a lot to think about, and we'll come back to it to the extent we have time. I do want to pass it on to Andreas, because I know he has a list of things that need to be done on the European level. I'm sure the audience is at least as interested in the European application. On my list that he already told me, bail-in Europe, ELA in Europe, deposit insurance, there are probably other issues. So Andreas, please go ahead.
Yeah. First of all, thank you very much for inviting me. It's good to see you again. Good to see Jeremy again after a long time, I must say. And I'm not feeling very well. My voice is even deeper than usual, and there's a reason for that. And I have a tendency to speak far too long. So what I am doing now is I'm structured myself a little bit so that I don't get carried away. And I would like to structure my intervention in a way that what's not really going well from my point of view in Europe and what should what I would like to see to be done. So it's a little bit forward-looking, and you cannot do this without looking backwards, but it's forward-looking. And the first point I would like to make is the mandatory bail-in. Now, everybody in this room knows that the BRRD stands for Bank Recovery and Resolution Directive, and the BRRD is making them, as the name correctly implies, mandatory in Europe. So that's okay, but they can cause quite some problems for regional, systemically relevant European banks. I'd like to cover that. So what's good for the big banks may not be good for the entire banking system, and I heard something of that in the United States also. Now, the international framework, which we all inherited by the FSB, they only really focus on GSIBs, on these global systemically important banks, requiring them to hold more capital in TLAC. So that which can be bailed in. Smaller banks, other banks, they would still be liquidated. But by contrast, the BRRD was visionary in recognizing that smaller banks can be systemic as well, either because they are big enough or in systemic contagion scenarios. So they really foresaw that. And the European Union now requires all banks, but the very, very small ones, but everybody else, to hold so-called MREL. And I was there when this was introduced. So MREL that could be bailed in. And I look at the ECB, and he's nodding, and that's good. Only after a certain amount of private sector claims has been haircut, and only then safety mechanisms such as the resolution fund could be deployed. And this hierarchy I am quoting here is mandatory in Europe. So public funds cannot and may not be employed in any circumstance in Europe unless the mandatory bail-in has been executed. And the big question is whether this works in real life or whether it doesn't work. And I'd like to make 3 points. First, more regionally focused banks do not have access to deep international capital markets, as the GSIBs, of course. So that MREL creditors, they may well be local counterparties, or they are likely to be local counterparties. Even non-insured depositors could well be in that position. So this second creates quite obvious macroeconomic and financial stability concerns in case of the crises getting very, very deep, as the mandatory bail-in could exacerbate panic and cause a broader and deeper loss in the banking system. And third, last but not least, the cumbersome process with many involved institutions at EU and member state level, and Europe is really the world-class master in having a cumbersome process, causes efficiency issues and might lead to suboptimal outcomes, and I mean it exactly as I say it. So I do really believe it is important to review the regime we are having there from 2 angles. First, we need to be aware who is holding MREL claims. I don't think we really are fully aware, and whether these claims could really be bailed in, not only from a legal but also from an economic perspective. And second, the process might need to provide for flexibility if it really would be needed. Secondly, let's talk about ELA, emergency liquidity assistance. And I actually was also in office when we had to decide on that. So I feel at least knowledgeable enough to speak about it. Now, it's being issued, as you know, ELA is being issued by the ECB, by the European Central Bank, but represents a liability of the national central banks. And I've been representing, at the time, the biggest European National Central Bank in the Eurosystem, which means that the financial power of the respective country is relevant for ELA, a big obstacle to a banking union. Let me explain a little bit why I'm saying that. While we have common safety nets in Europe as the Single Resolution Fund, there is no EU-level ELA. ELA is granted by the member states, member central banks, as I just said, even if the ECB Governing Council needs to approve it. It needs to be approved by the ECB Governing Council, by the way, only by non-objecting They're basically doing this to prevent member states from liquefying own sovereign bonds. So that's the only reason why the ECB really wants to be involved, I think. So even if it needs to be approved by the ECB, the risk is with the National Central Bank and stays with the National Central Bank. And as the latter is owned by the sovereign, ELA is in the end a burden for the sovereign. So now, what does this mean? As we are aiming for a more integrated banking system in Europe, a crisis that concerns a bank could require significant provision of ELA, and it actually did in the past require that. I remember very well. How would this then actually happen? If we follow a model where each central bank needs to backstop outflows in its own country, this creates really significant imbalances if and when bank transfer liquidity across internal EU borders. Now, to transfer liquidity across internal EU borders is actually the very purpose of the banking union. And this, however, means that banks that span many parts of the European Union could only actually be headquartered in EU countries that could afford to provide ELA for larger parts of the bank, i.e. large member states could actually only be the host for those banks, and this is politically and economically, and I say this as a former representative of a large country, this is politically and economically not desirable and not how a banking union should be actually formed. We therefore need to think about some sort of a ECB-level ELA framework, also considering the vast amounts of liquidity that might be needed to stem a larger crisis, as we have seen. It was mentioned so often recently in the US last year and with Credit Suisse. Third, the European Deposit Insurance System. The next point is really for me to mention that, similar to what I just described on ELA, applies unfortunately to the DGS. Member states' DGSs might not be powerful enough, may not be potent enough to cover banking fatalities, in particular if the sovereign, which backstops the local deposit guarantee, is in financial difficulties itself. The unification of the national schemes has been actually stalled so far, is not moving forward. First, some member states feared the resources of their schemes could be used to solve banking issues elsewhere. This could well have come also from my home country. Second, many countries have well-established schemes considering local specificities and are reluctant to give them up. Also holds true, among others, for my own country. So I have proposed, while I was still in office in 2016, an approach that could open the deadlock, and I would like to quickly explain it again, and it can be reread, and I don't want to give a lecture on it. But there is the possibility of organizing EDIS in a sort of in a reinsurance model. First, the national deposit guarantee system would kick in. If that would not be enough, and if that would be exhausted, there could be a fund, a European fund, lending to this national deposit guarantee scheme as a loan, the interest of which would be determined by the rating of the country in question, which would have to be repaid, so that this would not be a full mutualization of debt, but it would just be the help in order to prevent bank runs. And we could well imagine a system how such a European fund could actually be set up. So we will see whether this will ever be taken up. I think we need a solution on EDIS. We really need a solution soon. And there are already first signs of that in the European Parliament. Just before the election, there was a meeting of the committee, which actually exactly talked about this solution, which was presented and accepted it, but didn't put it forward for further approval in Parliament. It could well happen now, and then we could actually finish the banking union. But otherwise, we have problems on the European front. Last but not least, as we all know, little progress has been made in terms of creating a true European banking system, and this also leads to the fact that we are seeing very little European cross-border M&A activity because of all the reasons I've mentioned. Now, you may think that because of UniCredit now having started a development, let me call it very diplomatically a development with the German Commerzbank, is changing things. Now, I don't think so, because we are having BBVA also, quite aggressively going after Sabadell. We, of course, saw UBS Credit Suisse, which is not in the European Union, doesn't matter, it's close by. But these are really domestic mergers. We are seeing, we're seeing mergers in those countries. We see very little cross-border mergers, and I would even argue that UniCredit bidding or potentially bidding for Commerzbank is a merger which is intending of using Hypovereinsbank, their subsidiary in Germany, to merge it with Commerzbank, rather that there is, of course, some cross-border money involved, but it's more of a domestic merger than anything else. We are not seeing, because of the reasons I mentioned, we are not yet seeing a true European banking market, and these are my suggestions, what needs to be done to go forward.
Thank you very much, Andreas. We're running a little bit short of time, but I'm going to take some time off your coffee break because I think there's not enough to discuss here. 2 questions on my part, and then I'm going to give it to the audience, both in the room and online. One is directly to Andreas. It was mentioned both by Jeremy and by Natasha a little bit on the dividend restrictions. Do you see any scope for that as a tool, at least, not necessarily that we're going to use it right away, but the banking industry makes a lot of profit at the moment, yet at the same time capital is actually starting to decline a little bit. If I look at the ratios that the ECB puts out, at least it's not increasing. Risks are still high. Would you consider that as a tool that we should put on the table more often?
No. In these markets we are right in, it's not only the dividend, it's also the share buyback, of course, yeah. And you can look at it from both sides. And there are quite a number of large European banks which have helped their capitalization a lot by share buybacks. And if you look at what the analysts are asking for, it's the share buyback program more than than those stocks would really be looking for dividends. So I would like to answer this with these 2 instruments, not only with the dividend policy. I can no longer speak for the supervisory board. I was on one of the founding members of the supervisory board, the SSM, and I can tell you there is no chance, in my personal view, that the SSM will go away and giving away this instrument of influencing dividend policy or even share buyback. To be very clear, I talked to Andrea and Ria a lot about this. When this came into fruition and became relevant, the first approach of the SSM was to go and speak to the banks and ask them, could you refrain from high dividends? And the banks said, no way. And then it was enforced. So the first idea was to sort of convince them on a voluntary basis. This was not, I'm making a longer story short, but it was not at all successful. And then it was enforced, although that was not the first reaction or the first idea of the single supervisory mechanism. So you have to go through a lot of approvals these times, but I don't see the stance of the SSM change at all.
Question for Jeremy and Natasha and June as well. In light of the still significant mark-to-market losses on the security side, which is a very plain risk in some sense, in plain sight as well, do you think there's any value of doing a stress test through kind of an ex-ante recapitalization mechanism to ask those banks to clean up their losses, or do you think that's not in the card? I addressed it to Jeremy, but it's a really Natasha question, maybe even more so. Who wants to go?
Well, in that case, there was a more direct mechanism and I think a more direct failure in some sense, which is there's something in the US known as the AOCI filter. And I know about this because I have some deep shame and regret. This is something that was passed, I think, in 2013 when I was on the Fed board, which is when banks have losses on their securities portfolios, their available for sale securities portfolios, even though those losses are obviously, as you said, mark to market, they do not flow through to the bank's capital for regulatory purposes, except for the very largest GSIBs. But basically an exemption was made for everybody other than the largest GSIBs. Had that exemption not been in place, that would have done it. Wouldn't have needed more stress testing or anything else. You would have said, oh, you just lost X amount, your capital is down. And you can see how in the case of SVB, something like that would have been very helpful, because absent the AOCI filter, they only recognize the losses when they sold. They only recognize these losses when they sold their securities, which created a bad dynamic, which is basically when some of the Silicon Valley companies started needing to withdraw their money, then SVB needed to accommodate those things by selling securities. That then created, late in the game, much too late in the game, the sort of capital losses that forced them to raise new equity. Right? Had that been in place earlier, those losses would have been recognized earlier. That's a case because, this is to Natasha's point. I mean, a big problem we have is that most of the banking book is not mark to market. We don't use market information. Here we had market information. It's very clear, very objective. Without that AOCI filter, that kind of recapitalization would have been nicely affected. That's something that I think going forward should and will be fixed. It's relatively low-hanging fruit as compared to credit or CRE losses, and when do we kind of decide and make a discretionary thing that then sends a bad signal. None of that really occurs when it's the marking of your treasury securities portfolio. Should be easier.
I'm glad to hear that you're confident. After last week's announcement, I'm less confident in the regulatory approach in the US, but I think this is a good piece of news if it were to happen. Natasha, anything to add to this?
Yeah, I'll just say two things. One is just like a sort of broader statement about the nature of how hard it is to be a regulator and how hard it is to set ex-ante rules. The result of having this different treatment that Jeremy's describing for securities that are classified as hold to maturity versus securities that are classified as available for sale is that institutions kind of know that there's a different capital treatment if you classify differently. And in fact, some of these rules changed somewhat in the US over the course of the last decade. And the result was that they started classifying more of their stuff as hold to maturity, so they wouldn't have to take the capital loss. And so all that is to say that these rules allow for a ton of gaming, and it's super hard to think ex ante about exactly how to structure regulation. It's also, I would be very sort of pleased to see, and I was hopeful that what we would see coming out of SVB was a push to do a version of what you're describing, Stein, which is listen, there've been, if you Amit Seru and co-authors have estimated something like $2 trillion of capital losses, just pure interest rate risk related capital losses in the system. There's only $2 trillion of capital in the system, so that means that there's no capital left. I think that's not exactly right? Because what that doesn't take into account is the fact that the deposit franchise is this natural hedge against interest rate risk. This is a great paper by my former colleague Itamar Dreschler and his co-authors, which basically says a bunch of that risk is managed by the fact that you don't pay your depositors market rates. Even given that, there are significant capital holes in the system, and we know about them, and we still haven't done anything in the last year, even after post-SVB. So I am also, I would say, a little bit less optimistic that there's going to be this moment of capital reckoning, and I'm super nervous about some of the risks that are on the horizon, particularly for institutions that are not GSIBs in our system.
Thanks much. Again, word of caution. So let's turn it to the floor and any questions here in the room. I'll collect a few, try to direct them to somebody specific. I see Livio here, and then we'll pass it to you. And then we go to men from Cyprus, sorry.
Thank you. This is also a very interesting panel. So I would have many questions, but I limit myself to two. So you had this discussion on the stress test. So I wanted to check with you if you agree with the following view, that essentially so one could see that banks should always be prepared to face cyclical risks at all times, and so we don't need a stress test for that really. So what we need a stress test for is for specific events that we know are coming. So things that you are, for example, in the UK, there is a referendum for Brexit, and then so the referendum can be yes or no, and then in those special circumstances, you say let's stress test the banks in case the referendum is successful, for example. So you have a binary situation, you have a specific situation in that particular point in time. But for all other things that are more timeless, so we don't really need a stress test. So I'm just checking with you whether you agree with that general view. The second question I have is, what do you make of the economic value of equity as an indicator? No? So we always have the discussion, especially in relation to interest rates. No? So interest rates increase the interest rate income, so it is good, but it reduces the economic value of equity. We always wonder a little bit, what is the signal the economic value of equity gives us? So I wonder if you have any comments on that. Thank you.
Okay, so we'll just collect questions and then we'll give a round to the panelists.
Thank you, and thank you for the panel. Natasha was talking about, and coming back to the stress testing and stress testing of liquidity risks. If we take the SVB case as a benchmark for liquidity stress testing in the future, it's easy to expect that a lot of banks would fail quickly. And that would also imply that were we again faced with such a circumstance, we may need to take action, resolution action, midweek, instead of waiting for the traditional weekend of resolution. So taking into account that any kind of capital injections, any kind of sale processes imply marketing time, how does it reconciliate with crisis management preparedness in terms of should we be ready to act on the week, on Wednesday? Or do we need to take measures to bridge the time needed to reach the weekend to do those as traditional resolution weekend that is part of the FSB apparatus? And what kind of measures do we need to take? Thank you.
Thank you. Andreas. Andreas
Thank you.
from Cyprus.
I have two questions. One relates to stress tests and the second to ELA, emergency liquidity assistance. I'm under the impression that the stress test is a preventive mechanism to mitigate problems with regards to recapitalization, as Professor Jeremy Stein has already mentioned. And these stress tests are applied mainly to systemic banks. And they're forward-looking. I got the impression from the discussion that are backward-looking, but I think they're forward-looking. You mentioned there are some limitations, and I would greatly appreciate if you let us know what you suggest as far as stress test is concerned in order to improve even further, because in the past 10 or 15 years that these stress tests are applied from EBA, European Banking Authority, I think they improve, the banking system and the financial system in the European Union. And I need your opinion on that. A second issue relates to emergency liquidity assistance that Mr. Andreas has mentioned. We have experience in Cyprus for everything. We are the only country that we had the bail-in in the Western world in the last so many decades, and we had emergency liquidity assistance on one of the biggest banks in Cyprus in 2010, 11, 12, 13, they got emergency liquidity assistance from the Central Bank of Cyprus. As you mentioned, yes, the Central Bank of Cyprus is responsible for that. Under what circumstances do we give emergency liquidity assistance? When a financial institution, especially which is a systemic one, has short-run liquidity problems, right? In this specific case, the Central Bank of that specific nation has to decide, should we give liquidity assistance or not? Of course, it's not that easy, and I need your opinion because you are experts. On the one hand, if you don't give liquidity assistance, you would be accused that you didn't try to help the financial system in that specific country. On the other hand, if you give liquidity assistance, as it happened in Cyprus, because Cyprus is a small economy. At that time, our gross national product was approximately 20 billion, something like that, and we gave emergency liquidity assistance 50% of the gross domestic product of the country. So we have to be very careful. If that bank goes bankrupt, then the system, falls apart, right? What happened? Even though everybody was saying this bank will fail, the Central Bank of Cyprus have given emergency liquidity assistance of more than 10 billion euro. This bank failed thereafter. But what happened? The Central Bank of Cyprus, instead of transferring that to the taxpayers, what happened, they asked this specific bank to be merged by another bank. So you see there's major problems in this specific case as far as the decision that takes place, by the Central Bank of that specific country. Thank you.
Thank you. I want to give, is there anything online that we can add to this list?
There are several questions. Do you want to hear some of them or take?
If the audience agrees, we'll take a few more minutes of your coffee break. Let's hear 2 questions and then we'll have the panelists respond.
Okay. Let's take a short one for Jeremy Stein by Andreas Grünbichler from the University of St. Gallen. Does the AOCI filter mean that we might not see mergers in the US mid-sized banking industry as long as they won't devalue their securities? And another question on the stress test discussion by Tom McAleese from Alvarez and Marcel. Bloomberg has been reporting on the asset quality reviews conducted by the ECB on the leveraged finance books of the top corporate banks in Europe. The initial results called for additional provisions of about 14 billion euro. However, this has now been recently halved to 7 billion euro. This looks like a good result for the banks following significant challenges by them. Has the pendulum now moved back towards the banks? Is this a perceived systemic risk or normal supervisor-bank dynamic?
Very good. So we have quite a few stress test questions. I'm going to go, June, you're always free to come in at any point, but I'll start with Jeremy, Natasha, and then Andreas. I think most of the questions are clear to whom they are addressed. Jeremy.
Okay, so there were a couple questions about stress tests. Let me just try to broadly answer them by saying, what in an ideal world would be the role of stress testing? And it starts by an observation, it starts with an observation that Natasha made, which is regulation is really tough, right? Why is it tough? Because you write a rule and then you set it in concrete and then the banks have a look at it and they say, what can I do with this? How can I optimize? And of course, it's impossible for any rule, no matter how intelligently written, to anticipate all contingencies, right? There's always going to be something that somebody's going to figure out after you wrote the rule and is going to arbitrage it. So in my kind of ideal world, supervision, as distinct from regulation, is your second bite at the apple. In other words, first the regulators move, they write the rule, then the banks move and they say, what can I do with this? And then you, the supervisor, look and you say, what's going on? So if it were me, and Natasha also talked about, designing sort of more dynamic stress scenarios. The way I would design them fundamentally in principle is every year I would have the supervisors go into the banks and say, gee, who are the 10 most highly compensated employees this year? What are they doing? Or what's the fastest growing, unexpectedly fastest growing line of business or most profitable new line of business? What's that? I guess we didn't really think enough about that. Let's stress that. That's the kind of sort of role I would ideally see for the stress test. It's, in the sort of language of economists, the rules are incomplete contracts, and we're trying to fill in some of the incomplete contingencies after the fact. That's the essential role I see of supervision and of stress testing. Now, unfortunately, again, as Natasha sort of emphasized, it's exactly that discretion, which on the one hand may be the most valuable thing you could do in principle. It's also the thing that opens you up to, legal challenges and just a lot of trouble. And I think that's where, again, the process thus far has been disappointing. It has done the opposite of that. It has gone to being predictable. And then as the first question sort of anticipated, then it's just devolves into another hard-coded capital rule. In other words, if we know ahead of time you're going to stress this type of loan by this amount, it's just a kind of capital surcharge. then it has none of the benefits of supervision. It just becomes sort of another way to impose regulation. So again, that's a statement of kind of the ideal. I think we know some of the challenges, but I would do whatever I could. And you know, she mentioned, Natasha mentioned Dan Tarullo's proposal, which I'm kind of sympathetic to, because anything we can do to kind of give more muscle to the discretionary supervisory aspect as a needed complement to regulation, I think would be valuable. Then there was a very good question about the AOCI filter and its impact on mid-sized bank mergers. It's a good question. I've thought quite a bit about mid-sized bank mergers. I had never thought that the AOCI filter would be the impediment. I worry that the impediment, there's a much more blunt impediment, at least in the US, which is the Biden administration has basically said, we will do everything we can to block these mergers. And I think it's too blunt in the sense that, of course, we don't want JP Morgan merging with Bank of America, right? We don't want the G-SIBs getting bigger. But at the same time, we know that for some of the regionals, their economic models are potentially quite challenged. And we may need to either have them find some economics or purge some of the capacity out of the system, and mergers are a way to do that. And if we sort of just across the board have a hostility to all mergers, I worry the alternative is we're gonna have excess capacity and some zombified institutions with deposit insurance. I think we've seen that story in the past before, and it's not a particularly happy story either. So I would, in the spirit of the question, if not the precise language of the question, I would surely like to see impediments to mid-sized bank mergers be reduced.
Thanks, Jeremy. Natasha.
Yeah, Jeremy said a lot of what I was going to say, so I'll just sort of add a couple of pieces. I think there was another good question about like how stress tests should account for risks that we know are on the horizon. So things like Brexit, things like in the US, like a very substantial decline in the value, I think, of commercial real estate. I think that the stress tests are a great tool because and frankly, like the same thing happened at the onset of COVID. Like there was, in fact, and I should give the Federal Reserve due credit, like they contemplated an additional like COVID scenario. They detached it. It was one of these exploratory scenarios from any sort of direct capital linkage. And they also didn't make the bank by bank results publicly known, but it moves in the direction of like when you see a risk, test against risk, which I think is a good approach. I think the challenge, or a challenge, is that once you identify those risks, and if you're only stressing a subset of the banking sector, which is how stress tests work presently, not just in the US, then there is incentive for risk to migrate out of where you are testing for it into other places of this, other sort of parts of the system. And that's what you've seen happen because the stress tests are hard on small business lending and because the stress tests are hard on commercial real estate. There's actually less of that happening proportionally in stressed institutions than there is in non-stressed institutions in our system. So like I am worried about the migration of risks and the ways in which the stress tests themselves can like sort of perversely push risk out of the more sort of clearly identified by regulators system. I also want to be very specific about like, Jeremy was very good on like what his ideal stress test is. I want to be like pretty specific about when I care about the ideal stress test, which is like, I've always thought that there's kind of a difference between what we want the stress test to accomplish in what I call peacetime or like normal times, and what you want the stress test to be able to accomplish at the onset of a potential crisis or when you're in a crisis. And in some sense, like peacetime stress testing, like I would sacrifice, like I don't care about it that much because I think we have like a broader regulatory apparatus that has a bunch of rules and a bunch of requirements and roughly things are kind of right. Like I think when you care about stress tests, is you care about them when you are in a moment when you might want to see some of the recapitalization that we've talked about, precisely because capital has been drained or is about to be drained by the prospect of a downturn. And so as we think about like designing stress tests, given all the political constraints and all of the challenges, I think one thing we might want to think about is like, how do we keep the infrastructure in place and make sure we're well equipped to do a version of SCAP at the outset of the next crisis, and like less about like annually or with some regularity what we want an ideal dream stress test to be, because I think that might just be like a hard hill to push yourself up given a host of legal and political constraints, at least in the US. And I like +1 Jeremy's concern about mergers, and I'm less convinced than he is that you don't want JP Morgan to be bigger than it is today. If you compare us to Canada, where there are many fewer banks and no financial crisis, no banking crises in recent history, I think it just tells you that there are trade-offs to, there are pluses and minuses to concentration in the banking system. And one of the pluses is you have better control over and more visibility into larger financial institutions in your system.
Thanks, Natasha. Andreas, ELA question. June, you're always welcome to come in.
I guess I just wanted to add one thing about the stress testing and like the onset of the crisis is that I think, you know, one caveat is I think you need to be mindful of kind of what phase of crisis you're in as a jurisdiction. And, you know, if things are really progressing fast and if things are going badly really fast, you know, if you have the tools ready, that's great. And I think that's one of the purpose of this conference and, you know, why we discuss about these things in peacetime is that, you know, as authorities who have the power to do these things, you want to be as prepared and you want to know your authority as clearly as possible so that when time comes, you know exactly what to do. But also you don't want to spend too much time on trying to figure out, you know, like, do we need to stress test certain banks and try to figure out what is the adequate amount of capital that we need to give them? It's more, I think, when things are really burning, you just really need to act. And that's, I think, what we've seen a lot in a lot of the historical cases that we've seen.
Thanks much, Andreas.
Okay, I'm going to be quick. Three answers. First, with regard to stress testing, I'm quite disillusioned about it, I must say. Now, we are talking about public stress testing. I am expecting each and every bank to stress test its business model itself. I am expecting, let's say, the European Central Bank to stress test them without publishing and having a simulation of what's going on. What I am disillusioned about is a little bit the public stress testing for several reasons. First, why did we do it in Europe? I was there. Because the US did it. It had such a big success. We never had the big success in Europe, unfortunately. We would have liked to have that success because we're discussing EBA and ECB. We're discussing the assumptions of the stress test, and then it's going to be reported, and nobody really discusses whether this assumption is a fair assumption, is the focus correct or not. It's just accepted as it is. And plus, if you look at the European banks being stress tested, not only that they're in different regions, they are in different business models, they are just totally different. The sizes are different, and you have this big mishmash of a result, and then you start ranking them, and you can't really compare in the first place. So I am a little bit disillusioned. I don't think we can really stop it, but the amount of work when I was in office, which is inputted into stress testing, is enormous. And you wonder whether the output is really fully justifying that. Second, there was a question which you mentioned, that there was a Bloomberg report last week on leveraged finance and a stress test there, and I was actually quoted in that Bloomberg report, and I don't get quoted very much anymore, so I read it, and I didn't know the drift of this Bloomberg report, and it was, I think that this is a misperception. There was a stress test of the European Central Bank of the Left-Fin book, and there was a big number, and then the banks did have raised issues and concerns about this, and the ECB shifted back from its position. I think that strong supervisors can also shift their position. It is not that if you have said something once that you have to stick with that all the time. You have to be flexible and you have to be understanding. So I thought it was rather a strength of the European Central Bank to sort of readjust after having learned some arguments. And that's how the dialogue should be. There is not a winner or loser, but that there's a dialogue. The last question is on ELA. That's a very difficult question. My part was that when your central bank, and you were on the board, I understand, of the central bank, when you requested ELA, the governing council of the ECB had to vote, and the Bundesbank was asked, "Here, do you agree?" in the governing council with that decision. And we always agreed. But it was not easy. And I must say it, and you mentioned the arguments yourself. Now, what really is important is the conditionality. And you know, I don't need to remind this room that when you and others had the problem, that there was a group, you know, with no direct priority, the IMF, the European Council, European Commission, and the ECB, you know, looking at this, and that gave us at the end a lot of comfort. I actually have heard who was the most aggressive in this group of three, which was not the IMF and maybe not the Commission, but that, you know, I wasn't there, but you need a conditionality. You know, if something, special situations need special answers sometimes, whether you like it or not. But you need to have a conditionality, which then led to the bank to be, you know, to be shifted in terms of ownership. But without the conditionality, ELA cannot reasonably be applied.
Thank you very much. I think we had a very interesting discussion. Sorry we ran over, but I think the panels, both combination of academic, practical experience and the topics made it worthwhile, I hope for you. So we'll have a break, maybe a little bit longer than the 10 minutes that is remaining. But I want to thank the panel as well for their great contributions to the event today.
Welcome to the final panel of this conference today. And this is the panel on dealing with distressed assets. Thanks a lot to all of you that have joined in this room, but also in the virtual room that we have. Before we introduce the topic, let me thank the Austrian Central Bank for hosting us in this fantastic state-of-the-art hall. And also let me thank all of those involved in OeNB, SUERF, and Yale Program on Financial Stability that have made this conference possible. I will briefly introduce the panel topic and my esteemed panelists for this final panel, and then we will start with the first round of their interventions. Afterwards, as in the previous panels, we will give the possibility to attendees to raise questions, but also to our online participants to raise questions. So just to briefly motivate this topic, even though I think it doesn't require much motivation, as we know, financial crises are often intertwined with economic crises. Sometimes these type of crises also come together with a sovereign debt crisis or a currency crisis, which further aggravates the impact on the economy and on the banks. Now, a critical aspect of a macro-financial crisis is the impact the crisis has on the asset side of the bank balance sheet, creating distressed assets. And these distressed assets are often in the form of non-performing loans, and they also show the degree of economic distress, actually, by borrowers in an economy, by households, corporates. So faced by a surge of non-performing loans in a typical macro-financial crisis, the authorities of a country, including the supervisors of the country, are compelled to act in a certain way. On the one hand, authorities, the governments, want to alleviate the hardships of borrowers. On the other hand, there's also an intention to clean up the distressed assets in the banking sector. Now, doing so involves a number of policy trade-offs, which we will also discuss in this panel. Some ways to alleviate the hardship for borrowers can actually really have detrimental impact on the banks, on the economy, on public finances. But also ineffective reforms or the lack of action to address high NPL levels, they can lead to a prolonged period of high NPL levels and that would exert a drag on the economy. So there's a lot of literature on this. So in this panel, we will focus on a few points, what we can learn from resolving high NPL levels after crisis. In particular, we want to highlight and pinpoint effective strategies for NPL resolution and underscore also some policy missteps that should be avoided in future NPL cycles. So the focus of this panel is really not on the current situation we are in, but on a hypothetical situation where there is another economic and financial crisis that leads to a significant rise in non-performing loans. So we want to explore how to best respond to such adverse conditions. So I have four credit risk experts, four excellent panelists on that topic, with significant experience on NPL management. Let me briefly introduce them, starting with Marie-Thérèse McDonald, who is joining us from the European Central Bank in Frankfurt online. Thanks a lot, Marie-Thérèse, for joining at such short notice. So Marie-Thérèse is an advisor in the SSM, so in the ECB banking supervision, specifically working on credit risk topics across supervised banks by the ECB. Prior to working for the ECB, Marie-Thérèse was a manager at the Central Bank of Ireland and also worked in the banking sector in the early years of the financial crisis. Let me turn to my right, to your left. Ms. Alessandra Haber-Drabek, welcome. Ms. Haber-Drabek is a Chief Risk Officer at Erste Group. She has held management positions at Erste Group since 2010, with a focus on risk management, including credit risk management. So prior to becoming the group CRO, she already had been a CRO in Slovenska Sporitelna, so the Slovak subsidiary of Erste Group, and Erste Bank Austria. Let me turn now to Yannis Tsigripis, to my very left. Yannis Tsigripis is Director General at the Bank of Greece, and he's responsible for prudential supervision. He joined the Bank of Greece more than 20 years ago in 2003, and prior to that, he worked already in the financial sector. Yannis has a long experience in banking supervision and financial stability, and we also had the pleasure to work together for some years in Greece. He's currently the alternate SSM supervisory board member of the Bank of Greece and has been a member of the ECB's Financial Stability Committee. So welcome, Yannis. And the fourth panelist we have to my left, Miguel Otero Fernandez, is a senior financial sector expert at the IMF's Monetary and Capital Markets Department in the Financial Crisis Preparedness and Management Division, if I got that right. So prior to joining the IMF in 2019, Miguel has worked as a crisis management expert for EBA and later on for the European Commission in DG ECFIN and FISMA, among others dealing with post-program surveillance in Greece and Spain. Welcome, Miguel, as well. So let me start by giving the floor to Marie-Thérèse for the first round, to kickstart the first round of interventions. So let me ask one general question to Marie-Thérèse. The euro area banks, some euro area banks were characterized by quite high levels of non-performing loans 10 years ago when the SSM was established. And if you look at the development ever since, over these 10 years, there has been a really strong reduction of these high NPL levels. And as Deputy Governor Perrazzelli already mentioned this morning, there has been a steep learning curve by many banks, high NPL banks, but also by the supervisors during that period. So I think it's a good starting point to ask Marie-Thérèse from the SSM perspective, so what have been the main drivers of this NPL resolution by high NPL banks over this period? And what would be the main advice you would give to other supervisors, in particular on NPL supervision and provisioning requirements? With this, let me give the floor to Marie-Thérèse.
Thanks a lot, and greetings to everybody from Frankfurt. So I think it's been a long road over the last 10 years trying to resolve the NPL legacy of the last financial crisis. At the end of 2014, NPLs were about just over 1 trillion, which accounted for about 8% of total assets. But as we know, these NPLs were concentrated in a small number of countries in those banks. Now NPLs are below, say, 400 million, and the total NPL ratio is about 2%. And these NPLs are largely newer vintage NPLs, which are somewhat easier, I would say, to deal with. So for my part, I'll just quickly explain then, as you mentioned, the SSM's activities over the last 10 years, how these activities may have contributed to reducing the NPLs, and lastly, then just give you some quick lessons learned. So firstly, in terms of our supervisory activities, so we have introduced a number of different tools over the past 10 years. So firstly, we published expectations on NPL management, and these expectations, or this document, was supposed to be very practical, which set out our expectations on quite a granular, applicable way. And based on this, then we requested high NPL banks, which is obviously a bank that has a gross NPL ratio of 5% or more, to design a strategy to reduce their stock of NPLs. And these strategies then were critically examined by supervisors to see how ambitious, but also how credible they were. And we took into consideration during this, or each of these examinations, how the specificities of these banks, how they compared to peers, but also what was going on in the country and what tools were actually available within that country and have they actually used them all. And these tools really laid the foundation. But what really gave the push, I think, to banks was really the provisioning calendars that were introduced. The first one was introduced in 2015. So put very simply, NPL provisioning should increase the longer an NPL remains an NPL. Obviously, there's exceptions to these rules. There's always exceptions, but this is the general idea. And setting aside capital in this way really, I think, gave the incentive or the stick, I would say, to banks to proactively deal or address the kind of legacy problem. So this was our approach from the supervisory activity side at a very high level. What were the actual main drivers then of NPL reduction when we look at those high NPL banks over the last 10 years? So there's two probably main clusters of tools. So the first one really relates to the internal tools, such as forbearance and debt enforcement. So from our perspective, we really, really believe that forbearance is a cornerstone of NPL management. So forbearance was introduced in regulation in 2015, but the concept has been around for much, much longer. It's not necessarily new. Effective forbearance measures really focuses on viable and sustainable solutions being agreed with the borrower. And in the early stages of the NPL buildup, banks were really kicking the can down the road. For example, from my own personal experience of working in a bank in Ireland at the time, our strategy was often to just extend the loan on an interest-only basis for 2 years and wait to see if the economic situation improved. But we also did this simply because we didn't have time. The situation was deteriorating really fast and we couldn't handle it. But at that time, I think it was already quite clear, at least in Ireland, that property prices had collapsed and cash flows were greatly reduced. And the situation it was never going to return to what it was, say, pre-2008. But I think it's really doing borrowers a disservice by not addressing the issue properly at an early stage. And borrowers are, in fact, consumers, they're companies. They are effectively what drives the economy. So if distressed borrowers aren't dealt with in the right way, in a sustainable way, it's really going to stall any recovery. And when banks really started to engage with viable borrowers and provide forbearance solutions, we started to really see an impact. Of course, there's also non-viable borrowers, and banks needed to start acknowledging, of course, that borrowers were actually non-viable and start to move them then through the debt enforcement route, which also takes time. But we've seen a considerable volume of NPL reduction through both of these routes, through forbearance, which returns it to performing, and through the debt enforcement route. The second cluster, then, I would say, is really moving the problem out of the bank. So I'm talking here about NPL portfolio sales, securitizations, and then, of course, moving NPLs or distressed assets to asset management companies. And these tools really took a lot of time and government will to establish. It took years for this to be set up. Legal frameworks needed to be created, supports put in place. And of course, we can't forget, it's a huge operation for banks to actually make the first NPL securitization happen or make the first, we'll say, outright sale happen. There needs to be an investor market created. Once then, I would say the supervisory toolkit was established, which took quite a number of years. It still took time, especially for this second cluster, to work in order to really materially start to reduce the NPL stock. But I think once everything was up and running, they've worked quite well, especially for the older vintages, to clear them out. So lastly then, in terms of lessons learned from the last 10 years, I'll just quickly share some lessons learned from, we'll say, the bank's perspective and how they manage NPLs, but also from our own supervisory perspective. So for banks, the best way to manage large volumes of NPLs is to not let them build up in the first place. So obviously that's easier said than done, but there's many actions that banks can take to really help in this area. So the early identification and management through effective early warning systems, having operational capacity, kind of lying in wait, shall we say, and the systems already in place to engage with borrowers quickly is really, really important. So if you catch a borrower in the early stages of distress, you may actually be able to adjust the debt structure to give them that little bit of breathing space that they need to actually recover. Waiting until they're already insolvent or almost insolvent really stops that from happening. The second lesson learned is really around governance. So one of the biggest problems that we faced was denial. So to be able to solve a problem, you need to acknowledge that it actually exists in the first place. And certainly in the early stages, many banks believed that the macro situation might turn around and all the NPLs would somehow resolve themselves. But this was also, of course, partly to do with low capital buffers, and they didn't really have the tools available to them to actually move. But as I mentioned already, if you leave a borrower until they're insolvent or almost insolvent, even if there's a macro recovery, they could be already so damaged that they may actually never recover. So it's so important for the board of the bank to take ownership of the problem and actually get involved. And this really, really sets the agenda for everything. So for resource allocation, for reporting, for forbearance strategies, every single thing flows from the boards or from the board's direction. So related to this is that banks need to correctly classify borrowers. So be it stage 2, 3, NPE, whichever it may be. And classifying correctly is directly linked to the coverage expectations, which requires banks then to build up the necessary buffers to enable the resolution of NPLs. The third important lesson from the bank's perspective relates to the operational capacity. So banks need to have the right setup, for example, an independent workout unit with the correct skills. And these skills take time to develop. I can tell you from experience that dealing with one distressed borrower can take the same time as dealing with 20 performing ones. And the skill set needed is also extremely different. So it's a huge, huge drain on resources to have a huge buildup of NPLs on your balance sheet. So it's really important that banks allocate enough staff early on and make it as easy as possible for those staff by having good IT systems, clear procedures, processes to really eliminate ambiguity, inconsistency, and to get kind of efficiencies in the process of dealing with them. And then lastly, from we'll say a supervision side, maybe just 2 points quickly. So I said that banks need to be proactive. Supervisors also need to be proactive. So it's our job to really engage with banks before NPLs reach elevated levels. And this is where our supervisory toolkit that I mentioned before kicks in. Well, it kicks in now. And then secondly, peer benchmarking has really been a critical tool for us over the last 10 years. So we try to deal with banks in a transparent manner and establish, we'll say, public supervisory expectations where we can. But no bank wants to be the one that is disadvantaged by being the first mover when it comes to implementing a supervisory expectation. But having peer benchmarking available to us in order to engage with individual banks that are maybe falling behind has really put us in a strong position to be able to get banks to take action and to move to address the legacy issue. I think I've covered quite a lot there, so I think I'll leave it and hand it back to you, Max. Thanks.
Thank you, Marie-Therese. Following up to your observations on NPL resolution for Euro area banks more broadly, let us now zoom into the experiences and challenges of one large Austrian banking group and its subsidiaries in the experience on NPL resolution. Ms. Habela-Trabeck, please.
Thank you. So, can you hear me? Yes. Welcome. Thanks for your interest and in the direction of Marie-Therese. I did not know what she will be exactly talking about, but to be honest, I can agree to almost everything that you said, and I will also make sort of reference. Before I focus on the practical topics that we are struggling with sometimes, or we are confronted with, let me recall all of us how the operating environment of the last decade has looked like, how many black swans we have met, and then have a very quick look of how this translated or did not translate into movements in the NPL ratios. Global financial crisis, the mother of the financial crisis and the mother of so much new regulation, was for me at that time, I was workout manager not in Erste Group, it was still another bank, it was UniCredit, in one of my first managerial positions. This was effectively the first black swan that I have experienced, and not only me, but for my generation of risk managers and of, I assume, also central bankers. There we could see what a black swan means and when things change from one day to the other. European sovereign debt crisis, also severe, not so much impacting the bank that I worked for at that time, and also not Erste Group. Much more severe for us in Erste Group was the FX lending crisis in several CE countries. Many of you know, especially the Swiss franc lending, when it is combined with repayment vehicles. It was an Austrian invention, so to say, and also exported to other countries, and resulted in severe issues and also in forced FX conversions. Hungary in particular and Croatia, and this impacted in Erste Group and also, of course, of our peers, the NPL ratios quite considerably. US-China trade war, often forgotten because very soon afterwards the pandemic came. The first global shutdown, lockdowns, and I think everyone still knows where he or she has been on the day where in the individual countries the first lockdown has been announced. And this was, for risk managers, a very special situation because for some time, we really had no clue what will happen. No clue what an overall lockdown would mean. Also regulation that was in place and we were very familiar already with did not work in this situation. But policymakers reacted very fast, banks reacted, our clients reacted, and we will then see that on the NPL ratio, it almost had no impact. After the pandemic, I thought now, first time in my life as a risk manager and in the board function, I can stop managing crisis and I can focus again on growth and maybe relaxing our, in the meanwhile, very prudent lending standard. It came differently and well into 2024. Now the figures look much better. We all know we had the inflation and cost of living crisis with the unforeseen sharp increase in interest rates, the global supply chain crunch that we had, and the energy supply crisis. So our clients not only struggled with the absolute level of the high energy prices, but rather more with the volatility and with the uncertainty if there will be an energy supply at all. Energy supply also closely connected with Russian invasion in Ukraine. And not only this horrible war is still ongoing, but we also have the conflicts in Middle East. We have increasing tensions, US, China. We all do not know what China will do when it comes to Taiwan. So an overall very, very uncertain geopolitical environment. And what is not here, but what I have to say, especially after the last weekend, the continuation of severe and extreme weather events is something regulators and risk managers alike, I think, are very well advised to expect to continue or maybe even more severe in the future. How did these crises translate or not translate into the NPL ratio? You see the black bar is the NPL EU average and the light bar is the NPL development of Erste Group. And you see that the direction and the slope is very similar, But in the years after the global financial crisis, we had in absolute terms and also relative in terms of percentage, a higher NPL ratio. And now, since 2016, there we even were better than EU average. Our NPL levels, and we are very proud of it as well, are continuously on a very reasonable level, currently slightly above 2%, but 2% is something which I'm, as the CEO of the group, am targeting also in the long term. Why has this been so high? I do not blame the financial crisis alone. We have to be transparent and also self-critical. In our case, it was Romania. Here you can see the NPL levels of our Romanian subsidiary in the years, and it really surpassed 30%. And Romania at that time was even bigger from the loan book, so the impact on the overall bank was much bigger. And what we did is we sold large scale. It was the first and until now the last time where we sold really big chunks of NPLs. We also had a bad bank, we had repossession, so we used all the tools. And one can have different opinions on NPL sales, and I think we will discuss it as well. Does it make sense from the P&L perspective? Is it fair towards the customers? But what this chart shows and proves, it is effective. It is an effective tool, and we should not lose this tool or be in some way hindered to use this very important tool. And I think there the interests of you as supervisors and of the commercial banks are the same. NPL sales are a very important tool for healthy bank balance sheets. Now coming to the practical challenges, and they are very much, you will hear things which also Marie-Therese was mentioning. First, it is complex. Yeah? It's complex to set up the schemes, to set up the processes, to set up bad banks, or also the other names. But it's very complex when it comes to skills and to know-how. And as Marie-Therese has rightly said, it's very important that you're adequately staffed, which is tricky in workout, because work for workout managers comes in waves. And you need to keep a certain level, a minimum level of a team, and you keep this team busy also in times where there are no new NPL inflows. You can help yourself, and we did it by opening the borders and by reshuffling resources between underwriting and workout and also from the business front. But this is not to be underestimated, and in the wide range of complexity, for me, the most challenging for the managers. Second, reputation. Reputation of banks has suffered in the past, and you can imagine that we hear very fast and immediately when a company gets into trouble or more customers get into trouble, that banks give the umbrella to the clients, and when it starts raining, they take it away. So we are leaving our clients alone, which we know is not the case. We are really trying hard, and we are also, again, a reference to Marie-Therese, engaging very early on to help the customers. So our preferred workout option is restructuring to help the client really on the long term, which at the end is also the best result for the bank. But you need to be very careful on reputation. Also when it comes to asset repossession, which I also will mention briefly, imagine that now in the cost of living crisis, banks would have taken private apartments on their own books. And then you can read in the newspapers, interest rates are rising, families can't pay their loans, and the banks are taking the apartments. And also very important, choose your partners wisely. You have to be very careful which collection agencies you are using, what practices they are using, because it's our reputation at the end that needs to be protected. Regulatory and legal hurdles, and I'm not talking about banking regulation, I'm now talking more about tax regulation, and I give you one example from Romania. In Romania, there's tax legislation in place, which means when you when you sell a loan, when you have an NPL sale, you have to tax your loss. So the loss is not tax deductible, which does not mean, I give you one example, when you have a 10 million NPL and you could sell it for 1 million, you would need to pay corporate tax for the 9 million loss, which renders NPL sales not very profitable. And in fact, it's a very clear message from policymakers in Romania. They don't want banks to sell NPLs. Rules regarding enforcement are very different between the jurisdictions. This is also something which we have to manage, which is a challenge. And when I can briefly mention mortgage loans, there is, from time to time in different countries, there come various ideas how consumer can be better protected from banks when it comes to enforcement. So one very popular idea, regularly recurring, is that when a client is not able to repay his or her mortgage, they're entitled to hand over the key. So the bank is obliged to take the apartment or the house, and the loan is forgiven. Yeah, so you trade the apartment against the loan. Also, this is something you can imagine we are not very fond of. It does not pose in practice so big issues so far as the restriction on NPL sales. However, the idea is always coming up. Legal costs, not a big surprise. Asset repossession, only 2 words. Asset repossession for us is, as well as selling of NPLs, is a valid tool in the toolbox. However, when you, and also we did it, we did it in various countries, but when you do a very, very honest and hard backward-looking calculation, it costs time, it costs a lot of resources, and to be very honest, in best case, it's a zero-sum game. Still, it can make sense in special situations. Is it very profitable at the end when you are very critical and self-critical? Not really. Bad bank, I briefly mentioned, and they're the biggest topic which I admit we could not solve at that time when I was still working for UniCredit, is transfer pricing, finding the right price. But I know that my colleagues will come to these topics more in detail, and so I hand over to the next speaker. Thank you.
Many thanks. Ms. Haber-Drabeck, you mentioned 7 different crisis episodes affecting euro area banks, or some euro area banks, since the global financial crisis, or starting with the global financial crisis. Now, one crisis, the European sovereign debt crisis, affected one country far more than others, which is Greece. And Greece, still a couple of years ago, affected by the sovereign debt crisis, had a very high NPL ratio, but made tremendous progress in bringing down NPL ratio, so making it a very interesting case study, actually, to look at how you can deal with non-performing loans after a major surge following a crisis. So I'm very happy that we have Yannis with us. So let me ask you this very general question. So what are in your view, the main lessons from the NPL developments in Greece over this, again, 10-year period or so?
Thank you, Max. Of course, you all know the Greek crisis. It has been one of the worst post-war economic episodes worldwide. Greece lost about 1/4 of its GDP. And this huge contraction of GDP took a toll on the asset quality of Greek lenders. In the peak of the crisis, NPLs was the largest asset class for Greek banks. So about 50%, about half of the book was non-performing. And for some specific sub-segments, such as the small business enterprises, the SMEs, and the small business and professional, which are the backbone of the Greek economy, it was 60 or 65%. So it was an enormous systemic risk. Of course, as you said, the situation is way better now. So perhaps I can share with you some lessons learned from managing NPLs, starting with the most important, in my view, which is the impediments for NPL workout. You don't know how many impediments are there unless you have to deal with these impediments. So You may recall, Max, that if you read the prior actions in the MOU, this 100 pages document for Greece, the vast majority was about impediments, tax impediments, as you said, legal, judicial. Just to point a few, the Greek state had a super priority for collection in an auction. We had no experienced judges. Practically the collateral enforcement was impossible. And this created also secondary effects for us, for supervisors, because we were running at the early years of the crisis stress testing, but we couldn't factor in these parameters in our LGD. So there was a completely, let's say, we missed our true capital needs at that time. So dealing with removing impediments for NPL workout is very important. Then the role of the supervisor is important. First, to make sure that banks have the proper NPL governance function. At the early years of the crisis, Greek banks were not ready to deal with such a massive inflows of NPLs. And from our point of view, the supervisors, we didn't have tools and we couldn't monitor these inflows. You may recall at that time, with your help, the institution sent external assistant, I think it was BlackRock. We created a framework a governance framework for NPL governance. And of course, a very nice granular reporting template, because FinRep, the Europeans in the room, they know that, was not supportive at all in monitoring the inflows of NPS and the bank's actions. And of course, we were running the stress testing to ensure that banks have the proper capital cushions and provision cushions to deal with these NPLs. And of course, at the early years of the crisis also, we set up time-bound operational targets that were published in our website, and this promoted transparency and pushed banks to offload their NPLs. And of course, the role of the SSM was super important there when they introduced the so-called prudential backstop, the Pillar 2 prudential backstop. That, in my view, was the largest driver that forced Greek banks to move on and proceed fast with the disposal of NPLs. Now, moving to the secondary market, in 2010, there was not a single NPL servicer operating in Greece. Now we have 15 or 20 servicers that are active in the country. These guys have the expertise, they have the know-how to deal with NPLs, and of course, without them, you can have a transparent and well-functioning secondary market. And now funds can step in, acquire a portfolio, and then have assign an NPL servicer to service this portfolio. So the NPL servicer and the secondary market was important. And of course, what has been the game changer for Greece was the setup of the asset protection scheme. It was called Hercules by the mythical hero. It is similar to the Italian CAGS, and it's practically a typical asset protection scheme with the protection guarantee, the state guarantee on the senior note. Prior to HAPS, if you see the drivers for the NPL reduction, was primarily write-offs. The new formation was balanced with outflows, limited collection, limited liquidations. So after that, it is a completely game changer, and this facilitated the disposal of more than 60 billion of NPLs. Now, of course, I need to stress out that the debt is still out there, and I think this is something that we're not discussing a lot in the European fora. The debt has been removed from the bank's balance sheet, but it's still out there. It's a burden to the private sector. And here is the role of NPL servicer, which is very important, to work out effectively this debt, either providing a good restructuring solution to a viable customer, or liquidate either collateral and bring it back to the production. So this is very important, and unfortunately, what we see in Greece is so far limited progress in working out this debt which is outside the banking system. One other point has to do with borrower-based, with the borrower support measures. As I said in the beginning, the crisis was systemic. So the residential portfolios also, we had high NPL ratio there as well. In the early years of the crisis, it became evident that we needed some kind of support, some targeted measures, protection for the primary residents, because it's different to have, let's say, a commercial real estate crisis, and it's way different to have primary residents on the hook. So at that time, the lawmaker came up with a law that aimed to protect the vulnerable obligors and somehow ensure social cohesion. But there were some deficiencies in the law. I'm not sure, I don't think that it was by intention, but resulted to some extent to the emergence of what we call the strategic defaulters. So it eroded somehow the payment culture and affected the asset quality of Greek lenders in the resi portfolio. So targeted support for any country that would face the problem in the future should be very targeted and should ensure that there is no moral hazard created by the support. And one final point for coming back to the asset protection scheme. The proper design, I mean, you're aware of how this is working. I don't need to enter into the details, but the proper design of the scheme is important. You need to align the interest of the servicers and the state, because the state is on the hook here. They guarantee the senior note, and unless the design is proper, you may suffer from fiscal costs down the road. And one final comment, perhaps, coordination among stakeholders is also important. I mean, the central banks, all stakeholders, banks themselves, and the supervisors, and the state. So that's it from my part.
Okay, thank you very much. I think we'll get back to some of these points in the discussion later on. So just to recall for everybody, I mean, the main themes were the removal of impediments to NPL resolution as an important first step. You mentioned like the development of a servicer industry as a precondition for NPL sales and securitizations that were then supported also by a state support scheme, NPL securitization scheme with a government guarantee on the senior tranche. And you also touched upon the borrower relief measures. Maybe we can come back to them also later. Staying on the topic of state support schemes for NPL resolution. Often in a systemic crisis, there are considerations by authorities to set up a centralized asset management company. So let me turn to Miguel. What are the benefits, risks, and costs of setting up such asset management companies from your perspective and from the IMF perspective?
Okay, thank you so much, Max. I prepared a presentation, and basically here I will also take the opportunity to present a paper that has been recently issued by the IMF, and it's a technical note and manual that has been developed by the Financial Crisis Division of the Monetary and Capital Markets Department. And to this technical note and manual, it has been the contribution of many colleagues from the Financial Crisis Division, and this is the result of the analysis of the experiences with centralized public AMCs across the IMF membership. So we went back to 1989 all the way to 2022, and basically we have identified 30 cases where there has been the tool of a centralized public AMC used. And here I would like also to limit also the scope of the work that we have been doing that has been basically centered into centralized AMCs that got some kind of state support, which means that we have not been considering those AMCs that have been created ad hoc for individual banks. only in those cases where there have been several AMCs created for individual banks, thus reaching a systemic dimension. In those cases, we have also taken those into account, and there are a couple of cases in that regard. And then, once I have explained the scope, I would like to first go into what will be the easiest part, which is the advantages that the ANC will have. And we are all considering always two main rationales. One is the market rationale, that basically means that the state would step in basically to establish a floor on the falling asset prices. So basically, we'll be in a situation where there is a financial stability risk because of a dimension of NPLs that have reached this systemic dimension. And basically, banks have the alternatives to engage into fire sales, thus not realizing the real economic value that is underlying those assets. So the alternative could be the creation of an AMC to establish this floor. And this would be done through a transfer price that would be agreed. But then we will see later that the transfer price is going to be very, very tricky, and is going to be the critical decision that would basically decide from inception whether this AMC can be successful or not. And then sometimes the experience that we have been seeing is that policymakers are optimistic in those transfer prices, expecting an economic value that then does not translate years after. And this is the big risk that you will have as policymaker when creating an AMC. But then we also have this operational rationale, which would be what are the operational advantages of creating an AMC. And basically would mean that we are going to transfer all those NPLs, remove them from the banking system, and put them into an asset management company that could have a centralized and specialized management of those NPLs. So this will have two effects at the same time. On the one hand, banks can refocus on what is their core lending activity. And on the other hand, you can also optimize debt recovery strategies, because basically you can also take advantage of economies of scale and take advantage of that centralized management of NPLs that can prove to be very useful, especially when we have NPLs that are multi-lender NPLs, basically. So that way, you have a centralized way to deal with them. And last but not least, that way you can also promote a standard and uniform practices regarding the pricing and the valuation of those assets, because basically it would be centralized. So these advantages are clear up front, but this would be more the picture that we have at the beginning, when the policymaker has to decide whether to go ahead with the creation of this AMC or not. But what is very important to take into consideration is not that initial point, but to go further through the complete cycle. So basically, the complete life cycle of that NPL recovery process. And this is what brings us with the important costs and risks that we are going to face in the creation of an AMC. So basically, here I have highlighted what we consider that are the 5 main costs and risks that we have. The uncertain transfer prices, that I will go more detail in the next slide. But then there is also a high vulnerability to downside risks. And what we mean with this is basically that if you are centralizing all the NPLs of the system in an asset management company, you are going to have a large scale of NPLs. So any downside risks that may materialize, even if the AMC is well designed, will have a big impact on that AMC, and that will have a big impact also on the potential fiscal costs that will be assumed by the state. And this needs to be very carefully considered. Then we also have the issue that when you are creating an AMC, you have to establish from inception that AMC. That means that you will have high operational costs, high setup costs. You need to attract the adequate staff. You need to have adequate IT systems. And more importantly, you will need to take care of the collateral of those NPLs. And keep the value of those assets is going to be expensive. So it's very important to take that also in consideration. And then you also have what we call the political interference risks and also the reputational risk. A previous panelist mentioned the importance of the reputational risk for a bank, but that's equally or even more important for a public company. So a public agency needs to be very careful when dealing with those NPLs, when dealing basically with those distressed borrowers, because it has got a big reputational risk. And also there is the potential risk of political interference. So if that AMC doesn't have a clear mandate, there may be the temptation by the policymaker or the political party that would be governing at the time to engage into other kind of protection of distressed borrowers and so on. So that's why this is also another risk that needs to be very carefully considered. And finally, the moral hazard, that basically would consist and depend very much on the transfer price. That would be the moral hazard that at the end the state would be assuming those losses. So all these costs basically need to be carefully considered by the policymaker. And although at inception it seems that IMC would be a very good idea to deal with a systemic case of NPLs, it's very important also to balance this with the cost and risk, because once it is created, then the issue will be difficult to deal with. No? And the past experiences that we have been seeing is that basically the transfer price, if I would have to choose the original thing of the why there have been bad experiences with AMCs, would certainly be the issue of the not establishing an adequate transfer price. And this is because when establishing the transfer price, basically the policymakers have to deal with a high level of uncertainty, and there will always be the hope that there will be economic recovery sometime sooner than later. But then this will translate into a situation in which we can have recoveries that are going to be lower than the transfer price. So what we did in the paper is for those cases where there was available public information, we have compared the transfer price with the recoveries that happen later on. And you can see at a glance, comparing both graphs, that the transfer price tend to be higher than those recoveries. And this means that at the end of the day, there have been fiscal losses absorbed by the taxpayer. So that's why it's so important to be very thorough in the establishment of this transfer price. Be very prudent. It's better to be a bit pessimistic than to be overlying optimistic. And if you have a good transfer price for inception, there are better chances of that AMC basically to be run properly. But if that's not the case, the only thing we're going to do is to transfer losses from private stakeholders to the taxpayer. And this is basically what we would like to warn from the fund that should be taken into consideration. And then we have obviously other key design features. No? One of them is to have adequate capital and funding. And what I mean with having adequate capital and funding, I mean that on the one hand, this capital and funding should come ideally from the government and not come from the central bank. There have been a few instances in which the central bank has been the public body setting up the AMC. But this does not align with the monetary policy role of the central bank, also puts at risk the central bank reserves, and also will hamper the independence of the central bank. So these are three reasons why the funding and the ownership of the AMC should not come from the central bank. This should come from the government. And then, very important as well to have a targeted and time-bound mandate. So to have a targeted mandate will help us to avoid this political interference I was referring to before, but it's also important to establish a realistic deadline. So basically to avoid that the AMC will end up being an open-ended state-created institution that will be working for many, many years. No? So here we also did another analysis, again, for those cases where we had available public information. And you can see basically that those cases that are in red means that the sunset clause was not met. And in those other cases that are in yellow, there was a need for the policymaker to revise the sunset clause, meaning basically to allow for more time. And for those cases here that you don't see, remember there were 30 AMCs. That means that the remaining AMCs that are not in this graph didn't have basically a sunset clause established, which means that then it's very difficult to close down those AMCs, because if you have a mandate of maximizing value of the NPLs, sometimes there will always never be a good moment to basically dispose of those NPLs. That's why the maximized recovery mandate should be in a time-bound manner. So basically you need this sunset clause. And last but not least, very important when the AMC is created, that it has got a strong governance. And this is needed because basically we are talking about AMC that has been created with public money, and that's why it's needed basically to have a company that would be a separate legal entity created by the government, but which is at arm's length of the government. And that will also need to have independent and commercially driven management. That's super important. Make sure that the management have very clear that they have to fulfill this mandate within the sunset clause that was established. And finally, the controls. Those controls can be internal, with strong risk management procedures, with adequate committees, but also external, with external audit, and also with external control by the state. And with this, I will stop here, and then we can continue with the panel.
Thank you very much, Miguel. So let me ask a few follow-up questions to your presentations. Let me first start with Ms. Haber-Drabeck. So you mentioned among the challenges of NPL resolution, the reputational risks. Can you elaborate on how these reputational risks, how you would see them for the main tools to resolve non-performing loans? So in particular regarding restructuring, that loan restructuring, which I think you agreed with Marie-Therese should be the cornerstone of an NPL resolution strategy. And if I'm not mistaken, you also referred to the reputational risks in relation to sales. Mm-hmm. Can you please elaborate a bit on this and how this challenge could be reduced effectively?
Yeah. Maybe let me start with consumer loans. Consumer loans are these type of NPLs which are where NPL sales or use in collection agencies is very widely used. And just choose your partners wisely. Yeah? Choose well-established collection agencies. And I think nowadays this is not a big topic anymore, but some years ago, or when this whole thing started, there were very strange market players around and approaching clients really in a non-appropriate manner, and you have to be very careful. There's also there is different legislation. Are you allowed to contact clients via the mobile phone or not? So you need to be sure that those agencies that you are using are not destroying, because not destroying their and not our reputation, because usually they are working also in the name of the banks. Yeah, so there are different sort of contracts. So this is very important. And what I already mentioned in my in the short intervention, I mentioned Romania, yeah, where we sold, and looking backward, I'm very happy that we did it, because since I'm group CRO, I don't have to struggle with the high NPL levels anymore. However, we need to acknowledge that clients tend to remember. So the market knows that we sold NPLs on a larger scale, and no client wants his or her loan being sold to an unknown third party. Yeah, so this is something which you need to balance. Also there you need to be careful to whom you sell. But it takes time to overcome a certain, this is skepticism also of the market, if the bank will remain with them and really invest time in a peaceful and in a constructive restructuring.
Mm-hmm. Okay, thank you. So on this topic of the NPL sales and transfer strategies that many of you mentioned as an additional avenue to working out NPLs internally through the establishment of the workout units where you have operational capacity, as Marie-Therese explained. So let us stay for now on these transfer strategies. So of course, one way to overcome this issue is if you have asset management company that is set up for that specific purpose, or where you have some other type of state support scheme, actually. So a question to mainly Miguel, but maybe Yanis wants to come in on this as well. So if you compare the asset management company approach and the approach chosen in Greece and Italy on not having non-performing loan securitization schemes, so also transfer strategies, but with with different notes being issued, part of them retained by the banks and with a government guarantee coming in, not outright fiscal support to set up an asset management company. So if you compare these two approaches, so how do these benefits, risks, costs compare, and under which circumstances could this approach that Italy and Greece have mainly chosen be preferable actually also for other countries, this asset protection scheme approach? Maybe
well, maybe I would maybe start with a caveat, which is that there is wide experience with AMCs, but when we come to state securitization schemes such as Hercules, that was mentioned by Johannes before, or GACS, I think we still need more time, basically, to see the NPL recovery process through its whole life cycle. And then we will be able to have a more informed comparison between both the schemes. No, that's the first thing I would say. But there is clearly one advantage that you can say, which is that you don't need to put a fiscal cost up front. But this advantage also comes with a big challenge, no? Which is that the policymakers should be very aware that if you are providing a guarantee, that guarantee is possible will crystallize. And sometimes I fear that that could also lead to the policymaker to consider that it has a false sense of comfort, that because it's a guarantee, there is not a front cost, then this guarantee will only materialize in very rare circumstances, which, depending again on how this NPL recovery process is going to go ahead, will be true or not. So I think that's something that should be considered. Then another issue that where I see that there is an advantage clearly is that you don't have the high setup cost that you have for an AMC, because when you have to create an AMC, there will be high setup costs that in this case, obviously, you will not have. But on the other hand, with a state guarantee scheme, with a securitization scheme, what I see as well is that basically you are not going to keep the upside value if there would be at the end upside value for those NPLs. These cases are not so frequent in practice, but if there is upside value, that will not be taken by the state, because basically it's only this guarantee. No? And then you also, I don't think you have the same strategic control regarding that NPL recovery strategy, because you have a big transfer of NPLs to the credit services. No? But then here the big thing, I think that the big challenge that you will have in the case of Hercules or other securitization schemes is that there has been this transfer to credit servicers. The banking system is clean, but then, as you also pointed out before, you have still these NPLs there in the financial system. Also now, it would be important to get enhanced transparency on how those credit service providers are advancing and so on.
Thank you. Would you want to add something?
I completely agree. I mean, we haven't seen the full recovery cycle for Greece and Italy. And there could be country specificities. I mean, if Italy has less impediments, judicial impediments for Greece, for instance, or what is happening with the reperforming loans, if in a country, okay, in both countries the SSM is a supervisor, but the supervisory stance on RPL loans could be a game changer also for the performance of this asset protection scheme. So I completely agree. We haven't seen the full cycle. We're actually contemplating the idea of AMC versus APS. I don't know whether we chose at the time the easiest way out. I know for the banks it's also a bit better in the sense that they get a zero risk weight on the guarantee note. So it's I know that for banks perhaps it's a bit less costly. That's my reaction.
Okay, thank you. Very brief follow-up questions from Marie-Therese, and then we will open it to the questions from the audience, also in the interest of time. Very quick, so asking for a quick response, please, by you, Marie-Therese. So you gave us this overview of critical ingredients for the NPL reduction in the high NPL banks in the euro area. Of those elements that you mentioned, is there anything that you would point out as the game changer, or what has been the most important ingredient in this respect?
It's quite hard to point out one. I would be quick though and summarize which ones they were. So I think from a supervisory toolkit perspective, it was certainly the P2R backstop, so the provisioning calendars that were introduced. And I think if we look at the tools or the measures that were employed to reduce the NPLs by banks, we would look at forbearance measures. But a lot of the forbearance measures were only really allowed or made possible because of the write-offs that happened. So bringing the debt levels down to a sustainable amount to let borrowers recover. And then, of course, the transfer, so the outright sales, the NPL securitizations. But maybe just one tiny point to follow up on the discussion, the past point. So you mentioned, Miguel, that the transfer price is super important to the AMC. It's also incredibly complex in terms of the transfer price into a securitization because it determines the attachment points of the first loss tranche, the senior tranche, and that's actually been extremely difficult for us to assess as supervisors in terms of the significant risk transfer assessment. And just as a lessons learned or a pointer for banks, one of the best ways of improving the transfer price is to actually have documentation in place, kind of a good setup in terms of understanding the borrower, having data available, the documentation all available to actually let the investors look into seeing what's there and understanding how the portfolio is actually moving. That actually has always made the difference between kind of a better transfer price versus a worse one. But I will leave it there. Sorry.
Thank you, Marie-Therese. So in the interest of time, let's now open this discussion to questions from the audience. I think we have time for maybe 2 or 3 questions at the most, I'm afraid. But let me ask first in the room. Is there any question? Yes, gentleman from Cyprus, please.
Anyway, thanks for the very interesting discussion. First question, I fully agree with prevention of NPLs instead of management of NPLs. You discussed very nicely that the average about 2%, which is not bad. You know, having 2% non-performing loans. The majority of the European Union countries have less than 2%, which is good. But as you might have observed, Mediterranean countries have a much higher non-performing loans. Cyprus, Greece, Spain, Italy. Is it because of lack of bank regulation? Is it because of macroeconomic factors? Or is it because of bad governance, or a combination of 3? That's my first question. Second question relates to AMCs. As you, Miguel, nicely, discuss AMCs. And we have 2 types of AMCs, right? We have public and private. And you nicely mentioned that there are moral hazard issues. Moral hazard issues, if not mistaken, there are only if they are public, government-owned AMCs. If there are no government AMCs, there are no moral hazard issues. The question is, why should we have government-owned AMCs and have moral hazard problems? And is there any evidence that if there is government-owned AMC in this specific case, the transfer price is in favor of the private financial institution? If this is the case, there is a moral hazard issue. Your opinion. Thank you.
Mm-hmm. Thank you.
Maybe I try to explain where maybe these differences in NPL levels may come from. And to give you one example from our group, this was Croatia. Croatia had the highest. So after Romania, we cleaned up with NPL sales, and in Croatia the NPL levels still were elevated, and now they are at a super low level. And the reason was that the speed of working it out and the target of having NPLs worked out fast had a different weight. Yeah. It's always a trade-off. If you work out fast, you might get less returns. So keeping an NPL level for a longer period of time is not necessarily bad. At least this is our experience. It's a trade-off. We went, and I think it's a good way for the faster recoveries, faster processes. Also the regulation on backstop and provisioning helps in speeding up. Maybe this is the reason, but I cannot judge on Italy and Greece there. You are much better.
Perhaps can see here on Greece. Okay, I mean, and I guess for most countries in the EU periphery, I would say that macroeconomic factors are the primary driver for NPLs in Greece. But having said that, you remember, Max, that Greek banks were like sitting ducks at the time, suffering from heavy populism that eroded the payment culture. So populism is something that could be a driver for NPL increase, and unfortunately, banks are, as I said, easy target. And then poor laws can be the driver. I just mentioned in my intervention a purely designed law for residential primary residence protection encourage strategic defaulters.
On the second question, Miguel wants to briefly.
On the question of the AMCs, of private AMCs, indeed, that would be a beautiful solution to have a private AMC that is centralized. The problem is that when we are considering centralized public AMCs, we are considering a situation of a big financial distress with a huge amount of NPLs that the private sector does not want to get involved, basically. So it's very difficult to be able to capture private funding in those situations. However, on the other hand, when you were mentioning private AMCs, there is indeed the experience with private AMCs that are set up by banks themselves, and that's perfectly fine, and that's a very good approach indeed, because indeed you don't have this moral hazard. The thing is that in this paper we are focused on these centralized public AMCs, not on these other ad hoc AMCs that are established either by the private sector or by the public. But indeed, the thing here is that when you have such financial distress and such uncertainty about what is going to be the economic value of those distressed assets going forward, basically there is sometimes the need for the state to chip in because there will not be private funding available.
Do we have any questions? Maybe we have time for one more question from the online participants. Ingrid, please.
Yeah, there's one question from Philip Balkan from Yale University. How should central banks consider responding to a financial crisis caused by exogenous factors that unexpectedly leads to market illiquidity and a potential undercapitalization of parts of the financial system? As in March 2020, should banks be required to mark-to-market losses on their loan portfolios, potentially driving them into insolvency? Or should such requirements be exempted in such circumstances? To what extent should policymakers use discretion in deciding how best to respond?
Okay, thank you. So this is a quite broad question that relates to different parts of the conference today. So I don't know who of you wants to take the lead on this. Perhaps one of you wants to focus on the accounting treatment. So this issue about this mark-to-market evaluation, which is typically not applied for loan portfolios, since they are typically held at amortized cost. Maybe
exactly. Yes. I mean, it's for loans. It's amortized cost, so we don't have any such issue. Perhaps linking a bit to the question, that the timely recognition of the problem and the denial that Maria-Teresa said in the beginning is equally important. I mean, you need to take actions at the early stages, and both policy action and, of course, the banks themselves to try and deal with it before insolvency. I think your point, Maria-Teresa, was perfect and spot on.
Mm-hmm.
Yeah, maybe, and just to complement as well, there was also a mentioning about how to deal with undercapitalized banks. So basically, here the question was referring to the role of the central bank, but that will depend also on what is the specific institutional framework in each jurisdiction. No? Sometimes the central bank will have a bigger role because also may host the supervisory authority and the resolution authority. In other instances, may only be the one providing ELA, as it was mentioned in the previous panel. No? But here what I think is that What should be avoided is to reach that point in which we have an undercapitalized bank. For this, there is already a very strong framework. In the case of the EU, this framework has been reinforced, and basically a strong supervision will make sure that there is early action that is going to be taken. But then you also have the resolution plans, no? So in case there is first you will have the early intervention by the supervisor if needed, if there is a breach of prudential requirements. But then if there is a situation where the bank is reaching a point of non-viability, time is of the essence. So the sooner the authorities act, the better it will be for the financial system and to avoid spillover effects. And for that, there is the framework of resolution planning that should be basically put in good use under the circumstance.
Let me just follow up also looking at Marie-Therese. So I think one specific reference we could give that can be useful for other countries, really talking about an unexpected major exogenous shock like the COVID-19 pandemic. There's a good example probably from the SSM. The SSM reacted to the pandemic also by writing a letter to all the CEOs of the supervised banks. So maybe, Marie-Therese, you want to very briefly tell participants so what these dear CEO letters were mainly telling the bank managers in that situation of high uncertainty.
Yeah, so I think there was two letters. So one was issued quite early on, and that was really around the operational capacity that I mentioned before. So trying to set out expectations about what banks should practically do. So like segmenting the portfolio, trying to understand where are the pockets of risks, which sectors are probably more exposed, getting up to speed. It's a very complex topic, as Alessandra had mentioned, actually getting the capacity in terms of resources in place to deal with some of these issues. And then the second letter came a little bit later, where really it focused on how to identify and classify those loans, because it was actually a really complex time. So how do you know if something's forbearance if a government measure has been applied to that borrower? There was a lot of uncertainty or ambiguity around how the circumstances should be dealt with from a regulatory perspective. And this is what the second letter tried to clarify. It was still, I think they were very difficult letters to draft, because obviously we had different schemes and different approaches in each country. So it was quite there were two quite general letters that tried to be a little bit practical towards banks, but it was a complex approach, but hopefully it provided some clarity about what we expected as supervisors.
Thank you very much. So I think we have run out of time for this panel, and I don't want to keep also the participants in the room for too much longer. So after this panel, we will move straight to the concluding remarks by Ernest Gnann. Let me just try in 1 minute to summarize some key themes that came up in this panel. And I, of course, will not do justice for this to be comprehensive. But themes that came up and that were mentioned, I think, many times here. It's like, first of all, to have available, for banks to have available various tools to address non-performing loan problem, and for the authorities to timely work on the removal of impediments and to set up enabling frameworks, including for the sales and securitizations. That actually turned out to be a main driver for the euro area banks, NPL reduction, but also in the case of the Romania that we saw NPL sales really driving this process. In some countries, this has been supported also by state support schemes. We heard some experience on this, and also some caveats on some warnings regarding when and when not to use asset management companies, public asset management companies, which could be another solution. So let me leave it with this. Thank you very much to the panelists, to all four of you, and thank you very much. Let's hand over directly to Ernest. Okay, then we start.
Ladies and gentlemen, it is now time to conclude this joint OeNB, SUERF, Yale, JVI conference on building resilience and managing financial crises. While I'm aware that Max is going to task ChatGPT to produce a conference summary, let me offer some personal and selective takeaways the old-fashioned way. In other words, you are witnessing a horse race between a human economist's brain and AI. My aim is explicitly to summarize this full-day conference in 5 minutes, under 5 minutes. The conference started out with current key vulnerabilities and how to strengthen resilience. We are currently in a rather uncertain phase of the financial cycle. Many may not fully understand risks, their interconnections, and the need to build resilience. There are several potential blind spots in the current supervisory framework: under-regulation of NBFIs, the rapid pace of technological innovation, which exacerbates cyber risk, the evolving nature of climate-related risks, and rising geopolitical risks, which are difficult to manage and mitigate because of their uncertain nature, scope, and transmission. Election uncertainties entail mounting sovereign vulnerabilities. Tightened financial regulation and supervision post-GFC, notably macroprudential policy measures, delivered to a high degree on their promises. As we are gaining experience, and in the light of a rapidly changing environment, these frameworks need to continuously be evaluated and developed further. Ensuring financial firms' governance is key, as was emphasized several times. There is no panacea for models that can reliably predict financial crises. Often, crisis triggers are unexpected shocks exogenous to the models. Ongoing mergers in the financial sector highlight trade-offs between economies of scale and the quest for internationally competitive institutions versus a further exacerbation of too big to fail problems. As banking systems become increasingly concentrated, the interplay between micro and macropru may need reconsideration. Second, regarding crisis containment and digital bank runs. Digitalization has altered the nature, and potentially there was a little bit of discussion here at the various panels, and potentially boosted the speed of bank runs. Liquidity regulation, while important, has its limitations given the volumes involved. Also, we should not try to avoid bank runs by abolishing banks. Extending deposit insurance would create excessive moral hazard. Instead, banks' business should be tightly monitored. Liquidity runs are usually rooted in deeper vulnerabilities. For this, supervisors need adequate powers and have the courage to act in time. The term supervisory culture was mentioned. An effective emergency lending system by central banks is key. The ECB's ELA seems to work better than the Fed's. So far, digital bank runs have become more of an issue in the US than in the euro area, as evidenced in March 2023. Ultimately, interest rate risks sit somewhere, need to sit somewhere. It is not obvious whether it is better if at banks, like in the US, or at households and enterprises, as in Europe. We should be aware of possible trade-offs between banking system fragility and lower economic growth in the long run. Rigid compliance requirements are increasingly hampering cross-border banking for depositors, undermining the EU's single market for financial services. Regulators should refrain from introducing artificial frictions and avoid the impression that the financial system is rigged against counterparties, that is, customers. The digital euro will be designed to resemble the nature of physical cash. Attention is taken to avoid people from excessively flocking into CBDCs in the event of bank runs. Overall, the stickiness of bank deposits, in other words, customer loyalty, is falling. This reduces the de facto duration of banks' funding. The rise of NBFIs is also the direct consequence of post-GFC tighter banking regulation. Indeed, the intention was to remove risks from bank balance sheets. Our keynote dealt with how to navigate through financial turbulences. There will always be bank runs and failures. Regulators and central bankers aim to contain the spillovers. The bank failures of 2023 in the US and in Switzerland tested
how we managed to deal with too big to fail institutions by now. The failure of Credit Suisse, SVB and First Republic have shown that we have made important progress, but more work is needed. There were several lessons drawn. I mentioned financial supervisors need to act boldly and assertively. Even smaller banks can become systemic. Central banks need to provide extensive emergency lending. Resolution plans and rules need sufficient flexibility, or cross-border cooperation is key for successful resolution. There is currently a discrepancy between sanguine market pricing of risk and high global political and economic uncertainty. Abrupt market repricing may result going forward. The first afternoon panel adopted a balance sheet perspective to crisis intervention. Various types of guarantees, for instance, bank debt guarantees, account guarantees, and blanket guarantees, are suitable to address different problems specifically. Capital injections are the most direct method to help undercapitalized banking systems. They can usefully be combined with bank liability and asset guarantees. Combining interventions may signal that a country has credible resources to intervene effectively. The negative experience after the GFC has taught us that regimes for dividend retention and recapitalization can be useful to contain post-crisis credit crunches and enhance macro resilience. Contrary to several other countries, the US authorities did not suspend bank dividends during the pandemic. Future stress tests in the US should extend the range of banks, including those whose business model is not entirely clear and those which are heavily engaged in commercial real estate, something which might also be useful in Europe. In Europe, the mandatory bail-in, while appropriate overall, can cause problems for regional European banks. Separate national emergency liquidity assistance schemes and deposit guarantee schemes in the euro area cause frictions and biases and hinder the full creation of European banking union. The last session asked how to address a crisis-related surge in distressed assets. Obviously, the best way to manage large volumes of NPLs is to not let them build up in the first place. Both banks and supervisors need to be proactive. Once NPLs are there, the first step is for banks to acknowledge there is a problem which will not go away by itself. Correct classification is key to appropriate loan valuation. Dealing with NPLs is a huge strain on resources and requires special skills. Banks need to set up the needed systems in time. Forbearance is a cornerstone of NPL management besides debt enforcement. NPL securitization takes a lot of initial efforts to get running. The last 2 decades were full of shocks, or black swans, as our speaker mentioned them, with direct impacts for banks' loan books. Dealing with NPLs involves numerous risks for banks: high complexity, reputational risks, regulatory and legal hurdles for NPL sales, different enforcement rules across jurisdictions, legal costs of debt enforcement and conflicts with consumer protection rules, high costs of asset repossessions, and finding the right price in case of the establishment of a bad bank. As illustrated by the experience of Greece during the GFC and sovereign debt crisis, dealing with huge amounts of NPLs requires flexibility and improvisation. Securitizing NPLs is a key instrument for dealing with the huge volumes involved in acute crisis situations. Urgent lawmaking under time pressure can cause loopholes, as evidenced by strategic defaulters during the Greek crisis. Setting up centralized asset management companies, AMCs, involves opportunities and risks. They can establish a floor on falling asset prices, help banks to refocus on their core lending activity, optimize debt recovery, and promote sounder and uniform practices on the valuation of distressed assets. But AMCs are no panacea either. Setup costs are high, politics may interfere and cause reputational risks, moral hazard is a real risk. Establishing a fair and prudent transfer price is key. If NPLs are priced too high, an AMC only defers taxpayer losses. AMCs need to be funded adequately not by the central bank as far as I remember. Their mandate needs to be targeted and time-bound. Sound governance and controls are key. To conclude, it is important that lessons from the past are not forgotten and to pool best practices by bringing together experienced experts among practitioners, academic researchers, and policymakers. If today's conference contributed to that, much was already achieved. Let me thank all speakers and moderators for your thoughtful and stimulating remarks. A special thank you goes to Maximilian Fandl from the JVI for initiating this event and for putting in so much work. To Christian McNamara, who is not here today, from Yale University, and Gernot Ebner from the OeNB, for your intellectual and organizational input. I can say that during the preparation phase over the past 3 months, we had bi-weekly meetings to prepare this conference. Thanks to all participants for your interest and for your many questions and comments. Last but not least, a great thank you to Suzy Rubinek and the OeNB's event team, to Dragana Popovic from the SUERF Secretariat for the perfect preparation and organization, as well as to the OeNB technical team for ensuring that we saw and heard each other so perfectly. You will find the slides on the OeNB and SUERF event websites very soon. A video replay should also be posted soon. Thank you all, bye-bye, and take care.